Big deal. We're in talks. And they'll sometimes deny it, even though they spend hours and hours together talking. No, the talks are going along. We're going to hit them very hard yesterday, very, very hard, harder than any attack. I think I can say, General, from a point of knowledge, any attack since World War II. When we talk, we say we're talking. If we're not talking, when you ask me, no, we're not talking, I'll say it. But we are talking right now, we're talking. And we're talking at the request of Iran, backed by Saudi Arabia, backed by UAE, and backed by Qatar in particular, but others also. We're talking about the Strait, the opening of the Strait, having it open literally by tomorrow, completely open. And that's phase one. And phase two is we then will talk about the nuclear capacity, the nuclear, as we've been mentioned. Basically, it's, I think, the denuclearization.
Meanwhile, Tehran has denied that it is holding any talks with Washington, saying that it is speaking to Oman about the Strait of Hormuz. It says that progress has been made to provide a temporary safe route in the waterway. Now, the US military says that it is continuing to strictly enforce its blockade of Iranian ports and has so far redirected 44 commercial vessels, disabled 2 and boarded 2 others.
Now, how are all these overnight cues going to be impacting our Indian market? We have a team of research here to set you up for trade, tell you which are the important stocks to watch out for in the trading session as well. First up, let's go across to Sonal to tell us the important cues that we're keeping an eye out on this morning. Good morning, Sonal.
Good morning, Vinny. Well, you guys have covered how it is the weekly options expiry, so we will see moves in that direction. But before we talk about the Indian markets, let's take a look at what happened in the global markets. US markets staged a smart recovery, or I would say they closed higher in trade in yesterday's trading session. In fact, Dow ended at a record close. It was led by a lot of these tech names. We did have the likes of Amazon, Meta, Alphabet, Microsoft, all of them surged in trade. Asian markets, however, are quite mixed right now. We are seeing some gains from the Taiwanese index, but Hang Seng and the others are not looking so good. The crude oil prices, they were seeing a sharp correction yesterday after Donald Trump called off any further attacks on Iran. There's a wee bit of recovery on those levels. We are around that $83 to $84 per barrel mark on the Brent. GIFT Nifty, after surging big time, is off the highs of the day and is indicating a start in the green. But again, it is off the highs and the earlier indication that it gave in terms of levels. For Indian markets, we extended gaining streak to 4 days and rose to a 5-month high in yesterday's trading session. IT and financials were the major contributors. And what a move in those last couple of minutes, right? Nifty rallied around 200 points on that adjustment forecast. And just before the closing auction, it was at 24,590, ended at 24,774. So that's the kind of moves on adjustments is what we saw. Nifty now has broken out of this crucial overhead resistance of around 24,400 to 24,500 now. Nifty support is at 24,400 and resistance is at 24,800 to 25,000. The buying activity continues from institutions. DII's net bought around 1571 crore rupees. FII's net bought around 922 crore rupees. But yes, we are getting mixed handover from Asia at least. And GIFT Nifty has come up from the highs of the day. So could be a volatile session. But yes, some of the cues are in the positive direction.
Vinny, thank you for, Sonal, thank you for that update there. Over to Upasana then, who will tell you the stocks that should be on your radar today. Upasana, good morning.
Good morning. First up, let me start with SBI Fund Management. It is the first earning post the IPO listing of the company. It's overall been a decent quarter for the company, but company loses market share. Talking about company's mutual fund quarterly average AUM, it is up nearly about 0.8%, slightly above the industry average. Revenue is up 1.3% on sequential basis, and margins also continue to stand strong at above 80% plus level sequentially. Torrent Power is the next one on our radar. Overall, it's been a muted quarter for the company. Revenue has seen an uptick of 3%, margins flat at 19%, and PAT has seen a downtick of 11%. Now, LNG disruption has impacted the company's performance of the thermal power plants. results. GE Shipping, it's been a superb quarter for the company driven by shipping segment with revenue and margin expanding across the board. Revenue has seen an uptick of 67% and EBITDA margin stood at 66.1% versus 53.5%. Coming to KEI Industries now, overall it's been a decent quarter for the company. Margin beat led by company's cable and wire segment. Revenue slightly lower to what the street was estimating and PAT is above our poll. Revenue has seen an uptick of 23% versus the estimates of 27% that we were working with. EBITDA margin stood at 12.4% versus 10%, with a sharp uptick of 240 bips, which was mainly contributed by company's cable and wire segment. And now lastly, coming to PAT, it has seen an uptick of 40%. Stovecraft, another strong performance for the company. It has outperformed its peers. It has reported its highest ever revenue with a revenue uptick of 41% on one-year basis. Margin stood at 11.2% versus 10.5%. Now, Paytm will also be in focus as according to the sources, block deal is expected in Paytm. Paytm book is launched. SEF Partners likely to sell 2.3% stake in the company, and the book size is likely to be around 2,000 crores with a floor price of 13.39 per share, which is at a 5% discount to yesterday's closing price. Arvind Limited also will be in focus as company launches QIP for the fundraise, and the indicative issue size is somewhere around 500 crore and the price set is around 505, which is at a discount of 5% to yesterday's closing. And lastly, coming to Meesho, a block deal is expected here. Peak Partners and Elevation Cap is likely to sell 2.3% stake in the company, and seller seeks to raise nearly 1900 crore via this block deal. So certainly all these stocks will be on our radar today.
Okay, Upasana, thank you so much for that. But in the final update, let's go across to Sudarshan to take us through the cues in the world of F&O. Sudarshan, what are the levels? What should we keep an eye out on today?
Good morning, Vinny. So, very important day ahead of us. Yesterday, one tick and 200 points gain in the cash market that we have seen, and it's on the launch, the first day of CAS, that closing auction session that led to a 200 points jump in the cash market on an adjusted basis. And Nifty in the underlying level, if you talk about, closed exactly at 200 DMA of 24,774. Just ahead of CAS, the level for Nifty was 24,573. But now today, if you look at the Nifty futures level, it's trading at a discount of more than 100 points against the underlying level that normally or generally we don't see of this much discount, 100 or 200 points. But besides this, if you talk about all the indicators remain positive for our market. Crude continues to hold the levels, Brent below $85 per barrel. Rupee continues to appreciate against US dollar. Yesterday also, it saw a level from it at one point, it had gone to 95.11, but at the end, it closed below 95.50, remains positive for our market. Two sectors remain in the focus. Yesterday also, we saw buying both IT and financials in the financial space, especially NBFCs. You take a name, Bajaj Finance, Shriram Finance, Chola Investment, all these names have been seeing buying post Q1 FY27 earnings. But we have to be cautious at this point considering the put-call ratio. Now it's moving to the level where we say we are entering overbought zone. Currently it's at 1.40. If it goes towards 1.50, we enter the overbought zone. Now, GIFT Nifty, it's indicating a muted start currently around up. It's up around 1 point, currently at 24,650. But remember, underlying level close was 24,774. Now coming to the FIs. Yesterday in the index futures, they have bought. In the Bank Nifty futures, they have bought. In the Nifty futures, they were buyers. But in the stock futures, they were minor sellers. They have sold 307 crore rupees. Longs, they continue to add. Yesterday also, we saw addition of 1,800 contracts. Good part. The positive part is the reduction in the short position. Yesterday also, they have reduced by more than 20,000 contracts. Now, the short exposure of 87% is the lowest that we have seen in the last 5 months. In the options data on the put side, 24,400 and 24,350 were the most active ones, and on the call side, 24,800. So now it gives you the range of 24,400 to 24,800. So first support, I look around yesterday's intraday low of 24,515. Next support comes around 24,400 as per the options data. Resistance would be 24,850. Some of the stocks that I'll keep an eye on, Paytm had been seeing fresh longs, but interestingly, block deals will be seeing today. So keep an eye on that. Ashok Leyland, because of the strong data for the month of July, especially on the commercial vehicle front, all the stocks, all the companies have reported very strong and has seen short covering. GAIL has seen fresh shorts. And lastly, APL Apollo, after a strong commentary on Q1 FY27 earnings, stock has seen fresh longs.
Sudarshan, thank you for that update there. Take a short break. On the other side, we get you snippets from our conversation with the management of GMR Airports following a new airport launch. Stay tuned.
Welcome back to Power Breakfast in CNBC TV 18. Now, the inaugural closing auction session at NSE was a confusing one. Nifty gained 1.6%, but Sensex was up only 0.7%. Stock prices on BSE and NSE also saw similar divergences. Now, what exactly transpired and what should we watch out for now?
And nobody really knows what exactly transpired, not even we. Whereas if you saw the final ticks yesterday, the index went up 200 points in just one single move, and from 24,574 the spot went up to 24,774, and there you can see that one perpendicular line that goes straight up, and that was the closing tick that you saw on the index of that special first day of the special closing auction session. And not just that, if you look at the futures as well, side by side, you would see the divergence between the spot price and the futures price. The Nifty spot 24,774, the futures were at 660 or somewhere around those levels. A similar price action was seen on the Nifty Bank as well, an index that was struggling to cross 57,500 until yesterday. All of last week suddenly closed above the mark of 58,000, and that too saw one perpendicular tick right towards the close of the trading session. There you can see 1,000 points on the Nifty Bank, majority of which came right at the close of the trading session. There were not just that, there were divergences seen on the stock prices as well, both on the BSE and NSE. And if the stock closed at a different level on NSE, there was a big divergence on BSE as well. Asian Paints, Bajaj Finserv, L&T, all of them being case in points for that yesterday. The turnover on the first day was well over 1,200 crores is what NSE said in its official statement. ICICI Bank, HDFC Bank, Reliance Industries, Infosys, Bharti Airtel, all of them were the top 5 traded stocks in that closing auction session yesterday. So Nifty heavyweights doing the heavy lifting, unsurprisingly so. And there were 33 stocks in the FNO that had that closing auction session that ended below their reference price. Nothing alarming as such, but just an observation. 200 plus stocks, 33 of them closed below their reference price that is determined by the exchange to start off the closing auction session. And take a look at the top 5 names as well. ICICI Bank had a reference price of 1445, closed at 1460. HDFC Bank had a reference price of 751, closed at 753, so no major divergence there. Reliance Industries had a reference price of 1308, closed at 1320. Infosys had a price of 1172, closed at 1180, and Bharti Airtel too had a price of 1954 and closed at 1970. To watch out for Bharti Airtel in particular because it reports results this evening. See what kind of moves that you see in today's session as well, because the closing auction will continue starting 3:15 p.m. today. So it still remains to be seen. It's still early days. We're still trying to figure out what exactly transpired, but it remains to be seen the kind of action that you get in today's session as well. 1,200 crore plus of turnover on the first day.
Okay, we'll keep an eye out on the next couple of trading sessions as well to see how this works. But on to some earnings now. We have FMCG candidate Marico that is all set to report its Q1 FY27 numbers today. Mangalam is joining us to take us through what the street is expecting from this one. Mangalam?
For Marico, it's a good set. The reason why I'm saying that with so much authority is the fact that we know their first quarter numbers already from the update. It's a low 20s revenue growth with domestic growth, volume growth in double digits, which is the highest that we've seen in the last many quarters. So put all of that into perspective, the analysts are expecting a 20.5% revenue growth, closer to 4,000 crores on the top line, 18.5% jump in the EBITDA, which means the margins come in around that 20% mark, and the net profit grows nearly 15% as well. Domestic volume growth seen between 13 to 15%. Value-added hair oils, remember, grew in 20s. Their digital business is growing extremely well. So management commentary on the way forward will be extremely crucial, given some of their key raw material prices have seen a big decline year on year. So as a result of which, can we see further expansion in their revenues and margins or not is something that we'll be tracking.
All eyes on Marico. Mangalam, thank you for that update there. Now, GMR Airports has added another landmark project, taking its portfolio to 5 airports in the country. The newly inaugurated Bhogapuram International Airport in Andhra Pradesh is a greenfield airport that is expected to become the new aviation gateway for North Andhra. CNBC TV 18's Madhya Mujawar got caught up with GMR's IP Rao. Take a look.
This airport has become like a pivotal for the growth of Andhra Pradesh, and this is a gate of east. You can see that from the center such a way, right from east that up to Calcutta and toward this side, west side, you can complete the whole thing is available for this. And because being center, earlier what happened, Visakhapatnam is one corner, now it's become from Visakhapatnam, Vijayanagaram, Srikakulam, not only the central east and also go the farther east also. That's one thing. Second thing, this airport has completely built a greenfield. So when you're doing the greenfield airport, we have taken what is the best available technology. It should be now technical improvements a lot have happened. So this airport taken the best output of all smartness. For example, right from facial recognition, you're seeing no conventional counters, you're seeing only SBDs and CUS machines. You may surprise Visakhapatnam tied to city, where is this? So we brought the technology up front. And also go up and see security angle. Not only we have put regular security machines, we also put and body scan, full body scan to have testing. So you can imagine this airport has taken this. This is on the front side what you're seeing it. And also there's a smart washrooms which have sensors are there. We'll also use that complete analysis of the floor, water, what's happening, anything going wrong, we'll come to centrally, we'll be able to communicate. Before passenger reacts, we react.
Does that mean that this is in your portfolio, this is the most advanced airport?
I can say yes, because what are the best in all airports we've taken here, obviously.
So you've invested over 5,000 crore in building this airport.
4,800 crores.
Nearly 5,000 crores. How soon do you expect to recover that cost?
See, we don't get it today. I'm getting tomorrow. I'll get it. Invest. No, it's his own plan of action, his own thing. Depending on the traffic demand. You know that regulator income. What comes with depending on it, 3 years or 10 years or 12 years.
What is the period in your mind, sir?
I don't want to guess it, I want to do it.
Yeah, an interesting chat there, but on that note, we're going to slip into a very short break. After the break, we'll get your cues from Wall Street. Stay tuned in.
Welcome back. Shifting focus to the US markets then. It was a very sharp gain and a strong session on Wall Street on Monday. Oil prices slid. Amazon's market cap crossed $3 trillion as well. And the gains came after Donald Trump said that he was calling off the planned strikes on Iran. CNBC's Brandon Gomez gets us a wrap of all the action on Wall Street.
U.S. stocks were up sharply across the major indexes in Monday trading, with a slide in oil prices and a broad market rally after President Trump said he was canceling planned attacks on Iran. The Dow closed up 693 points, the S&P 500 gained 111 points, and the tech-heavy Nasdaq added 540 points. Now, shares of Amazon hit an all-time high Monday, putting the e-commerce giant's market cap above $3 trillion. The surge comes after Amazon reported massive cloud growth in its quarterly earnings last week on strong AI demand. Its biggest cloud rivals also reporting big gains. Microsoft posted a 40% rise in cloud revenue for the quarter, while Google reported 82% growth. And Spider-Man Brand New Day earned an estimated $360 million over the weekend, setting the all-time domestic opening weekend record previously reached by Avengers Endgame 7 years ago. Internationally, the movie brought in more than $570 million, putting its opening weekend global total at $927 million. Industry tracker eTelligence says more than 24 million people went to see the film in the U.S. and Canada, and that's without the benefit of an IMAX release. Those screens have been reserved for Christopher Nolan's The Odyssey.
Okay, thank you so much for that. But staying with the U.S. market, National Economic Council Director Kevin Hassett discusses the state of the economy and inflation concerns. Listen in.
The inflation numbers have been fantastic, the last couple of reports. And the thing about them is it wasn't a story of energy. It was really about everything else that President Trump has been doing. Like you saw, the prescription drug prices dropped a lot because of Trump RX and the most favored nation negotiations. And our dereg efforts are also putting a lot of downward pressure on prices. And so I think the question is it going to continue? And I think that you're right to highlight shelter costs. And one of the metrics of shelter costs that I find most interesting is that they're going down pretty rapidly in places like California because everybody's leaving. And so when we look at the aggregate numbers, the fact that it's actually, even though they're high prices in California, it puts downward pressure on inflation because shelter costs are such a big share of inflation and everybody's leaving the state.
With that, we call time on this edition of Power Breakfast from Edie and me. Thank you for watching. Bazaar Morning Call sets you up for the day's trade on the other side of this break.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. It's a Tuesday morning. I'm Prashant. With me, my colleagues Nigel and Reema. Guys, hi. Good morning.
Hi, good morning. It's an important session because we're less than 24 hours after yesterday's CAS session. There was commotion, there was chaos, unusual levels seen in the last 5 or 10 minutes. And today we've got the expiry. So it's going to be a very, very important trading session. And not to forget that we've got a lot of earnings to track.
Well, my limited point on the CAS is in October 2010. That's when the auction came in for pre-market. I was in the exchange and I was a witness to all the chaos that took place there. And after a few days, no one ever spoke about that. So hopefully that CAS stabilizes as well in the coming days, and we have a better end to the trading session. Though they could be very different with regard to the auction because that's not compulsory to participate, but towards the end of trade, CAS for many traders will be compulsory.
Okay, well, we'll talk about CAS and that a little later on the program, but let's just take it from the beginning, right on top, with regards to what you need to know as far as today's trade is concerned. So Nasdaq 2% higher, the S&P about 1.5% in the green, and you basically have a pretty good close all told as far as overnight US equities are concerned. Just a bunch of things. Bond yield is also cool. So you look at the 10-year, the 30-year. So end of last week, there was a fair bit of concern. I mean, there is still concern. The 10-year is about 4.6, say the 30-year is above 5%, but both actually cooled off. And I think the worry around the 30-year is more. I mean, the 2-year you can play around with, and you can maybe, I mean, of course you can't move it, but the 30-year is definitely much harder in that sense to move, manipulate, and that kind of went up pretty sharply. Now, the July ISM numbers came through, and that was 55.6, that's manufacturing side, as the highest since May of 2022. In terms of single stocks, lots of action, lots of activity. And I just want to highlight one name, which is Amazon. Amazon was up 4.5%, but that's not the point. The point is it's hit $3 trillion in market valuation for the first time ever. It's the fifth name to reach that milestone: Apple, Microsoft, Nvidia, Alphabet, and now Amazon. So you got $5 trillion companies in terms of the in terms of the listed universe. Just incredible out there what's happening in the US. Oil's flattish around 84, so you don't have very much new to learn from looking at the oil price, similar to where we were 24 hours back, 83, 84 in that range. Some commentary from President Trump, and we'll play out some sound bites, basically saying, I want to give them, that is Iran, every last chance before decapitation, is the word he used. You'll find out today or tomorrow. So it's carrot and stick. Sometimes it's a lot of carrot, sometimes it's more stick, but it's basically swinging both sides. And oil prices, I mean, not overtly impressed to make another move up or down in that sense. Now, yesterday, I'll just sort of quickly get down to the levels and what you need to know. But that's what happened, right? Nifty at 3:15 p.m. Was at 24,573, and it finally closed at 24,774. Why am I comparing it to 3:15? That is because the trading stopped at 3:15 before it resumed for the auction session at 3:20. So the last price, I mean, to the reference price in that sense is the price at 3:15, which is 24,573, and inexplicably you had a 200-point surge from that point. And the market was at about 24,774. So it's caused a lot of confusion and a fair bit of hand-wringing and anxiety in terms of why this has happened. And the point is, the systems worked as they were supposed to, and the tech and the ops and all of that worked according to, and I think NSE has put out a statement as well saying that it was all worked. But that's not the point. The point is no one said it's not worked. It's all worked. But if the actual end result, what everyone wanted of this new system was better prices, more accurate prices, did you get that? The answer, of course, is absolutely no. And it basically goes down to a simple thing, which is order book in terms of the volumes which are traded in that auction, and there wasn't very much in terms of volumes. So a small quantity of orders really ramped up the price. It's happened all over the world. In the US, for example, it's called banging the close. And I think it's something which we saw yesterday as well for the first time because of the change we've seen. So, let's hope, this gets populated with more orders on both the buy side and the sell side, and then it kind of evens out in that sense. So for levels that we are looking at today, that I'm putting out, I've looked at Nifty futures, not at Nifty spot, because you can't have any levels based off the Nifty spot because those are not correct prices. So these are levels, the spot price would broadly correspond to this. So these are Nifty futures prices. Once again, I want to emphasize 24,550 is the first resistance, and then 24,940 is the bigger one, which is a projection of the last up move that we have. So 24,550 first and 24,950 on the Nifty futures. The supports come in at 24,490, and that's the very immediate 24,350. 24,490 is the first support. And that's a very, very immediate line which the market must respect. And 24,350 is important for this up move to sustain. So those are the two levels to really watch out for. GIFT Nifty will come up on your screen, and I think it's indicating an absolutely flattish kind of start this morning. But remember, GIFT Nifty is futures. It's compared to futures. I guess what's happening today, of course, is that overnight US markets are up 2%. So in any case, you would have got a bump up. The GIFT Nifty after a 2% pop-up on the NASDAQ would be up, 150 points, 200 points, right? You're not seeing that on the GIFT Nifty. And what perhaps, happens is that the spot either catches up to the futures, or in the pre-open, the spot adjusts a little lower. And then when trading starts at 9:15, it all kind of, falls into place. So we'll see, but that's the rate. What we are seeing at this point in time. Well, Nigel is booked across the wall with the F&O cues and the positioning. Nigel, take it away.
Well, because of the rough edges of the closing auction session, there is a gap between the Nifty futures as well as cash. And that's why now the Nifty futures is trading at a discount in comparison to the premium. So for starters, the Nifty spot will actually catch up to the futures, and then we progress from there on. But the trend seems to be up. And that's heartening from a bullish perspective because it seems the pieces are coming together, as I mentioned yesterday. Institutions, they have turned the corner, which is good news. Both are buyers, the FIs as well as the DIs. Both of them were buyers even in yesterday's trading session. And clearly, yesterday, there were signs of short covering because on the Nifty open interest itself, you did have the open interest that was down by close to around 6%. And Nifty Bank as well, it was mildly low. And both those two indices ended higher. So the shorts are getting squeezed out. And that's precisely what's been happening over the last few trading sessions. And the FI positioning perfectly collaborates with that. Because if you look at it, the shorts, they covered out close to around 20,000 contracts, and long addition was close to around 1,700 contracts, which is telling you the swing factor was close to around 22,000 contracts in favor towards the long side. And that's why now the short positioning from around 92%, it's come down to close to around 87%. But this chart tells you the picture. Remember, the series just started a few trading sessions ago. And in a matter of a few trading sessions, from around 2 lakh contracts, we're closer to around 1.5 lakh contracts. That's a 20%, 20-25% downtick in the FI net short positions. And that's quite sizable in a matter of around 5 trading sessions. The heartening aspect, as I've been mentioning, is the put writing continues. Even in yesterday's trade, there was aggressive put writing, close to around 25 puts being written for every one call. And the strike should come up for you. 24,600, 24,500 put, both of them, added close to around a crore shares odd, with the total open interest between the two up close to around 2 crore odd. So that's telling you at lower levels, we should see some kind of support. If I put out a support on the cash market rate for today, it'll be around 24,450 or thereabouts. The bigger reference rate, if you want to look at it on the downside, will come in at around the 20 DMA, which is very, very deep, 24,150 or thereabouts. But crossing the 200 DMA decisively is going to be important. X of that CAS, the closing session that we had yesterday, you'll want the Nifty to get past the 24,800 or thereabouts. That's what could cause a further short covering bounce and push the market up as well. So the trend is up for sure, but some kind of caution is warranted because today is weekly expiry, and also the implementation of the CAS will be important to track as well.
Well, indeed. Thank you very much for that, Nigel. A quick update then on what's happening with West Asia. US President Donald Trump says talks with Iran are underway, warning that negotiations are Tehran's last chance to secure a deal to end the 5-month conflict. Speaking to reporters, he said Iran faces decapitation if it doesn't strike a deal, and that he plans to open the Strait of Hormuz literally by tomorrow. Listen in.
Maybe get something, but I want to give them every last chance before decapitation. Very tough to do what we have planned, still planned. We'll see what happens. But it's a very, very tough thing to do. I think I'm very proud of the fact that I'll give people a chance. This is a big move. To do an attack that big on a country, I'd rather not do it. Now, we've already, through lots of large attacks, but they were normal large. Hopefully they'll come to their senses, because what happened, cannot have a nuclear weapon, but hopefully they'll come to their senses. When we talk, we say we're talking. If we're not talking, when you ask me, no, we're not talking, I'll say it. But we are talking right now, we're talking, and we're talking at the request of Iran, backed by Saudi Arabia, backed by UAE, and backed by Qatar in particular, but others also. We're talking about the Strait, the opening of the Strait, having it open literally by tomorrow, completely open. And that's phase one. And phase two is we then will talk about the nuclear capacity, the nuclear, as we've been mentioned. Basically, it's, I think, the denuclearization.
Well, crude prices are unchanged, so we'll have to see how the market reacts to these very strong statements coming out of U.S. President. Arvind Sanger, Managing Partner, Geosphere Capital Management, is here with us on the show. Arvind, thank you very much for joining in. Well, since we last spoke, let me begin our conversation with AI. Since you are in the heart of AI, I just learned last time when you were here, with your son being in it. So since we last spoke, semis have been out, while software has made a very strong resurgence and come back. So if you were bullish on semis and hardware, you've got an amazing opportunity to buy. And if you were out of the software trade, well, you could be feeling FOMO. How have you read? Is it just a change in narrative that the market is going through, or we're seeing semis retreat from very high levels?
Well, I think what we are seeing is a lot of cross currents. On the one hand, you had this whole situational awareness fund that was blowing up, right? So you had a lot of reversal of a lot of trades around what they were long went down, what they were short went up. And then for 2 days, things have reversed a little bit. So I think that you have to separate the noise from the signal. And that's an important distinction to make. I think the real question is, China is coming on strong with their open source models. You have some talk about Chinese also starting to build memory capacity. So to me, the memory side and the hardware side is a risk of overcapacity, maybe not 6 months from now, maybe 12, 24 months from now, but the market is worried about that. On the other hand, the software side isn't getting quite as easily displaced. Everybody was assuming that cloud was so good that all these software SaaS companies were going to go away, and it isn't quite that simple. So I think there's a lot of cross currents here going on. But the bottom line is that AI adoption is on an inexorable trend. There will be ebbs and flows along the way. But, there's no stopping the AI wave. There'll be winners, there'll be losers. But, making blanket statements that everybody on one side will lose and everybody on the other side will win is a little dangerous.
The pendulum has been swinging, and yes, it's not about taking an overly pessimistic or an overly optimistic view. But if, as you said, right, software names in the US have come back and they're not going away, what does that mean for Indian services companies? Do you think the next leg of AI can potentially benefit the services company, or it's too soon to say that right now?
Well, it's an interesting question. I was talking to the CEO of an IT services company recently, which is based in the U.S., and we were having this discussion about AI. And he was making the case that if you're a small, more nimble company, which doesn't have a lot of legacy, large installed base, then helping corporates take AI in-house and use that data to train their own models is going to be a very powerful opportunity. So the question really is going to be, you have some of the smaller Indian IT service companies that are actually trading at very strong multiples, which are in a position to take advantage of. The real question becomes, if you're a TCS or you're an Infosys you have your feet on both camps of the simple, stuff that can get displaced by AI, and the stuff that you can help clients implement in-house AI, training your own models so that you're having your own proprietary data using the base, LLMs, but then keeping a proprietary base to improve your own processes and to use that for you. So there is a room for, for IT services, but I think I would prefer the smaller companies with more capabilities than I would necessarily, the big boys who have too many feet in too many areas that might get displaced.
Arvind, hi, morning. For investors based out of India, right, who are watching you, they can. There's this IT services as a pack. Then there's lots of stuff happening in the unlisted space. You've seen what's happening with Sarvam, but of course, that was a larger, but there is smaller stuff happening as well in that sense. So what's the thing to do here? Lots of ways to make money through AI is one, but manufacturing has been doing very well. There's lots of stuff, right, which will be there. AI, and of course, AI is one of those things which perhaps will become all pervasive, but as an investment route, there will be many other things to do. So what's the advice, Arvind?
Well, my advice is, look, I think one of the biggest themes from an AI that we're playing is companies that are helping with install the data centers and the hardware and the equipment needed for the digitization, for the electrification needed. And you're going to see, we haven't talked about the Iran war, but that is going to spur more adoption of EVs, more adoption of, green energy, solar, what have you. So I think the opportunities lie in many areas in India, which are related to some of these mega themes that are going to be with us for a while. Whether it is the whole, green side and things that play off of that, whether it's in the EV space or in the, electrification space, or it's in the companies that help in the AI build out, whether it's companies that are exporting, equipment that is used around the world for supporting turbines and other equipment that is needed for balance of plant. And so there's so many opportunities on the export side, in addition to the Indian domestic opportunities in some of these areas. So I think there are many areas of opportunities that are related to AI or that are related to, other domestic economic growth that are not necessarily dependent on IT services alone.
Okay, we'll chat more, Arvind. Thank you very much. Appreciate you joining us with that and speak again soon. Thank you. Well, just a quick couple of things to watch out for in terms of what you'll be seeing here. Sami Hotels management comes up at 8:35 for a quick conversation on the numbers. KEI Industries and Q1 numbers at 9 o'clock. We'll track what happens in the pre-open with Rajesh Baheti. 9:20, Tahir Badshah talks markets with us. 9:30, the management of SBI funds, which reported yesterday evening, comes on. Aether Energy will also be speaking with us at 9:40. 9:50, we'll have the management of Jindal Stainless on their quarterly performance. And 10 o'clock, another earnings conversation lined up with the management of CAMS. And Lata speaks with BNP Paribas' Chandresh Jain and Bandhan AMC Suyash Chaudhary on rates, rupee, and of course the RBI policy tomorrow.
All right, time to slip into a short break. We've got a lot of stock-specific action to track. We'll go full tilt on them. SBI Funds, KEI, Escorts, GE Shipping, all of them will be reacting to positive news flow. The flip side, DLF will be reacting to negative news flow. Add to the list, Torrent Power, LIC, Paytm, Meesho, and Arvind. Take that break, come back, getting to further detail on all of these names.
Welcome back. You're watching Bazaar Morning Call. It's a Tuesday morning. Time to talk stocks. Our research team is standing by with CNBC TV 18's list of top stocks for the day. Lots of earnings to parse through. Good morning, guys. Devyani, let me begin with you. SBI Funds Management, the first one after their IPO. How did the numbers look?
Well, the first earnings post the IPO listing for SBI Funds, and it was a good one from the company. Now, on a quarter-on-quarter perspective, it continues to be the market leader by AUM, with mutual fund quarterly average AUM going up 0.8%, slightly below the industry average to 12.61 lakh crores. Now, market share has moderated 20 basis points quarter-on-quarter, but the equity AUM grew 2% this time around, higher than industry, but SIP flows have fallen 2.4% on a quarter-on-quarter perspective. So that's a slight negative. Coming to the financials, revenue was up 1.3% to 1154 crores. Yields improved slightly with better mix aiding margin expansion this time around. And this comes as a relief as fears of yield compression due to TER changes have largely been at bay. Now, management has successfully passed on the expense ratio rationalization to distributors, with company neutral to slightly positive post this exercise. Now, operating profits were flat this time around, with margins contracting slightly due to higher employee expenses, but margins came in strong, still above the 80% mark. Now, mark-to-market gains have led to higher profits, as is consistent with the industry, with other income swinging from a loss of 46 crores in Q4 to a profit of 237 crores this time around. So, all in all, a solid update coming in from SBI Funds, going with a green in trade today.
Okay, all right, Devyani, thanks a lot for that. Going across to Sonal, I think she's going with red on DLF. Hey, Sonal, looking lovely in yellow.
Yes. Good morning, Nigel. Okay, you caught me off guard, but let's talk about the numbers now. DLF numbers, they were weak because their pre-sales were down 83% on a sequential basis and down 94% on a YY basis because there were no new launches in the quarter that the company came with. Remember, their guidance is 20,000 crore rupees for the year. This time, bookings were driven by their super luxury project, which is Dahlia's project. Even their customer collections were down 15% on a YY basis at 2,400 crore rupees. But their commercial segment did well because office lease income was up 1% on a sequential basis, 8% on a YY basis. Even their mall rentals did well, 14% uptick on a YY basis. But it's the residential weakness because of which I'm going with red on DLF today.
Thank you very much for that. Over to Vivek now on Torrent Power.
Well, that's right. So Torrent Power came out with the Q1 FY27 results, a slightly subdued quarter, as the management has explained that constrained LNG supplies went ahead and impacted results this particular quarter. Revenues higher by just around 2.8% on a year-on-year basis, EBITDA higher by 3.7%, margins largely flat on a year-on-year basis, profitability down 10.7%. Now, one important update coming from the management in the quarter gone by, they've completed the Nabha Power Plant acquisition from L&T. This particular acquisition has been done at a value of a little over 3,600 crore rupees. Remember, Nabha operates to almost 1,400 megawatt worth of coal-based supercritical thermal power plant in Punjab, with steady-state PPAs already signed as far as Punjab discoms are concerned. As far as plant PLFs are concerned, it's been quite weak given the fact that higher LNG prices have ensured that most of the plants were operating at much lower plant load factors. So Sugen, Sugen as well as DGen, all of the plant load factors were down significantly in the quarter gone by. Going with the red on Torrent Power today.
Okay, all right, Vivek, thanks very much for that. Jio Industries is the next one, and Upasana's got details. You'll hear from the management, as I just told you, a little while later. Upasana, take it away.
Well, it's been a margin beat for the company led by the company's cable and wire segment. The revenue stood, however, lower than what the street was estimating and below our poll as well. But the PAT stood above our poll. So overall, if we look at the numbers, revenue has seen a growth of 23% versus the estimates of 27% that we were working with. And this growth was driven by company's wire and cable segment, which logged a revenue growth of nearly about 25%. Now, if I talk about the domestic cable and wire segment, that saw an uptick of 29% on year-on-year basis and down 5% sequentially. Exports continue to remain muted with a sequential downtick of 7%. and 25% and 7% on year-on-year basis. EBITDA has seen an uptick of 53%. It is much better than what the street was estimating. This is because of the better product mix this time around that the company has seen. EBITDA margins have also seen a sharp uptick of nearly 240 basis points at 12.4%. This was mainly led by company's 281 bips expansion in cable and wire segment and 106 bips in stainless steel wire segment. Now coming to PAT, it has seen an uptick of 40% on year-on-year basis and it stands at 274 crore. Now mind you that the board has also approved proposed capacity expansion of manufacturing capacities at a wire and cable company's upcoming new unit located in Rajasthan. Now overall, if I talk about the peer comparison, the company's revenue growth stands lowest amongst its peers, be it the likes of Havells, Polycab, but in terms of margins, it stands the highest. So overall, we'll be watching out for this stock today in today's trading session.
Thank you very much for that. And we'll try and get the management as well on CNBC TV 18. Back to Devyani, and this time she's going to tell us about GE Shipping's numbers. Devyani?
Superb quarter for GE Shipping. Now, the shipping segment of it was a star, with revenue doubling and PAT tripling on a year-on-year perspective. Revenue, as a result, went up by 67% to 2,005 crores. Now, debt more than halved year-on-year from 1,853 crores to 800 crores, and that aided margin expansion due to 56% lower finance costs this time around. Now, EBITDA doubled to 1,326 crores, with margins expanding 1,260 basis points year-on-year, and PAT was aided by not just better performance but also a higher profit on sale from assets, up 160% year-on-year. So superb quarter coming in from GE Shipping, and as a result going with a green for GE Shipping in trade today.
Okay, thanks a lot for that, Devyani. Well, let's get into it. He's here to tell us about Escorts Kubota, and I believe their commentary and guidance sounded very optimistic. Sud, please take it away.
Good morning, Nigel. So remember last week Anish Shah was here and he said there is a potential upside to tractor industry outlook for FY27. Well, now Escorts Kubota has come out and it has raised the industry outlook for FY27. So in the beginning of the year, Mahindra & Mahindra had given the mid-single digit growth guidance for tractor industry, but Escorts Kubota had given the guidance of flat or marginal growth. Now they are saying industry will see mid to single digit growth in FY27 and company will outperform the industry with continued market share gains. As far as the construction equipment industry growth is concerned, there also they are expecting a growth in the range of 12 to 15%, while exports are expected to be flattish. Now talking about the commodity cost, in the Q1, they had got the margin impact of almost 5%. Now they believe that 1.5 to 2% impact can be seen even in Q2, but they had taken the price hike in the month of April. Now they are planning for further price increase. So on the back of increase in the guidance for industry, I'm going with green.
Thank you very much for that. And for more stocks which are in the news, Vivek joins in. Vivek?
Well, that's right. This is probably going to dominate all of the headlines today. Equity fundraise of almost 36,000 crore will be seen in the markets, between today and tomorrow. We'll start off with the big boy LIC. The government has launched an OFS to pair up to 6.5% stake, with the base size of this particular equity offer being at 2.5%, and the green shoe option is an additional 4%. Now, this actually takes the total fundraise opportunity up to 31,000 crore at a floor price of 382 rupees a share. The main purpose of this particular QIP is something that the management has spoken about all along, to meet SEBI's minimum public shareholding requirements. Remember, the government currently owns up to 96.5% stake. This particular fundraise or OFS will help the government pare down its stake to 90%. Now, one important thing to watch out for post the successful completion of the entire OFS is the fact that LIC will now become eligible to enter most of the passive indices, including MSCI, come the next cycle of the review. Other two stocks in focus on the back of block deals are Paytm as well as Meesho. In both of these cases, the likely sellers today, as per the term sheet that we managed to access last evening, are SAF Partners as well as Elevation Capital. For Paytm, the total size of the block is close to a little over 2,000 crore rupees at an offer price of 1,339 rupees a share. Coming to Meesho, the sellers are looking to raise close to 1,900 crore rupees at a floor price of 182 rupees a share. And lastly, rounding it off with Arvind, a QIP launch for a fundraise of up to 500 crore rupees, indicative issue price at a discount at 505 rupees per share. It'll be interesting to see how most of these stocks react after the slightly negative opening we anticipate.
Okay, Vivek. So the LIC size is about 32,000 crores, right, Vivek?
That's right, a little over 31,000 crore, taking into account both the base as well as
and the green shoe.
option.
And this is the crazy bit, right? NSE, I think, was looking to raise 30,000 crores in the IPO. I think Jio Platforms was about 35,000 crores. So, you know, it's I mean, just the sheer size of this OFS is quite incredible.
Absolutely right, Prashant. You know, almost 90,000 crore, and take into account a lot of the block deals. You know, more than 1.5 lakh crore worth of equity. You know, just in the last couple of months is what we've seen.
Yeah. You know, maybe another consequence of the LIC IPO is going to be if they're able to, you know, in one shot do 32,000 crores. Will the government really look to sell, you know, 500 crores there, 500 crores here? You know, some of the smaller ones where there has been some overhang, or this does the job of collecting a large amount in a single name. So that's another way to look at it. Thanks very much, Vivek, for it. So that's the large issuance which is lined up today. Well, we'll take a break. We are back. Mayuresh Joshi of Mark Smith India is going to be with us with some fundamental stock conversation. We also have the management of Sami Hotels to talk about their earnings, quarterly earnings.
Welcome back. Let's invite the first management on the show on CNBC TV 18. It's Sami Hotels. The company reported a good set of Q1 numbers. Revenue is up 12%. Occupancy has gone up. And the board has approved a 750 crore of fundraise. Ashish Jhakanwala, CMD and CEO of Sami Hotels, is now with us on the show. Ashish, morning. Rima here. Let's begin with the fundraise. 750 crore via warrants or preferential equity. Is this an enabling resolution, or do you have an investment plan? If yes, give us the details.
Good morning, Rima. This is an enabling resolution, which I think you will see as a part of our AGM practice now. You know, we operate in a very uncertain world, both in terms of problems and in terms of opportunities. And I think, therefore, the board needs to have flexibility to access capital if it needs so. But at this point of time, it's an enabling resolution.
Okay, so no plans to raise funds as of now. You've said Q1 saw the impact of the West Asia crisis. A, can you quantify the possible loss? Is Q2 also going to be impacted on account of the same reason, or has business completely recovered? And 3, if you could give us sort of a guidance for FY27 on the key parameters.
So actually, if you see, same store grew at about 9% YOY, which in our opinion is a reasonably range-bound healthy growth. Clearly, there is an impact of the West Asia crisis. The impact is more on the average room rates. If you see our data, occupancy actually closed at about 79%, which is up 400 basis points over the same period last year. So demand is very strong, largely backed by domestic travel. But we always know that the international travel comes at a 10-15% premium. So as we see the crisis dissipate and the international travel resume, you will see that add on to the total revenues. But overall, I think on a same store basis, we saw a YOY growth of 9%, which is within the range that we have guided for the long term. We have seen some recovery happen in the month of July. and the early trends are fairly encouraging, but I would be cautious to replicate that for the rest of the year till we see some more evidence.
All right. Hi, good morning. Good to see you, Ben Ashish. So for the year, what are you planning in? If I look at RevPAR, revenue, EBITDA, a broad outlook.
Nigel, the thing about SAMI is for 3 years, we maintained the same guidance that for the long term, total revenue will grow in the range of 9 to 11%.
Okay.
The last few quarters have only made our conviction stronger that notwithstanding whatever we see in the external environment, same store will continue to grow in the range of 9 to 11%. We are seeing an impact of about 3 percentage point added revenue growth because of the hotels we opened last year. So, with that, if we have a remainder of the year to be strong, we should deliver early teens in terms of total revenue growth. What we are very excited about is FY28 because we are quite prepared to open the W in Hyderabad. And on top of the existing same store growth, that single hotel can add about 5 to 6% in terms of revenue growth.
Got it. Okay. All right. I think we briefly chatted about this. You all were probably thinking about, transferring a couple of hotels to the JV, the GIC JV. Any progress on that front, if you could help me out? And also the net debt number, I think, is closer to around 1,500 crores. You have a good capex plan as well that runs through for the next few years. What's the outlook on this number?
Nigel, I think we've already capitalized a joint venture with existing 4 hotels. The 5th hotel will get added to that, which is going to be the Westin in Bangalore. We are in discussions with GIC about some of the new opportunities where we had committed capital if they want to bring that into the JV. But otherwise, we're not in the process or planning to divest any of our existing operating hotels in favor of the joint venture at this point of time. So that's part 1. Part 2, in terms of net debt. Net debt is about 1,500 crores. We see that to remain stable. And I think we will meet our guidance of keeping the debt at around 3 times net debt to EBITDA. But in the medium term or the long term, bring it down to around 2.5 times. So we remain fairly comfortable on that spot as well.
Ashish, just, sorry, this is a little out of the left field in that sense, but, everything seems to be doing well. The commentary is great. The structural dynamics of the industry in terms of demand supply, all of that is working well. When will shareholders make money, Ashish? What should they watch out for, actually, is the question. I'm sorry, that's the wrong way to put it. But what are the milestones or inflection point where, for SAMI shareholders, this will, all this comes together? Because, your performance has been consistent, as you said.
Prashant, so I will talk as a shareholder, less as a CEO for this one question. I typically avoid that role in this company. I think we made some growth capital investments in the last 3 years. As I mentioned earlier to Nigel, next year we open the W in Hyderabad. And I think that's when the shareholders will start seeing a steady set of incremental non-same store growth coming to SAMI. So that cycle will start in FY28, will continue depending basis of current committed capital till FY31. So that's when I think the investors and the shareholders will be able to see that SAMI is going to go back to its pre-IPO or the long-term growth rates where our revenue grow in high teens. We've already made those investments. We already have that assets with us. It's just about bringing them online. So I think FY28, when W opens, and it's a substantial hotel that we open, then we have the Westin in Bangalore, we have the IKEA development in Noida, we have the Marriott in Sri Perumbudur, and then we have the big box in Navi Mumbai. So I think this company will deliver some incredible additions to its portfolio starting next year, which will be the inflection point, in our opinion, in terms of a different size of the growth that we will deliver.
FY28 is around the corner in that sense, but bulk of this is going to come towards the back end of 28 or?
No, I think H2 will be able to take benefit of that. Prashant, I'll be careful. You are ready with hotels in India and you still have problems getting operating approvals. So we are quite confident to deliver the product, but we want to be cautious, and that's why we're saying more towards H2. But I think that's the stronger part of the year. So on a full year basis, the impact could be pretty substantial.
Okay, we'll leave it there. Thank you very much, Ashish, and we look forward to it. Sorry again, it's an unusual question, but you were a sport enough to answer it. Thank you. That's SAMI Hotels with perspective on the Q1 numbers and what to watch out for, guys.
Okay, let's get in on the show. Mayuresh Joshi, Director Research, MarketSmith India. Mayuresh, morning. At your desk, what's the big stock that you all are talking about today? Which one should watch?
Morning, Iman. I think NBFCs have given a stellar show as far as Q1 is concerned, and across the broad universe as far as NBFC stocks are concerned, whether it's large caps like Bajaj Finance as an example, which gave a very decent set of numbers, and the reaction to that stock was equally stellar as well. Or to the second-tier names, including the likes of Credit Access or Chola Finance. I think NBFCs have probably stood out in this quarter. I think out of the large caps, Bajaj Finance is something that we keep on owning in our portfolios. I think the numbers were very decent. The management commentary was extremely strong and robust as well. And therefore, I think if one really believes the kind of AUM growth that can come through, along with the moderation in asset quality pressures that we've probably seen, and the digital initiatives that the company has probably taken, which obviously abets them in both aspects, in terms of garnering better growth, in terms of cross-selling, as well as operating efficiencies in terms of how EBIT or EBITDA margins can get reported. Out of the large cap leadership stocks, this is one stock that we continue liking and owning in our portfolio. In the mid-cap names, Chola Finance is something that we continue holding in our portfolios as well. A similar story. I think the AUM growth has been pretty decent, a 22% jump in the AUM growth that you probably see. What has been more stellar has been the NIM expansion that Chola has probably seen on a year-on-year basis, with NIMs expanding to 8.2%, which probably led to better ROAs and ROEs. In fact, ROAs jumped from 3.1% a year ago to almost 3.7%. And though asset quality probably stayed a little bit stable as we speak, both on a year-on-year and a quarter-on-quarter basis, the expectations in terms of vehicle finance and the positioning that Chola probably has, being one of their largest segments, I think that is expected to do well, as commercial and freight probably does well into the second half. The other segments that they're probably catering to also are probably showing a steady state growth. So to that extent, I think NBFCs is something that we're watching out for next week.
Get into a break, Mayuresh, so request you to stay on. We'll come back and continue chatting with you. We'll also talk about technicals. Sudarshan Sakhani and Mitesh Thakkar will join in. Stay tuned.
Okay, welcome back. I just want to quickly highlight two names which moved quite a bit, right? Pine Labs and Paytm were sharp moves. Of course, Paytm's got an, OFS today, so there will be that in play as well. But Pine Labs was up 9.5%, and I think Paytm went up quite sharply. Yesterday evening, that's Paytm, 5%. Yesterday evening, the Pine Labs CEO put out a post on X, and this is what it said, right? I just want to ask Mayuresh about this. He said, and I quote, Parliament moved an amendment to the Payment and Settlement Act, which is a step in the right direction towards implementing MDR in some shape or form without impacting customers, while allowing recovery of reasonable charges from merchants for higher value transactions that already attracts the charges on debit and credit cards. While this will undoubtedly bring about a debate, it is important to remember that both Brazil's PIX and China's real-time payment systems have always had merchant charges of 30 to 40 basis points, yet both have achieved over 90% penetration across users and merchants compared to roughly 35 to 40% in India, as per reports published by the RBI and NPCI. For us to get to 90% penetration, UPI Global, startups, fintechs and banks will need to fund this expansion through continued investments in it, innovation and cybersecurity. These costs have increased by almost 300% over the last 12 to 24 months. While there should be some recovery of these investments, P2P transactions, that is person-to-person transactions and charges to consumers, should continue to remain zero. Well, this is as clear an explanation as we've heard from a fintech founder with regards to the case for MDR. Mayuresh is with us. Mayuresh, I don't know if you looked at Pine Labs. Stock's not done anything since listing. Corrected after the recent results. We had them on the show, but yesterday was up 10. I mean, I think if you compare Paytm and Pine Labs, I mean, if MDR on high-value transactions were to come through, just in terms of the nature of transactions on both platforms, perhaps more beneficial for Pine Labs.
Sorry, Prashant. I think that seems to be the case. If MDR is implemented in some form, and therefore I think in terms of the transactional value, obviously I think if it is on a P2B, if it is not levied on a P2B or a customer basis as well, specifically on the retail side, obviously I think there is no expectation that the customer might get hit quite significantly. However, I think if MDR comes through, as the Pine Labs CEO has probably put through, and there has been a lot of debate on MDR, Prashant, over the last few quarters and last few months as well. But if this does come through at some level in the next few months, obviously I think the kind of penetration that these platform companies are probably looking about at this point of time, the expectations in terms of that MDR levy, specifically on high-value transactions, can actually have a significant impact in terms of how their cash flows will probably get positioned on a more durable and consistent basis going forward. So I think it seems to be seen how the government and the regulator probably implements this. But if it does go through, I think even Paytm will benefit to a certain extent. But yes, Pine Labs are tad bit more.
Hi, Mayuresh. Good to see you in. Mayuresh, what about the auto sales numbers? What do you make of it? And also, we had escorts that came in there, and they have actually sounded very optimistic about the path ahead. What do you like from that space?
Morning, Nigel. So again, I think within the OEMs, I think two-wheelers is something where our belief is that the numbers have been pretty consistent and stable as well. TVS Motors is something that we have kept on holding for a long periodicity of time. And therefore, I think our own sense is that the kind of numbers that TVS is probably posting at this point of time, the EV model that they have introduced and a couple of more models in the pipeline shall probably mean that as they gain traction in the non-South markets, as their dealer and distribution network probably increases, they're also probably looking at some components to come in from exports, where they're also probably putting in a lot of efforts to that extent. And the margins that they've probably posted, which was far better than what anybody expected on stage, if that consistent performance is expected to continue remaining so, my own sense is that two-wheelers might remain a very strong show as we speak. Within the four-wheelers, I think it has been a decent show so far. And therefore, I think our sense is that two-wheelers are a bit better placed. But for the space as a whole, I think auto ancillaries, as we've always pointed out, probably remain a very, very decent bet. I think the mix that they probably got in terms of not just servicing the OEM customers, but the replacement market and their foray into the EV space itself. I think the kind of technologies that they're probably developing, a large part of the auto Inc. universe, without creating a lot of leverage onto their balance sheet and disturbing their cash flows as we speak. My opinion and our sense in terms of how earnings are probably playing out, I think they are very strongly positioned to probably take advantage of both ecosystems and the transition thereof as we speak.
Got it. All right. Thanks a lot for that, Mayuresh. Wishing you a good day ahead, and we catch up soon. Let's get in our technical experts. We have Sudarshan as well as Mitesh who joins in today. Good morning, gentlemen. Good to see you. Mitesh, you go first. Yesterday we had a bit of a bump up because of that, first day of the closing session. That's why the Nifty suddenly spiked up 150, 200 points in the last minute. I mean, by the time we wound up between 3 o'clock to around 3:30 odd. What would you do today? We could start off a little bit softish because the cash rate could adjust towards the futures rate. Your take on the index first, and then we get to your calls.
So, good morning, Nigel. I think the most important thing which happened, because of the adjustment was that we had a closing above 24,600, which was an important pivot, a high made in April. And now that we are above that, I would believe that as long as the cash and the spot rates are about 24,600, there's a stronger chance of us heading towards 25,050 to about 25,100. And therefore, any 50, 60, 70 point kind of a decline, if it happens, I would want to use that as a buying opportunity.
Got it. You'll want to look at that in case of a dip as a buying opportunity. Got that. Sudarshan, what about you? As you mentioned yesterday as well, you have kept the faith all of last week. I think you were saying just stay long and ride it. Call now?
Well, you've already made the call for me. Thanks. Stay long and ride it. You must understand, Nigel, rather viewers should understand we are in an uptrend. Now, within this uptrend, there will be periods of consolidation of even intraday dips, even one-day dips. That's part of the process. But you should keep, as you said, keep the faith in the uptrend till we see signs of exhaustion. We have just begun. So stay long. If you don't have a long position or if you want to add to it, wait for dips. Don't chase any gaps. And yesterday's close, I prefer to ignore it completely. And I look at the 315 close, which was about 24,575. And if the market opens there, if it corrects from that level, then you buy. 780 to 575 is not a correction for me.
Got that. Sudarshan, morning. What stocks would you go with?
Yeah, good morning. Well, I'll go with Havells, buy with a stop under 1260. Pidilite Industries is a buy with a stop under 1610. Oberoi Realty is a buying opportunity with a stop under 1825. And JSW Steel is a buy with a stop under 1265. These are all 4 buy calls. But ideally for the Nifty, you must wait for dips to buy.
Okay. And Mitesh, your recommendations?
I have all buy calls as well. The first one is L&T. Keep the stop below 39.75 for targets in excess of 41.25. Yesterday we made a call on Hindalco. Today is National Aluminum. That's a buy with a stop at 361 and look for targets of 385. A buy on Force Motors, which is after a good correction, is showing first signs of reversal. So keep a stop below 18,100. Look for targets in vicinity of 19,400. And after a long time, in fact, it's a cash stock. ACC is making a triangular pattern. The breakout will happen above 1404, 1405. So buy about that. Keep the stop at 1384. Look for a first target of 1450.
Okay, well, gentlemen, thank you very much, both of you, for joining us. The Paytm block deal has gone through. 2.3% equity exchanged hands. Some 2,000 crores worth of block at about 1,368 rupees per share. So stocks, it's happened on the block window. We'll take a quick commercial break here. We'll come back with the management of KEI Industries on the other side. Stay tuned. Welcome back. We have the management of KEI Industries now joining us. So they reported a decent set in the first quarter, margin beat led by the cable and wire segment. The board has also approved capacity expansion of the manufacturing. To discuss this and more, we have Anil Gupta, CMD at KEI Industries, now joining us. Mr. Gupta, good morning. Great to have you, as always, here on CNBC TV 18, sir. So let's just start with what happened in the quarter. Revenue growth of 25% on the cable and wire side on a year-on-year basis. Does this mean that volumes actually fell? Can you start there, sir, on cable and wires?
In fact, we are not tracking volume. We are basically tracking the growth in terms of value. I'm not aware that, of course, a volume growth was marginal, but now we are ramping up our production in Sanand, and the volume growth will also be substantial as the production ramp up is coming up in the new facility because of the new capacity coming up on board. But with our efficiencies, we have been able to improve the EBITDA margins substantially compared to last year.
Are you saying you don't have the volume number, sir? You said it's marginal in the quarter.
No, I'm not saying no. There is a growth, but not to the extent what we expect, and the volumes will grow with the capacity now coming on board in our new facility, and the production is ramping up in the new facility.
Because sorry, I'm just sticking with volumes for a bit, because the volume growth has lagged some of your peers in this segment, Polycab and others. And not just now, but over the last 1 year, 1.5 years. So that's the reason why I'm kind of sort of emphasizing on that point. And I think you are saying that it's not kind of sort of met up to expectations, right? Could you give us a sense of why that has been the case?
I've been repeatedly saying that we were lacking capacities. And we have been able to commission our Sanand first phase in the end of December. But actually the production ramp up takes time, and as is the recruitment of manpower and stabilization of production, it is improving month after month, and you will see the quarter after quarter we will see a substantial growth in our revenues also from the overall business, and with the greater efficiencies, we have been able to improve the margins, and we will continue to do so.
So some numbers. So now on Sanand phase 1, as you said, it was commissioned in December. So the last quarter, Q4, had just a less than 100 crore contribution to your top line because the capacity was ramping up. In Q1, what was the contribution of Sanand? And do you maintain your FY27 volume guidance of 17 to 18% that you shared last time and a 20% top line growth?
See, as of now, I can think of that our overall revenue growth will be in excess of 25% for the full year. It will be substantially more, and the volume growth will be there. I'm not able to quantify exactly the volume growth at this moment because I don't have the numbers. But there will be a substantial improvement in the revenues and the volume growth in the coming quarters.
Growth guidance last quarter. So what makes you hesitant now to hold on to it or change it? Go ahead, sir. And the Sanand contribution in the current quarter, if you could highlight that. Give us that number.
It's close to around 200 CR. And in coming quarters, it will be far bigger. Okay. So due to that, the volume growth will be coming.
Sir, but just coming back, so 3 months back, you had the confidence to give a volume guidance of 17 to 18%. Are you now holding back because the numbers are tracking much lower?
I'm still saying that the volume growth will be substantial and the revenue growth will be in the excess of 25%. I'm not backing down from what I said, and we are sure to achieve the results.
All right. Hi, Mr. Gupta. Good to see you. And sir, the bright spot was on the margins. The cables and wires business, it looked very, very good. if you had to argue, the revenue growth in comparison to your peers may not be as much, but the margin expansion was more than any of your peers. What is the sustainable number we're looking on the margins for cables and wires?
Margins will be sustainable because of the greater efficiencies and the product mix. And as a guidance, I can say that we would try to achieve anywhere between 11 to 12%. Earlier, we were always giving guidance between 10.5 to 11%. Now I can say that we will be able to maintain it between 11 to 12%. And I mean, maybe that if the volume growth is from the new facilities comes up much bigger, then it may improve also.
6% in the past quarter. So when you talk about sustaining the level, you're saying it'll come back down to 11 to 12%. Is that correct? Because in the past quarter, it was close to around 13.6%. Only the cables and wires business.
I'm sure that it will be anywhere between 11 to 12% as a guidance, but it may be more. We can't give very optimistic guidances on the channels.
Okay, all right, that's fine. What about exports, sir? That came down, I think, to around 10% of the mix. Are you seeing signs that exports come back into its own? And for the year, what kind of a number are you looking at?
Our exports will be close to 16 to 18% of our total turnover this year. The first quarter numbers are less because our export to Middle East was impacted badly, and also exports to United States was also impacted due to tariffs. Now we have a very strong export order book and a very healthy book, and 16 to 18% export numbers will be there in the whole year.
Sir, you've spoken in the past about how data center is an opportunity in the US. Have you won any orders related to this?
Yes, we are executing many orders of data centers in US.
Okay. And the export pipeline, because last time you were hopeful that exports would hit 20% of your revenues. Now you're saying it should be 16 to 18% after a softish Q1. So what changed?
16 to 18% of the increased volumes, increased turnover. That is why, you see, I don't want to give very optimistic figures and then do less. We always try to say less and do better.
Okay. So, and phase 2 of Sanand, because that's where again more incremental capacity comes on, another earnings trigger. Is that on track to be commissioned by March 2027?
Yes, it is on track, and we expect it to commission by March 27.
Oh, and
March 27, correct.
And what will be the Sanand contribution in FY27? 100 crores in, I mean, it was about 200 crore in Q1. For the full year, what's your own expectation?
At the moment, I can't quite, but it is expected to be around anywhere around 3 to 4,000 crore in the full year.
Thanks very much for that. Najil, you want to take, sorry, take a question?
No, sir, you're saying 3 to 4,000 crore will be the Sanand contribution in FY27 or FY28 once phase 2 ramps up?
Expectedly, we expect around 3,000 crore in the full year.
This year?
FY27 from Sanand.
From Sanand, okay. And Q1 was only 200 crore, odd.
Yeah.
Right. Got that. Mr. Gupta, we'll leave it there, sir. Thank you very much for joining us. Great speaking with you. Good luck as you continue to execute. So volumes are what markets are going to watch. And look at the pre-open session, which just kicked off on KEI. Stocks up 5% as we speak. 52.65 is where KEI Industries is at this point in time. So it's actually
a revision in the margin guidance. So, you know, last quarter they had said the margin guidance is 10.5 to 11%. And now they're saying it should be 11 to 12%. So volumes maybe, you know, he's expecting a substantial pickup in volume. The margin guidance has been revised higher for KEI.
Yeah, I don't know how to look at that, right? Because for a company, for copper, cable and wire companies, it's just pass through.
It's just pass through, yeah.
So then, I mean, you know, I think the more important thing is volumes for a business like KEI or actually any of these other companies, Polycab, etc. But, and on volumes, I mean, Mr. Gupta, sounding confident, saying, well, I'm not backing off, but not providing a explicit numerical number in that sense. But, you know, that's KEI for you. Well, the pre-open has started, right? So the entire, will the the Nifty in the pre-open come off. It's not gap. I mean, is 60 points gapping down? Not really. But the point is that you've got a 2% lift from the Nasdaq last night. Now, the thing is, if the Nasdaq and US markets were absolutely flat last evening, then the Nifty in the pre-open should have gapped down 200 points. And then you would have said, well, the system is working, right? Not perfectly, but I mean, the pre-open adjusts the closing auction and we're even. But because overnight US markets have given us a 2% higher handover, you're not going to see a 200-point gap down. And why am I saying 200? Because between 315 yesterday and 330, there was a 200-point bump on the Nifty out of the blue. And even if you look at the Nifty and where the Sensex closed, there was a big difference, about 0.8% difference between the Nifty close and the Sensex close, right? So that is the point. So while the Nifty is adjusting lower, it's not going to go down all the way and flatline because you have a bit of a natural lift because of the strong US market session. Rajesh Baheti is with us. He was with us through in the last 40-45 minutes yesterday. Rajesh, first thoughts, what you're seeing out there. I mean, am I putting it correctly with the US market session and what the pre-open is doing? Go on.
This is actually not about what the US markets is doing. It's about what happened yesterday. And let's put it in perspective that the US market also follows a closing auction session. But there are remarkable differences in the way the US market operates and the Indian market operates. In the US markets, the exchange publishes the balance or imbalance of the buyers and sellers in the closing auction session. B, there are designated market makers across the index stocks and across the stocks. So these market makers are aware of the imbalance in the buyers and sellers, and they can step in because there is a very easy stock lending and borrowing mechanism. It doesn't have to work in the process that we work in. And three, you can arb at very low spreads and keep that market closing, resembling what was actually reflecting when the market was trading because there's no STT involved. In India, you don't have designated market makers. The big banks are not allowed to participate in the equity markets. You have STT, and the SLBM is a very, very onerous system. In the absence of all this, to expire the derivative contract on a closing auction system determined closing price, I think is a very, very dangerous game. Let me be upfront and say it is a very dangerous move as far as the F&O is concerned. If you want to keep this, you must expire the F&O at a different time based on the original half an hour weighted average closing prices or 1 hour weighted average if you want to make it even more difficult to move the markets.
Sorry, you said a lot of things. So you're saying that US also has a closing auction, but there are differences which makes it difficult for what happened yesterday to happen in the US. One of those is there is no STT, so arbitrageurs can step in, right, and arbit away, and that's the spread away. SLBM is very active. That is the other thing, right? Designated market makers. So these are all,
borrowing and lending can be done by brokers themselves. They don't have to go into an exchange-driven segment to borrow and lend shares.
Yeah. Just one thing, Rajesh. What is the recommendation you're saying that expire futures in a different way, at a different time?
If the whole idea of the CAS was to allow index funds to rebalance without incurring a lot of tracking error, then the F&O session can expire prior to the closing auction session based on the last half an hour or 45 minutes, whatever you might deem fit, prices, and let the F&O expire and let the official closing price not be the price at which the F&O expires. I mean, we had the currency expire at 12:30 or 12:15 p.m. based on the RBI spot rates at that time and nothing to do with what the markets were doing here. And secondly, even in the US, the quarterly options, the triple witching contract does not expire on the closing auction system determined prices. They expire on the next morning based on the opening rates. And in the US, the opening rates take close to about half an hour to be determined. And so in half an hour, it's difficult to fix the market.
So you're saying, so what you're saying is if this has to continue, then the F&O sessions should expire. I mean, theoretically, you're saying should happen at 3:15.
3:15, 3:30, and then you can have your closing auction and determine the official closing prices for the benefit of the index funds.
The point of allowing F&O after 3:30 to 3:40 is to be able to give option players, etc., a chance, right?
There is no chance because you could on a day like today, you could have an option that is 200 points out of the money. Theoretically, if you look at all the history, it would be only sellers at 5 paisa. And then you can wake up and have that option settle at 200, 250. You may get an opportunity, but you won't get an opportunity to at 5 paisa. So if you're a seller at 5 paisa, or if you want to do something, then it's at the determined price that comes as a shock to you. And B, what's going to happen is none of these options, based on what happened yesterday, are going to be at 5 paisa because you will have absurd prices. If you really want to square off your sales, you would have absurdly high prices in the options, given the fear that this is created.
Yeah. You know, the one point of view is this was day one. This was essentially about demand and supply. As that kind of picks up, this will settle down, right? That's the middle view a lot of people have, right? Do you agree with that? Or are you saying fundamentally the way it's designed is a problem?
I don't share that view. I think the lack of active market makers in India, the fact that there is STT, the fact that stock borrowing and lending is a very onerous exercise in India, makes the Indian market more prone to volatility in the closing auction session, which will not reflect the actual mood of the market. And if the idea is to have a closing price reflect the real mood of the market, then I'm afraid this is not going to work in India the way it works in the US. If you still want to do it, at least don't link the derivatives to this.
Yeah. You know, good quick chat. Thank you very much, Rajesh. Appreciate you joining us. And, you know, we've got let's see what happens today, right? Later in the afternoon. And would be great to have you back to walk us through what happens. Thank you. Well, I think we've got the 9:10, the pre-open, by the way, is ended. Let's just look at the Nifty, if we can. And in the pre-open, so we are down 70 points. 24,700 is where we are at, about a 0.25% lower. And we left off at, we left off at 24,550 yesterday at 315. So, you know, the pre-open, by the way, is indicating about a 150 odd point higher start compared to yesterday's pre-open, yesterday's 315 close. So that's the way to look at this. That's the way to look at this change that you're seeing. And look at the Sensex, obviously, right? I mean, 500 points higher because, and yeah, I mean, so the Nifty would be up 150 odd points. So this is the Nifty adjusting to that level, but, you know, just gets complicated because of the final close, which was ramped up. Well, Sudarshan is with us and Mitesh as well. Sudarshan, go on. Your trades, 9-10 trades.
It's Pidilite Industries, buy with a stop under 1610.
Yeah, and Mitesh?
I'll go with a buy on ACC for targets of around 1450.
Okay, thank you very much for that. We'll come back to you, gentlemen. LIC is a stock to watch, gravitating towards the base price for the offer for sale. 392 in pre-open, 8.5% lower. Vivek joins in with details of the offer for sale. Vivek?
Well, that's right. You know, along expected lines, a sharp gash seen across LIC given the very large equity offering that we're seeing at a discount that is significant to yesterday's closing price. Just to quickly go through the details of this particular large offer for sale, the government is looking to pair stake up to 6.5%. The base size of this particular OFS is at 2.5% of the total equity, with the government having an option of further upsizing this particular issue to an additional 4%. The total size, taking into account both the base as well as the offer for sale, works out to a little over 31,000 crore rupees. Now, this particular, the purpose of this particular OFS is to ensure that LIC goes ahead and meets SEBI's minimum public shareholding requirements. Remember, the government currently owns a 96.5% stake. Post this particular success successful closure of the OFS, it will come down to 90%, slightly ahead of what SEBI had asked the government to pare down its stake to. Now, going forward, one important aspect to watch out for as far as LIC is concerned is that, post the successful completion, given that there will be increased headroom for investors to enter, it can enter into the NSE passive indices as well as the MSCI index opportunity also opens up as far as the November review is concerned.
Thank you very much for that. LIC IPO was at 949, then it went through a bonus, so adjusted for that, it would be about 474. So even people who invested 4.5 years back in the IPO are still under the water.
Well, we'll see what happens, I think, in terms of demand, etc. So 24,700 on the Nifty Bank is, so basically, the change you're seeing is we are up. We are up from yesterday's close. We're down from yesterday's 330 close, but from the actual 315 close, we are up about 70 points on the Nifty. Yeah. So that's the thing, right? Look at the Sensex now. The Sensex is a strange situation. Can we have the Nifty and the Sensex up in one window, please? Because, when do we see this, right? But we're seeing this because the CAS system. Look at the Nifty, look at the Sensex together. Nifty is down 0.7. But we're up 50 points. The Sensex is up 0.25%, and obviously, that is the actual change because, there you go. Look at that. And that is because there was that 200-point ramp up which happened in the auction session yesterday on the Nifty, and nothing on the Sensex, which was fine in that sense. So one down 170, one up 140. And that's the reason why I was referring to the change from 315 on the Nifty. Okay, just a quick look at the heat map, and then we'll get into individual stocks, single stocks, and the change there. Just focus on the value, not the change on the Nifty. The heat map should come up on your screen. Yeah, Adani Enterprises, Sports, these are the top two gainers. Trent, Bajaj Finance, Tech Mahindra, and Hindalco are the other gainers as well. On the other side, there's Grasim, Titan, Bajaj, and HDFC Life, which are the top losers coming through. Rima.
Well, banks are showing you a big gash because that's where that spurt along with the Nifty took place in the last minutes. So you had names like an ICICI Bank, HDFC Bank, Reliance Industries shooting up, and now you are seeing a retreat in those prices. Grasim is weak in trade. Bajaj Auto is down 2%. Titan ahead of numbers later this week is under pressure. SBI Life, Tata Consumer, HUL, couple of IT names are under pressure. TCS also down in excess of 1%. Adani Group stocks right on top, and some buying visible in Tech Mahindra, Trent. Bharti Airtel reports numbers later today along with ONGC, so keep that on your watch list.
Well, that's right, Rima. Quite a few stocks moving around, in today's trading session. So let's get a few of them up for you on the screen. You have Ganesha Ecosphere. There's a big move out there. So that stock, in fact, is flying away. It's up close to around 4.5%. That recycler, it's already rallied close to 25% in the last few trading sessions, and it opens gap up. EBITDA number at around 60 crores. That's the best, I think, that they've ever reported. I think on one exchange, it's showing at around 1,200 rupees thereabouts. Stovecraft, the stock has come off the top. It started off close to around 6% higher, but that's now up only around 2.5%. So some bit of selling out there. You have Gandhar Oil. Well, good amount of buying being seen on that one as well. It's been, fairly volatile. So that stock comes up for you on the screen. Thangamayil Jewelry continues its downtick. That's down close to around 5%. Net, the big divergence on the Sensex as well as the Nifty, that's catching your attention as we speak.
Look at Ather, right? Actually, pretty bullish call yesterday as well in terms of demand, really bursting at the seams. They're expanding capacity and a lot more. So that is Ather for you. 300,000 shares traded on that one, 1381. So that's a change which is coming through at this point in time. KEI is up about 5.25%, 5.33% as well, 52.92. Remember, KEI will hold its investor call in the next couple of hours, but you heard from the management here at 9 o'clock. Well,
just one more stock, Godfrey Phillips. I'm looking at an article in today's papers. Godfrey Phillips in focus because there is an article that says that Samir Modi says he's withdrawn all legal cases against Mother. That's stock that's been buzzing. Even yesterday, I think it was up, but that was, I think, the read-through with regard to ITC. Today, it's seen some more buying because probably the street is taking note of that.
Yep. Well, that's Godfrey, right? And, Godfrey's volume, business-wise, volume decline was pretty sharp. ITC is not so much. But Godfrey reported earlier, ITC only recently. And IDC was one of the movers yesterday as well. Tahir Badshaw is with us, CIO, Invesco Mutual Fund. Tahir, good morning. Good to have you with us here. Thanks very much for joining us. So I just had sorry, not a market question, but I don't know if you've thought about this. Because of this new system of closing, Tahir, from a mutual fund perspective, I mean, if you got a sale order from an investor, right? They got great prices. I mean, if towards the end, right? But maybe not real prices. Any thoughts? Have you thought about it internally? Because this affects mutual funds as well.
Yes, it does, I think, to some extent, but we've honestly have not really given it a thought. So to profess any kind of comments, but I would just like to think that, yeah, I mean, this may not necessarily occur repeatedly every day is probably my guess. This is something which will probably settle down over a period of time. So once in a while, yeah, I mean, it happened yesterday. I have absolutely no.
Got it. No, we will not.
On this matter, to be honest, and don't really care, at least as far as mutual funds are concerned, given that we don't have those shorter time horizon in order to.
It's not about what you will, but point is that if you.
Yeah, I mean, we are happy to take advantage of some opportunities like this if at all they come our way. So once in a while.
The NAVs, my only point is the NAVs can go a little haywire, right, in terms of what is reported on a daily basis.
Yes,
anyway,
absolutely.
Yeah.
I think the regulators will probably look at this a little more keenly after it is in motion.
So what is what's the view on the market, Tahir? I mean, earnings is in full flow. Some 10 F&O companies reporting earnings today. I mean, a huge list from last night, yesterday. What's the verdict so far? More than halfway done.
Yeah, I think in a way, Prashant, I think all what is happening over the last 3-4 months has probably been in line with our expectations. We had called out that this year probably we will see mean reversion as far as India's performance is concerned, both from a earnings standpoint as well as from a hopefully a market standpoint as well. And I think we are probably trending in the right direction. We've seen quarter on quarter build up, at least as far as earnings acceleration is concerned from the December quarter onwards. So some of those things are trending out pretty nicely, so that cyclical recovery that we have been kind of expecting as far as Indian markets, Indian economy is concerned is probably coming through, notwithstanding some of the challenges. But there are a few opportunities and challenges also which will confront us as we go along. So it's hard to at this stage still say whether we are in a full-fledged structural recovery that we can probably think about over the next 3 years or beyond. But we'll take it as it comes. At least for now, things are trending in the right direction, whether it be in terms of earnings flows, attention towards India, some of the laggard sectors actually starting to catch up, market becoming somewhat more broad-based than what it was probably earlier. So all in all, directionally, we are happy to with the trend.
Got that. Tahir, hi. So do you want to tell us how you're constructing your portfolio right now? Any changes, any new ideas, or any trends that you've spotted in the earnings season which changes your view, your narrative?
So basically, I think the market is still, or rather, the economy is still, is quite concentrated at this stage. I mean, we are seeing continuity of action in a few of the areas that we've been seeing earlier as well. Autos, for example, is one of them where the full benefit of whatever happened last year in terms of tax cuts, etc., is continuing to hold. Not much is can be said. The same can not probably be said about some of the other parts of the consumption sector, although things are incrementally getting better. We've looked at some of the retail, businesses as well within consumption. Those have also held up pretty well. I think what is also kind of going against the narrative of the market is the impact which will probably be there on costs and margins given the cost escalation, particularly commodities in the last 3-4 months. I think that has not come through. Unfortunately, in the meanwhile, commodity prices have kind of softened. So I think that changes the narrative for the next couple of quarters as well. There is clearly some acceleration in top line too, compared to what it was in the last few quarters. So I think all in all, it is more of the same at one level. Some other parts of the market have started to join in. For example, tech has been, as you know, has been a decent performer. I think that too is partly driven by numbers and more so by narrative as well. I believe the narrative is starting to change in favor of Indian IT. So last 3 months we've seen the tech sector actually do pretty well compared to the rest of the market. So I think those are the incremental stuff that is looking interesting, and we're focused on that.
Okay. Yesterday we were, chatting with one of our experts, and he was quite bullish on the entire home improvement scheme, the sector, whether it's tiles, ceramics, etc. Do you have a view on that?
Well, I mean, we have some more position, some larger positioning, I would say, towards the real estate stocks as well, not as much of the derivatives. So I think we've seen a couple of companies do well in that regard, and that probably can make a comeback too, given that at least primary sales as far as real estate is concerned is continues to trend well, at least in certain portions of the market. Segments, and I think that should eventually lead to, as you're saying, stronger performance for some of the second derivatives as well, as far as real estate, housing, etc. is concerned, or home improvement related products. So I think that is something which has probably not been very strong up until now. It starts to kind of probably show up as we speak. I think in there probably it is also the benefit of costs, which hopefully should make a difference as we go along. So I think that is an area which can look potentially promising.
Hi Tahir, good to see you, and feeling good about the markets after a while actually. It seems the pieces are coming together. But wanted to ask you about this fresh supply of paper. A lot of large trades, the government as well has come in there to sell some, stake in LIC. How big a problem is it? Till now we've been boasting about good domestic retail flows, retail audience as well as held on to their own. How big a risk is it?
I think it is, at least from a timing perspective, it is quite rightly timed in the sense that it is coming at a time when foreign flows are at the margin somewhat getting better. I mean, I'm not saying that the selling intensity is stopped, but it is significantly abated compared to what it was in the last some time. In fact, probably we have had some good days as well as far as flows are concerned. So I think it should hopefully be manageable. India appetite is probably back gradually, so that should also help. And I think we've been seeing, while I understand where you're coming from, there are some of these large issues lined up in the today, tomorrow types. But in general, we've seen that appetite with regard to IPOs, etc., continues to be reasonably strong, given at least domestic flows continue to be pretty robust month on month, quarter by quarter. So I think it should probably not be a very significant problem.
Yeah. By the way, do you have Ather in your funds? Tahir?
We were among the original, IPO investors as well, and we anchored them at one point in time. So
I hope you have a lot, because it's just I think let's just put the stock up. It's up, I think 15%, 16%, and just amazing commentary in terms of demand and bookings and registrations and inquiries, etc., right? Tahir, how are valuations looking though? I mean, if your analysts have looked at this one. I mean, what is it now factoring in? I think they have about, 17% share as far as EVs go. But, I mean, if you look at the market cap, it's now sort of, accounting for some percentage share of the overall two-wheeler market, not just EVs as a share of, assumes EVs will become a much larger share of overall two-wheelers, but then, and Ather having a much larger share in that. Just valuation side.
I think we've seen that in a good number of companies without commenting on individual stocks, while this is one of our larger holdings that we've known today. But I think you always get into those situations where stocks do materially beyond what is probably immediately visible, and I think at certain prices, especially when the company is executing well, doing the right things, I think if you end up even buying at probably somewhat inflated valuations, you just need to make your time horizon relatively adjust to that, in order to make sure that you still don't go below water. But I mean, we've come a long way in terms of some of these kind of companies which have done exceedingly well. They have kind of being supported by the tailwind in demand as well, due to various factors. And to that extent, it is one of those, we do tend to be careful at very extended valuations at various points in time in different kinds of stocks, especially in the longer, in the shorter journey. But I think so long as execution is in place and things are moving in the right direction and it is in line with our investment thesis, I think we are happy to continue holding, even in situations where near-term valuations become a little more indigestible.
Very strong commentary. Just 1 month back, the company had done a QIP, raised money from Hero MotoCorp at 1,202. This was about a month and a half back, and now the stock is at 1450. And yesterday, the company says inquiries for Ather have gone up 95%. Pre-orders at 150,000, pre-monthly orders on a month-on-month basis at 50,000, and the company sees an unrealized retail potential of 13 to 15,000 units per month, and the dealer inventory has come down from 14 days in the prior month to just 3 days in Q1, and they're saying that sometimes dealers can't accept orders because the waiting periods have gone up too much. So that's Ather Energy for you. We'll get chatting with the management soon.
Absolutely, and I think just expanding capacity to catch up with demand, meeting demand, an enviable position now in the electric vehicle space. Because the other one, of course, where there were a lot of hopes and aspirations, Ola, right? I mean, that of course has gone nowhere. There are, of course, larger incumbents. Bajaj has been doing phenomenally well. TVS and others as well. But I mean, as a pure play electric vehicle, I think there is Ather, which is the one player that I think is doing exceptionally well. At scale, that is. Now, SBI Funds Management has reported its first ever quarterly result post its listing, which was fairly recently. It, of course, continues to be the market leader by the sheer size of its assets under management. Let's get straight to Mr. Debashish Mishra, MD and CEO at SBI Funds Management. We have Mr. DP Singh, Joint CEO at SBI Funds Management, and Mr. R.S. Srinivas, who's also with us. He's Executive Vice President and Chief of Strategy, Digital and Technology at the company. All three of you, Mr. Jain, Mr. Singh, and Mr. Mishra, great to have all of you with us on the program today. Mr. Mishra, if I can start with you, sir. Give us the one thing which many are pointing out: top line growth, revenue growth is strong, quite strong, but at the net level, things are a little slower. I mean, it's not, it's not as strong. It looks like it's moderated. I mean, the rate of growth. Could you give us a sense of what happened in the quarter, Mr. Mishra?
See, good morning to all. In fact, the quarter has been very well for me. If you look at the top line growth and the QAAUM, which in market measures, is 12.6 trillion, which is roughly 11-12% higher than last year's quarter. And our operating income, what you say top line or bottom line, operating income has gone up by 17%. So both ways, the QAAUM and operating income levels, we are very, very happy that the quarter has given very well results. There has been some mark-to-market adjustments. That's why maybe the net result has been coming a little lower. But then that is something which comes up every quarter. And every quarter to quarter we can improving. You look at the QOQ improvement in net profit is 37% higher than last quarter, sequential. So market movements and some of our readjustment portfolio is something which bottom line is looking at. But then these are very small fundamentals. The fundamental look at it, our spread, our reach, and as you mentioned before, our distribution network. Look at the SIP. The SIP has been a success story for us, and in last quarter, we added 16 lakh new SIPs to our portfolio. And we are one of the leaders with 2.06 trillion SIP AUM base. So these are constant steady flow of growth to our books. And the SIP flow, although it is equally flat compared to March and June, but it has not come down. It's 4,000 crores per month is coming up to our SIP books. So all over, new customer addition, the QAM movement, the operating income, everything has been showing very nice results, and we are very happy that this quarter, having such a volatility and geopolitical issues, we could give best results to the market.
Mr. Mishra, what were yields, sir, for the quarter? What were they at? And if you can maybe break it up across asset classes.
Yeah, so Srini can take that.
Yeah, happy to do that. Good morning, Prashant. Good morning, everyone. On the yield side, I think it's been a very interesting quarter for us. In fact, our yields have not just stabilized at an operating yield level. We've actually increased it by about 2 basis points. So in a way, what we were talking that our asset mix quality moving up in the last few years from more active assets coming into the play, our weighted average yields have been actually moving up quarter over quarter, year over year. So that's actually reflected in the last quarter growths too. Overall, one other important part was the regulatory action that happened in terms of from 1st of April onwards, the telescopic pricing and the impact on that. That also we have been fairly able to manage that cost very well with optimization of our expenses and of course distribution fee. To both this extent, we've done a fairly good job of containing the cost, and at the same time, we've been able to expand our revenue pool too.
Good to see yields go up by nearly 2 basis points on a quarter-on-quarter basis. Mr. Singh, the other strong story in the performance this time has been alternatives and PMS. Now, those assets went up from 5,300 crore to 6,800 crore, a jump of 29%. And you've always said that this is a high growth engine for the company. Now, currently, it's about 8% of your revenue. Say in the next 3 years, what's going to be the strategy to grow this? And what is the AUM or revenue contribution you would like alternatives and PMS to have?
Yeah, actually, if you look at the alternate growth, which has happened at about 29%, but on a very small base, we would like to see these percentages go very, very high. That is number one. But we don't want to do it just for the heck of it. But we are very, very investor-centric people. Till the time we have got new ideas and new pipelines, we will not collect the money and we will not do that. But we'll do it in a very, very calibrated manner so that we are able to create value for the investor. But the idea is this 29%, of course, on the top line looks very good. But we are very aware in a 13 lakh crore company, this number in absolute terms is very low, but we have to make it very, very big. And for that, we have already created a team who will be going out in the market, creating a pipeline. Till the time we don't have good ideas and good pipeline, we will not be in a hurry to do it. But at the same time, we will like to see this balance sheet to go manifold in multiples rather than in percentage growth. That is the idea and that is the aspiration.
Of course. Mr. Jain, you want to add to this? What should be the AUM scale we can expect from alternatives and PMS in the next, say, 3 years or 5 years?
I think while we are not speculating on where it should be or give guidance on it, the best way to look about it is this. Our ambition is to be one of the largest players in that segment. And in the next 3 to 5 years, by 2030, we have a plan to make it the largest asset manager, at least the listed asset managers, to be in the largest category of assets under management when it comes to AIF. And we're working towards it too. Just to complement from what my colleague DP Singh said, it's not just about raising money, it's also about building capability and building distribution pipeline. And that's something that we've been investing now, creating a dedicated business unit, creating a dedicated team of professionals, and of course, new asset classes covered in AIF. So, this is stepping, year after year, we will start showing progress on this. And our goal is that at least by 2030, to be one of the largest asset managers in the alternative space also, like we are now doing in the traditional asset space.
Mr. Jain, just some nitty-gritties. Your market share slipped. Maybe we're looking at quarter on quarter, there will be movement, but 15.1 versus 15.3. So your quarterly AUM growth was about 11%. So did the industry grow faster? If yes, what was the industry growth rate at, and what should we expect market share?
I think that we are reading too much into a quarter-on-quarter kind of a data, and there have been many quarters where these things have, things happen. We are a very large institution. Today we're at 29 lakh crores overall, and especially in mutual funds around, 13 lakh crores plus assets, there will be a mark-to-market impact that happens in the portfolio. On the net new money levels, we've been continuously growing. Like Mr. Mishra said, we've added a significant, pool to both our SIP base, new customer base. But I think reading it between a quarter to quarter may be too it's probably not the way to think about it. Our ambition is to continue to maintain our leadership in mutual funds, and we're doing everything to do that, including democratization of savings, of bringing more and more new investors to the kitty. So I think maybe the better way to look at it is to take a longer term perspective about our market share.
Got that. Just one question, and this is a slightly broader question. Mr. Srinivas, about performance, right? Because, I mean, at the end of the day, if there's performance, money will come. There is the tailwind of distribution and the SBI base, and we talked about at the time of the IPO. But at the end of the day, investors will give you more money if the performance is top tier. What are the linkage? I mean, one way. Some argue that once, especially a SIP kind of product, right? I mean, once it's there, and people don't track it so closely. I mean, just your thoughts around it, Mr. Srinivas.
No, but at the core of it, performance matters, because whether it's a new investor or existing investor want value for their investments that have invested with us. But at the same point of time, people do take a longer term call. And we've seen some anecdotally, if a SIP survives beyond a couple of years, at least 18 months plus kind of a scenario, people will tend to kind of ignore short term aberrations in performance. So we've seen anecdotally and with data to prove that customers are long-term oriented. But the core of it is for us as asset managers to deliver on our value or deliver on our performance. So we continue to focus on that. In fact, last quarter has seen some progress on our growth further, right? We continue to do well at an aggregate level when it comes to fund performance. So, I mean, we are not shying away by saying performance is not important. It's very important to what we do. But we also know the franchisee, the kind of investors who come to us are very long-term in nature. And those investors tend to bet not with short-term volatility of performance, but for long-term what we have. Secondly, we also run a very hybrid plus kind of an approach as a fund house. So it's not a pure equity only that we need to look at. We run the largest fund of ours is a hybrid fund, equity hybrid fund. So we continue to, for those kind of customers, it's not just pure performance. It's also, defensive play that they have when markets are volatile. So you got to take it all together when you think about it as a collective way to think about how whether performance attributions come when it comes to AUM growth.
Mr. Singh,
Prashant, I'd add one more point to Srini, if you can add further. Look at the customer base. We have now 1.82 crore customers, which has grown up 12% YOY. And live folios are 2.2 crores, again 14% YOY. So customer addition has been very good in the last quarter compared to the previous quarter of the last year. And also, one point which Srini also mentioned, our cost to income is the best in the industry, 17.5%. So we are actually working efficiently to give more margin, to generate more profits for the investors.
Got it.
I just want to add the data to support Srini's point.
Absolutely, and helpful. Mr. Singh, just to, as we wrap up, the IPO had such huge demand, right? I mean, we discussed around the time of the IPO, the anchor book and the just absolutely great demand. Have you been a little disappointed with the listing itself, Mr. Singh? I know it's maybe a bit unfair question. You're looking at the business, not maybe running the, what happens in, stocks is another matter. But any thoughts on, because the price is around what the IPO price was?
Not really. Actually, see what happens, we don't look at the price. People have come in, people have put in money, looking at the business franchise and looking at the long term, what is the destiny for this company. We are the leaders by far, and we are likely to continue to be leader by far for all the times to come. That confidence we definitely have. Because we are market makers, we are not only market sharers. That is what we are saying. And second, what Srini also talked about, we are really concerned about the new investors bringing into the market. We bring them through hybrid route, we bring them through our proprietary channel, we bring them through our other partners. And we are very conscious of the interest of the investor. The share price will definitely, we are very confident that they will be buying, there will be other things, people will look at it. but we are not really bothered about how it happens day-to-day basis.
Yeah. No, I'm just saying that on that moment on the listing, because there was so much demand and the grey premium, etc., was so high, it all there was a bit of a mystery in that sense. Mr. Singh, at the time of the IPO, I asked you whether you'll be able to do 5,000 crores in profits in FY28. You said, well, maybe a little less, but now that you're listed and you can talk about specific numbers, you did 3,000 crores last year.
No, you have to understand one thing. With the kind of strong base which we have, it's more of the market movement rather than the flows. I mean, when I look at the flows number in the industry and the mark-to-market in the industry, forget about our own company, the contribution of flows is only 15%, 80-85% is the mark-to-market movement in the last 6 months. Right? In such a scenario, the profitability and revenue will always depend upon how the India growth story plays out, how people are confident, how the domestic flows continue, because we can work on the flows. But the mark-to-market is something which is very important, and we are very sure that this will continue. And God willing, if the markets continue to remain what it is for the last 4 months, 5,000 crore definitely is doable. But the function of mark-to-market is extremely important in the market. And we have a very strong base of 600,000 crore of equity-oriented assets which are growing at 10-12%. So that will definitely give us a boost to the revenue.
Thank you very much, all three of you, Mr. Singh, Mr. Mishra, and Mr. Srinivas. Mr. Jain, thank you very much for joining us. It's a pleasure, and the first interaction post-listing as far as the quarterly numbers is concerned. All the best. We'll take a break. We are back. The management of Ather Energy on the other side on Q1 numbers. Stay tuned.
Welcome back. Ather Energy is clearly the stock of the day, firing on all cylinders after reporting a good set of Q1 numbers. The company's revenue growth remains strong, and even the non-auto revenues were very healthy. Tarun Mehta, co-founder, CEO of Ather Energy, is now here with us on the show. Tarun, thank you very much for joining in. This is Rima here. Your first EBITDA positive in the quarter at 9.5 crore. And even the numbers, what you indicated about the EV demand for Ather, inquiries up 95%. Ather received 150,000 pre-orders in Q1. That's a jump of 158%. We'll discuss the demand, but first on the EBITDA turning positive. And this is despite absorbing commodity inflation. What can you guide on EBITDA going forward for Q2, Q3, Q4? For the full year, what should we expect?
Thanks, Rima. No, I think Q1 was a very interesting quarter. We had been guiding for a couple of quarters that commodities will be inflationary in the near term, which is what we saw in Q1. In fact, the commodity hit was probably a bit higher than we even anticipated. What we did, however, every crisis is an opportunity, and which is what we were able to do. In anticipation of this, we were able to push our teams, we were able to push pricing up, we were able to drive a better skew in the shop floors. And end result, our overall margins were not impacted as much as we anticipated. So that definitely helped. As you also said at the start, non-vehicle revenues compounded really well, particularly software, AtherStack Pro, which has helped our non-vehicle revenues to climb to 14% already. That finally paired with a very disciplined execution on the fixed costs. All of that put together led us to a positive EBITDA for the first time. My guidance is what I said on the call yesterday. I think there are still going to be a few ups and downs over the next few quarters, but the trajectory does look better. Particularly the price hikes that we were able to draw and the skew management we were able to drive in, that should stay long term. So even as commodities do cool down, and they will cool down to some degree in the coming quarters, this upside should stay. So I think long-term margins have now moved north of 25%.
Okay, so your adjusted gross margin should stay above 25% on a structural basis. I think that's the guidance that you're sharing?
Yes. But just like Q1, there will be still commodity that we will continue to absorb for a couple of quarters at least.
And when you do get this entry-level launch, which marks your first entry into this 1 to 1.25 lakh segment, because historically you've been much higher. So Ritza starts at 1.2 plus, or even your 450 series is higher priced at 1.35 lakh. So once you get this, your average selling price also comes down. Will that have a bearing on margins? And you will launch it, I think, on 29th of August. That's the launch date for the EL platform. What is your own expectations of the kind of volumes you will enjoy in the first year after that?
Yeah, thanks, Rima. So, our first product, Ather 450, played in the 1.5 lakh rupee plus price point for the most part, which is where it has a very strong dominating presence. Our second product, Rista, plays in the 1.25 to 1.5 lakh rupee segment, where we have become again very large today. Our third product, which we are launching on 29th August at Ather Community Day, we expect it'll play across price points, but we expect it to particularly drive volumes in the 1 to 1.25 lakh rupee segment, which is the largest segment in the industry, a segment that Ather has not yet made a presence in. And with that, we expect our market shares to start tilting upwards once again. We're building new capacity for it, 42,000 units a month in Aurangabad, Chhatrapati Sambhajinagar. We are also outlaying another 18,000 a month out of our current capacity. So our net peak capacity of 60,000 a month, we are earmarking for this new product, which is codenamed EL right now. We'll be revealing the name shortly tomorrow. How do I expect it to play on ASPs and margins? Obviously, since it'll play in slightly lower price segments also, we expect ASPs to soften a bit in a year's time, not immediately. But on margin perspective, we don't think there will be any impact on margins even in the midterm, primarily because we built the platform fundamentally grounds up to make sure that this product is able to enter a lower price segment without any impact on margins. In fact, on a percentage basis, we expect margins should start inching upwards in a matter of a few quarters, because structurally, this is a materially better cost structure for us.
All right. Hi, Tarun. Good morning. Good to see you. First of all, congratulations on the way you've scaled up business. I recall speaking to you at the IPO time and you said you're confident about the way ahead and you've delivered so far. Let me get a couple of factors out of the way first. Ather Stack, that's the optional software that you'll have. Could you tell us, out of the total number of sales that you do, how many of the customers take this? And if you could give us a brief idea, I think it is between 10 to 20,000 rupees. You could correct me on that number. Just give us some more details, because people look at it more than just a two-wheeler or more than just an EV two-wheeler because of Ather Stack and the other facilities that you're offering as well. Please go ahead.
Thanks, Nigel. So a few years ago, we started experimenting with the idea of taking all our software features, because Ather was building a lot of them, from Google Maps to connectivity to safety features like Track My Scooter, etc. And we started bundling them in this package called Ather Stack Pro, which is what we sell separately. So it's not bundled along with the vehicle. So we don't have to force people to take software along with the vehicle if they just want a simple plain vanilla scooter. They can choose to buy the software pack on top of it. We had to come up with this because there was a lot of crisis of margins at one point many years ago, particularly with subsidies scaling down. I think to date, this has been one of our best experiments that we've pulled off. Today, an average product, the lowest cost software pack that goes is priced at about 14,000 rupees. The highest is priced at about 24,000 rupees. On a blend, we would be at about 19,000 rupees, customer facing post GST price point. And what's been really surprising, however, is not just the price point. What's been really surprising is the attach rates. Particularly as we started scaling Rista in Western and Northern markets, we expected attach rates to drop below somewhere around 60-70%. But very happy to report it's inched up. And last quarter, we clocked 94% attach rate, which means of every 100 customers who buy our scooters, 94 of them today buy the Ather Stack Pro. And this is now with Ather being present in about 300 or 400 cities, 700 plus experience, multiple price points, so on and forth.
Right. Tarun, that's encouraging, because as your vehicle is selling at a premium in comparison to your peers, and then they don't mind to pay a little bit more and take the software. Got that. Just a couple of quick questions before we let you go. One, if you could tell us, your market share has slipped, but it's not a demand problem. It's a supply problem, which you're going to be sorting out in the next few months or so as capacities come on stream. So what is the targeted market share you're looking at? Point number one. And EBITDA positive, when do you get PAT positive? Just two questions.
So, no, you're right. Market share will slip because market share is not currently a function of demand. It's not being driven by customer demand at all. It's being mathematically driven by how much capacity we have because we have maxed out as we speak today. Q1, we had already hit 31,000 a month out of a current peak capacity of 35,000 a month. And entering Q2, we are already now nearing 100%. And in fact, we are trying to breach 100% also. So, but the market's growing much faster, which is what we have indicated in our results. Quarterly demand last quarter also was more than 1.5 lakh units, while we could only sell 90,000 units. In fact, we believe that underlying demand is even higher than 1.5 lakh units because in many states, dealers are no longer even punching or accepting new orders because the waiting times are exceeding 2 months. So this is obviously a very bullish outlook, which is why our focus is not market share because temporarily we can't do anything about it. Our focus is on ramping up capacity. By Diwali, we are expecting our new plant in Chhatrapati Sambhajinagar to go online. And in Q4, we are expecting daily production output out of it. By end of Q4 or early Q1, it would have ramped up to its full max capacity of 42,000 a month, which will take our total net capacity to 77,000 units, which should hopefully give us enough headroom to supply the market its this pent-up demand. So market shares will catch up in about 3 to 4 quarters. Before this demand surge happened, we were already comfortably getting to 19-20% market shares. We still have hundreds of stores to add, and we have our new product EL going live in a few weeks. So we believe a rightful market share should be north of 20%, probably north of 25%. But it will take us a few quarters with new capacity to get to that market share.
Tarun, hi, morning. A few questions more. Sorry, so just to pick up on the 25% market share, so you get to 25, that is assuming EVs, what is the share of EVs overall in the scooter market?
I meant 25% within electric two-wheelers, not the large. So yeah.
I see. So
that's hard to say where e-two-wheelers land up. We've had a phenomenal run in the last few months as an industry. We've gone from 5-6% penetration in two-wheelers to 11% penetration in two-wheelers. And not just us, I do believe that our entire industry is now supply constrained. Actual underlying demand is materially higher than 11%.
Right. So on that point, right, I think I heard a part of the call yesterday. So Hosur is, you said, I recall a number of 14 lakh units total. So Aurangabad phase 1, there's phase 2 also, right, which has not been, you've not broken ground or anything, which you're going to do. So give us a sense of this 14 by when are we looking at that?
Right. So our current facility in Hosur is capable of 4.2 lakh units, which is what we've now finally gotten to. Our new facility in Aurangabad has 2 phases, phase 1 and phase 2. Phase 1 is incremental 5 lakh units per annum, which is what we had raised money during the IPO for. And that's going live in a few months later this year. With that going live, we'll have total 9.2 lakh units per month total capacity. Phase 2, we had already secured the land and we've already built some common facilities. So if demand does continue to surge up, we will have the option of quickly ramping into phase 2 and taking a total capacity to 14.2 lakh units. So 4.2 lakh units, 5 lakh units, and then incremental 5 lakh units, total 14.2 lakhs. We haven't taken a call on phase 2 of Aurangabad yet. But if demand does stay on this trajectory over the next 2-3 quarters, then very likely we'll trigger that.
And so if say, let's assume for now that demand does stay on track, what is the time, what are we looking at by when, you think?
So it should be a little faster than setting up phase 1. Setting up phase 1 has taken us roughly about 5.5 quarters. Phase 2 should take less than 4 quarters, maybe in the 3 to 4 quarters report.
This is, so basically, you said phase 1 is Q1 of next year.
Yes.
FY28 and 4 quarters from there, basically.
That's a good timeline if we do trigger phase 2 literally over the next few months.
And for that, will you need to raise more money, Tarun?
No, we do not expect so. Part of the reason we are just wrapping up a 2,500 crore fundraise. We closed 1,300 crore QIP a few days ago, and we are in the midst of closing another 1,200 crores preference issue right now as we speak. So this 2,500 crores was for these possible upsides where we may have to fast track more capacity, where we may have to fast track newer products because the market is expanding very fast. So if we do have to do phase two, we do not believe that we'll have to raise more equity capital.
Got that. And so by the end of FY27, your commission capacity will be 9.2 lakh units. What will be peak revenues then? Assuming you, at that point, assuming 100% utilization?
Now that's hard to say and would be a very aggressive number for me to guide right now. Our average revenue per vehicle is somewhere in the vicinity of about 1.4, 1.5 lakh rupees. We believe that with EL, it should moderate down by maybe 2,000 to 3,000 rupees, but broadly in this same zip code. So yeah, fingers crossed that we are able to use the entire 9 lakh units capacity literally in a year from now. If that happens, I think there's a material upside available on top line. But I don't want to put out a number because I think it's still early.
Got that. Thank you very much, Tarun. Appreciate you joining us. Good speaking with you, and all the best as you continue to execute. That's the stock of the day. Jindal Stainless management is with us. Najil, take us through.
Oh, that's right. Let's get straight to Jindal Stainless. We have Tarun Khulbe, the CEO and whole-time director of the company, who joins us on the show. Hi, Mr. Khulbe. It was a good performance in a challenging quarter. Your EBITDA per ton went up on a sequential basis, which is good. And the debt came down on a sequential basis, which is good as well. Normally, we ask you for two top numbers, so let's get straight to that. What's the volume growth you're estimating for the year? I think earlier you were talking about 7 to around 9%. Do you stick to that? And EBITDA per ton, you've been talking about that 19 to 20,000 rupees per ton. You have done close to 23,000 rupees per ton in the past quarter. You want to revise it higher?
Okay, Nigel. So, yes, this was a challenging quarter, like we had stated in our last conversation. But as a company, because we have our own strength that due to our presence into across the sectors, across the series, across the various grades, we are able to, play with these things. And looking at the situation when we realized that post this Gulf War, the fuel was becoming a challenge, particularly LPG and propane. So, and we had to take a hit on our volumes in this quarter. So we decided that, okay, let us focus on the value products. And that's what has helped us in getting the better EBITDA per ton, what you see. Beyond this, of course, as a company, we also constantly focus on improving our operational efficiencies and working into producing the more value-added product. So that is the reason. But in the market, the uncertainty remains constantly, Middle East also. So rather than reacting as on a knee-jerk basis, whatever guidance we had provided earlier was for H1. So I think let us wait till H1 and then we will come back with the revised guidance on our EBITDA per ton and also on the volume.
But you're being very conservative, sir. If you did 23,000 in quarter one, quarter two, you'll have to do 17,000 to come to around that 20,000 per ton mark. So I think, in all probability, mathematically, you should be higher than the 90 to 20,000 rupees that you're talking about. But for the timing, you want to stick at around 20,000 rupees, right? For first half.
Yeah, I mean, okay, I'm not revising it, but mathematically what you are saying is true. The direction is similar, but as I said that there is so much of uncertainty in this global market as of now. So that is why we don't want to react as a knee, we don't want to give a knee-jerk reaction kind of things. And
so volume also you're sticking to 7 to 9% because first quarter there's a degrowth because of the challenges you're talking about.
Yes, absolutely. The first quarter, because the challenges, what I said, the fuel and the logistic disruptions and all that, which, impacted our volume because we had to cut down on our production because of those challenges. So, but then, okay, we had, in the meantime, we took our steps, we reduced our dependence on the fuels like LPG and propane. We worked on piped natural gas, which was more easily available, even into our Odisha plants where it was not in use before. And all that has helped us now in easing out the challenge of the fuel. But as I said, now though we see the situation improving, but any revision we will provide you after H1.
So we're taking at 7 to 9% for the year as of now. Propane and LPG shortage was something that hurt you all in the past couple of quarters, Things have improved, right?
Yes, they have improved because we have reduced our dependence also on these fuel. It was not only the availability of these fuels, also the prices had also gone up tremendously, particularly in the initial phase of the Hormuz problem.
Got it. All right. And exports have perked up a little bit, on a lower base, but as a percentage has gone to around 11%. Earlier, I think you were guiding that exports will be 8 to 10% for the year. You stick to that, or you think that it can be actually in low teens?
So Nigel, as we always say that export for us is an important market, but at the same time we are quite focused on the domestic market. And export, we have many customers of very long-term relationship, which we continue to serve despite the various challenges what we face. But here, in terms of percentage, you see it on the higher side. One of the major reasons being the denominator also has been lower. So while in terms of numbers, I will say the export numbers are very similar to the previous quarters, but percentage you are seeing them higher because of the lower denominator.
All right. And as you said earlier, the debt number comes down to around 2,800 crores by the end of this year, and you made a move in that direction as well. So we got that on board as well. Finally, sir, before we let you go, tell us about that protection from the government of India. The Ferris space has got it, but you all as well have made some kind of a bid to the government that why don't you all put in some protection to save the industry from imports. Where is that at, if you could help us out?
So I will say, I will take it on 2 points, Nigel, not only the ADD part. ADD is, of course, one which we have already given the application to the government on which the work is going on. In fact, 9th of September, a public hearing has been scheduled by the DGTR, and we hope by the end of the September, the DGTR, we are hoping, should come out with its recommendation. But there is another aspect that is on the QCO, which Government of India suspended on the stainless steel products. There also, we believe that the move has its own problem because QCO suspension means we are just letting the BIS standards which are applicable on the products go. And that is not a very good situation on one hand. Because a lot of the stainless steel goes into the hollowware and kitchenware segments, which is directly related to the public health. Yes. And also, this allows the cheap substandard material coming from China, which impacts the MSME producers of stainless steel, where already the capacity utilization being very low. So we believe that on this aspect also, we are requesting and telling government that they should act on this also. Yes. Because in the longer term, this will have its own harm on the industry.
So quality controls is what you're pitching for, as well as some protection from the imports that are coming in there. Hopefully that comes about in your favor. But congratulations on a fairly good set of numbers. In a difficult quarter, we'll hold you to this guidance of around 90 to 20,000 rupees per ton for the first half of the year and volume growth of around 7 to around 9%. Thanks a lot, Mr. Kolbe, for speaking to us here on CNBC TV 18. Well, time to slip into a short break. On the other side, we have the management of CAMS that's waiting for us. Stay tuned.
Welcome back. CAMS reported a muted set of first quarter numbers. Other income boosted profits after tax. Non-MF business didn't inspire too much confidence as well. CAMS pay was perhaps the single largest positive in the quarter. We have Anuj Kumar, MD and CEO at the company, joining in to take some questions. Mr. Kumar, good to have you with us here. Good morning, Prashant this side. I think we've seen a bit of a yield compression in the quarter gone by, sir. Can you quantify that and tell us the reasons behind it?
Hey, good morning, Prashant. Thanks for having me on the show. Overall, I would say it was a solid quarter. If you see general numbers, non-MF revenue, which we've stated will grow by over 20%, grew almost 28%. Yield has actually been stable over the last 3 quarters. So whatever pricing compression we had taken in FY25, end of 25, has stabilized now. So yield compression is minimal. It's just contingent on the telescopic rates that we have in the business. So there is no event to report there. We also expect pricing will kind of remain the way it is for the next 3 to 4 quarters, will remain stable. And right with that, PAT grew 17%, EBITDA grew about 18%, and the growth drivers are in place. So I would rate it as a solid quarter.
So the mutual fund yields, the number I have came off about 3% or so on a year-on-year basis, Q1 over same quarter last year. Is that correct?
That's correct. So take it as just a normal base compression, just like mutual fund TERs compress as they scale, the scheme scale. We scale on more or less similar principles. So mutual fund yield scale, they come down by about 2.5 to 3% in a year.
So let me flip that question, Mr. Kumar. In FY26, there was a much larger compression which happened. So this is actually a smaller compression. Is our yields now starting to stabilize? Is that the way to look at this?
That's correct. That's absolutely correct. There was a single large client price adjustment last year in FY26. We've come out of that. So you would have seen that yield compression is about 2.5 to 3%, which is what we normally guide as a principle. You will continue seeing that for the rest of the year.
Mr. Kumar, your non-mutual fund business was supposed to de-risk the mutual fund business and provide that growth acceleration. But other than CAMS Pay, where we've seen a 14% quarter-on-quarter jump, the other businesses, whether it's KRA, REP, they've all fallen 18-20% on a quarter-on-quarter basis. What happened here, and what should we expect on the non-MF side growth for the full year?
Well, I would say take a look at the year-to-year numbers. On a year-to-year basis, pay grew significantly. Alternatives grew about 26-27%. KRA, where we've actually taken a price compression across the industry, the price compression is of the order of about 28-29%. In the face of that, year-on-year revenue fell about 3%. So we made up the balance. Also remember that this was a tough quarter in general. When you compare it with the fourth quarter, Jan and Feb were normal months. March was a month when there was global uncertainty. This entire quarter did suffer the uncertainty. We are coming out of that. I think you will see on a Q-on-Q basis a far more stable set of numbers in the quarter. If you do a year-on-year comparison, the first quarter looks pretty solid.
Okay. And non-mutual fund revenue growth will sustain 20% plus for the full year. And what was the growth in Q1?
Q1 year-on-year, non-MF grew almost 28%, and we are guiding that it will be over 20% for the entire year. That's the way the non-MF portfolio will grow.
And as a share, it'll be, what will it be for the full year of the total?
It's just kind of crossed 15%. We expect it to end the year between 16 and 17. 17 best case and 16 about base case.
Got it. For the full year, Mr. Puri, just to wrap this up, Mr. Kumar, what should we expect in terms of as far as growth is concerned overall for CAMS?
Overall enterprise level, I would say revenue should grow about 13% on a base of about 1430 crore that we had last year. EBITDA should certainly grow in excess of 15%, should grow about 16%. So 13% revenue growth, about 16% EBITDA growth is what you can expect for the full year FY27.
Got that. Mr. Kumar, thank you very much, sir. Short conversation, but very useful to get that context for the quarter and how you're thinking about the year ahead. Thank you. Okay, well, that is CAMS for you. We'll take a quick commercial break here. We'll come back and we will talk about what's happening in the economy. It's been, one corporate after another. over the last 2 hours. You'll hear from Chandresh Jain from BNP Paribas and Suyash Chaudhary of Bandhan Asset Management. Lata is going to be discussing the economy, rupee rates and more. I mean, the latest with regards to these FCNR flows as well, the update we have from the Reserve Bank of India. Stay tuned, coming up.
Welcome to It's the Economy. The Reserve Bank policies tomorrow widely expected to maintain status quo on interest rates. But the market is actually divided deeply on whether there will be a rate hike in the second half of the year. So that's what the market will watch out for, perhaps. Separately, on the rupee, the Reserve Bank's announcement that $40.8 billion have flowed in via FCNR deposits and other schemes by 31st July, that is in just 7 weeks, did not fire up the rupee as much as dealers expected. So what's the future course of the rupee, and what will FX dealers want to hear from the Reserve Bank's press conference and statement? To answer all these, I have with me Chandresh Jain, the FX strategist from BNP Paribas, and Suyash Chaudhary, the CIO Fixed Income at Bandhan AMC. Gentlemen, good morning. Thank you very much for joining us. Chandresh, the first, besides the policy, before the policy, this $40.8 billion was a very good number, we thought, in 7 weeks and 8 more weeks to go. But it didn't really fire up the rupee. What do you think is happening?
I think the 40 billion number is very good, but most of it has come in the last couple of weeks. And that's when we have started seeing some rupee appreciation happening in the last 10 days or so. So initially, when the rollout of the scheme happened, the inflow was a bit slow, but at the same time, oil prices were still very high. So rupee could not really rally a lot. And then when the numbers started pouring in on the inflow side, the oil once again went to $100, which caused the problem. Now, in the last 10 days, when oil has started to come down and these flows have started to pick up again, now we are seeing some kind of appreciation in the rupee. Our expectation is that we will reach closer to $70 billion number with these flows. And that will be decent enough for the second half balance of payment picture, which can push dollar INR closer to 94, 94.5 kind of a range.
Okay, so when do you expect this 94? Will it be September end, or do you think earlier?
Yeah, I think should be towards September end, because that's when the FCNR scheme will end and most of the flow will come in by that time. Also remember, when we go into the October, November, that's the festival season in India, the imports again increase that time. So all the appreciation which has to come, it has to come by September in our opinion.
Okay. Suyash, now for the more important event up ahead, what will you watch out for? Will they increase the growth forecast, reduce the inflation forecast? Exactly where will your gaze be transfixed?
Lata, we don't expect too many changes to their macro forecasts yet. There is a chance that eventually there is some revision downwards to inflation and some revision upwards to growth, but that's a nudge, pretty much not here nor there. One hopes that RBI and MPC are not seriously contemplating a change in stance prior to rate hikes, because a stance actually has a very important signaling effect. And if their view is similar to what ours is, that this cycle may not need more than 50 odd basis points of rate hikes eventually, then I would say there is absolutely no need to change stance while executing those rate hikes, which we don't think will happen before October. So one also, will see that there is no change in stance, or the risk thereof is what one will monitor. There is also, chances that further capital augmentation measures eventually get rolled out, because remember, although the FCNR flow is large, and for the time being it does shield the external account, it's not permanent, and therefore, this has to eventually give way to more permanent measures as well. Finally, and I'm not sure this is an agenda for tomorrow, but I think there is a good case to continue to review the average duration profile of issuances, especially for the central government borrowing, because state government borrowings are, done more autonomously, but the RBI has a good say as far as central government borrowings are concerned. If you note, the long end of the yield curve is completely unanchored from the repo rate.
Yeah.
The government of India borrows long end where pretty much people can get home loans at. So there is a disconnect. There's probably still too much duration supply to the marketplace, and eventually, and especially with the Bloomberg index inclusion not happening for the time being, and a reasonable accretion to deposit base for banks, where natural buying will be in the 3 to 5 year sector, one will also eventually look for some transmutation of the maturity borrowing profile of Government of India.
Yeah, I agree with you that we are not going to get anything about the duration, or how much 10, 15 year borrowings will happen by the government tomorrow. But the market is deeply divided in terms of the expectation of a hike or two in the second half. The poll that Ritu did was actually 60-40 divide, with 60 expecting a hike, 40 not expecting a hike. So will the Reserve Bank indicate its mind that I am in this camp or that? Do you expect them to say that in some fashion, that they see a hike?
No, I would say they will continue with the commentary that they are watching for second round effects. There is some recent de-escalation to the geopolitical pressures as well.
Yeah.
And the reason the governor talks about core inflation ex valuables in our view is to indicate the state of demand side pressures in the economy. And, if the demand side pressures indicate that, core inflation is unlikely to go beyond 4 on a meaningful basis, then the total scope of rate hikes is limited. And therefore, RBI and MPC don't need to reveal their hand upfront today or tomorrow, when the total quantum of rate hikes expected is quite modest. I think the larger issue is about transmission, which I alluded to in my previous answer, and that needs to gain more focus from RBI in our view.
Okay. Chandresh, before I come to what you're waiting for from the policy, Suyesh referred to the Bloomberg deferring the inclusion. Now, on the one hand, this inclusion still looks imminent, and on the other hand, equity FPIs have clearly stopped selling. July was the first month when we had a net inflow of $1.5 billion. I mean, a paltry amount, but still, it was not minus 16 billion and minus 20 billion. This combined likely debt flows because of an eventual Bloomberg inclusion, plus the turn in the tide of FPI equity thinking, is not that likely to put a floor to the rupee. Chandresh.
Sorry, if you can repeat that one.
No, I just thought that equity and debt inflows. What are your views, and will that change your view on the rupee?
I think the debt inflows is pretty good. I mean, we have got about $8 billion of inflow in the last 1 month. And I agree with Suyash, we are not expecting much hiking cycle from RBI. So those bond inflows should continue. Equity side also, the negative momentum that we had and the outflows that we had, that has completely stopped now. I think people are much more comfortable with rupee, with RBI hiking cycle and so on. And that's why it has started, the inflows have actually started coming in the equity side as well, which essentially means the same thing, which I was explaining on the INR. It's a positive thing, and INR should appreciate on the basis of that. I think one thing to watch out in this RBI meeting would be market is not expecting any further measures on the FX right now because they have done enough on the FCNR and ECB. What would be interesting is if RBI can announce something more, something extra, which the market is not expecting. Something like if they can extend the time duration of these FCNR and ECB flows by another 3 months so that more people get time to invest in that. I think if that happens, I think we can probably see more appreciation of the currency.
No, there is a expectation that comes up every now and then that the importer-exporter behavior is not changing. Importers are still hedging hugely, some 60-70%. So if there is a CRR requirement on every importer hedge, that might make hedging expensive. There are views like this. Do you think some such a proposal is what you have in mind?
No, I don't think that's going to happen right now.
Okay. Yeah, I know it's a little of a tall ask, but there are these views because hedging behavior is the one that is the problem and not really flows at this point in time. Flows are decent. Suyash, what is your expectation in terms of the yield itself? Is it more or less likely to be here, the 10-year, 6.8, 6.85?
For the time being, probably yes, Lata. What we are also watching for is the probable continued unwind of the global AI trade. Remember, one of the big pressures to global interest rates and to the lack of capital flow to India has been this AI trade, which is had both a financial market aspect as well as a capex aspect, especially for countries like the US, which have both absorbed global capital and put upward pressure on interest rates. Now, if the stagnation of the AI trade were to continue, then that probably would lead to some resumption of capital flow here and some pressure coming off from global interest rates as well. And that should start to rub off in India as well. But like I said before, I think there is a clear case now for government to relook at the duration profile of issuances so as to better anchor the yield curve to the repo rate.
Okay. Just a final quick question to you, Chandresh. You may be speaking to foreign investors who invest globally. Where is India in the pecking order in terms of equity and debt? Does it come up in conversations, or are your investors still Taiwan, Korea fixated?
I think a lot has changed as well in the last few weeks because we have seen Kospi dropping by a significant amount and have seen deleveraging happening there. So it helped Indian equities to some extent, but I think India is still, quite down the line in terms of the pecking order on the equity side of things. On the debt side, it still stands out quite well because if you look at in Asia as a whole, there are not many high yielders here. We have Indonesia, we have Philippines, we have India. Indonesia is going through another tough cycle where the currency is depreciating a lot. So India stands out on the debt side, at least from an Asia perspective. So that's what we are hearing.
Okay, so more for debt and equity, still work needs to be done. Thank you very much, Chandresh and Suyash, for kind of preparing us for the rupee market and for what to expect from the Reserve Bank. At the moment, most of the markets have given away the gains they made yesterday. Equity markets down about 0.8% on most of the key indexes, and the rupee is very, very static. It is 95.3 for the last 3 or 4 trading days. Nothing much happening over there. But let's see what the second half holds. Wrap up on Bazaar Chartbusters after the break.
Jio Industries surges to about 7.5% in gains today after a strong first quarter performance. EBITDA jumps nearly 60%, richer product mix lifts margins by 240 basis points. The MD, Anil Gupta, tells CNBC TV18 they expect 11 to 12% margin, which is up from their earlier 10.5 to 11% guidance.
The centre launches an offer sale in India's insurance behemoth LIC to dilute 6.5% stake. The floor price for the OFS is fixed at around 382 rupees. That's 11% discount to yesterday's close price. The stock is under pressure.
UPS June quarter disappoints. EBITDA grows just 9%, well below the company's guidance of 14 to 18%. Though forex gains lift profit by 50%, management bets on a stronger second quarter led by robust crop protection volumes, steady seeds growth and a sharp scale-up in specialty chemicals.
Aether rallies following a strong showing in the first quarter. The adjusted EBITDA turns positive and losses shrink to 51 crores. That compares with around 178 crores same time last year. The company logs a solid 89% growth in revenues. The company issues ambitious guidance. The company tells CNBC TV18 that they expect the long-term adjusted gross margins to be upwards of 25%.
Earnings-led sentiment on Restaurant Brands Asia, the company that owns Burger King India, delivers record quarterly revenue and EBITDA. The India business outperforms with over 12.5% same-store sales growth, which is a 15-quarter high. Hello and welcome. You're watching us here on Chartbusters. We come to you live from the CNBC TV18 Motilal Oswal studio. I'm Mangala Malu. With me, Nigel D'Souza. The market flat on the Sensex front as compared to yesterday's close. The Nifty lower by 190 points, but remember, you have to adjust it for the CAS close in yesterday's session as well, which took the market closer to that 24,775 mark. The broader markets, however, sitting with a cut of almost 100 points. Important numbers to track, and we have Century Plyboards, which reported its highest ever quarterly revenue in the first quarter, strong growth across their key segments, and sharp improvement in their profitability as well. Keshav Bhajanka, the Executive Director, Century Plyboards, now joins in to discuss the strong first quarter performance, but more importantly, the outlook for the next year as well. Thanks a lot, Keshav, for joining in. We've been speaking over the last many quarters where you said FY27, FY28 will be years of strong growth for the company given the capex that you've done. But, you know, I just wanted to understand a little before we get to the volume and revenue growth guidance for this year. On your MDF business, you had earlier guided for 15% plus EBITDA margins. First quarter margins are just 7%. This is obviously due to the planned shutdown. Once this shutdown lifts, when do you expect these margins to come back to this 15 to 16%, if not the earlier highs of over 30%?
Good morning. Thank you so much for having me on the show. I think, you have summed it up very well, that this year and the next financial year, we intend to sweat the assets that we have created over the course of the past 3 to 4 years. And I think they are going to be very strong growth and profitable growth years for us. In MDF, like you have correctly pointed out, Q1 saw two disruptions. Firstly, we have expanded our capacity in our Andhra Pradesh plant. We have done a brownfield expansion of close to 25% of capacity at negligible capex or practically no capex. So that has been something that took some time. It took over a month and the plant was shut down during that time period, causing certain losses, like you have rightly said. Alongside that, the West Asia crisis, that also led to a lot of volatility in terms of raw material prices. And it was not one-way volatility. Prices went up, came down, went up, came down. So because of that, passing on to the market or holding on those increases in prices that were passed on to the market became slightly difficult. Having said that, I think this is going to be 1 quarter of stabilization of the new capacity. And post this, H2 onwards, you shall see 15% plus EBITDA margins in MDF.
All right, H2 onwards, 15%. The next quarter will also see similar numbers, right?
So H2, current quarter, I think will take a little bit of time to stabilize the expanded capacity. H2 onwards, yes, 15% plus EBITDA margins in MDF.
Got that. And what about plywood? You've typically guided for mid-teen sort of growth, but this time around, business continues to outperform over 30%. What's a revised target and sustainable growth path here?
Well, due to the West Asia crisis, we are not giving any targets for the current year. But like you rightly pointed out, growth has been stronger than what we had anticipated. And our new capacity, our new plant in Hoshiarpur will become effective from October onwards. I think we'll start commercial production in October. So that will again aid to our growth. So I'm sure you will see a strong growth year for us in FY27.
You define strong. I mean, I understand that you're not giving any guidance, etc. But if you could give a range, and we're not going to hold you to that. We all understand that we're going through uncertain, volatile times. But maybe a range
It will
for
be
perhaps.
higher.
Okay.
It will be higher than what we had guided for earlier.
Okay, we'll take that.
All right, hi Keshav. Let's talk about a smaller part of your business then, the particle boards business. The growth is good out there. You have mentioned in the past you want to go to mid-teens in terms of margins. However, it's still loss-making. Tell us, how does this business evolve, and by when do you get to those ambitious margins?
I think this is the first year of full operation, and within the first quarter, we are at 3% EBITDA margin. Now, I know it's not a very high margin as of now, but going forward, I believe that as we scale up, and we have shown quarter after quarter that our throughput has increased, our turnover has increased. So towards the second half of the year, particularly in Q4, I'm fairly confident that we'll have double-digit margins. And next year onwards, we should be able to reach a 15% plus EBITDA margin.
All right, 15% plus EBITDA margin next year, Q4 10%. The first quarter you did 3%. Obviously, the reported numbers EBIT are a loss. You'll have to add back depreciation and amortization to that. On your laminates business, even as the reported numbers show growth, at least the 15% revenue growth that you've done, I reckon most of that is overpriced because volumes are still lower by about 8.5%. You've done a lot of strategic changes out there. When does that business turn around, especially on the volume front?
The way that we look at volumes needs to change in laminates slightly. We have been accounting for it in terms of number of sheets, because that is predominantly our business, or what used to be. It used to be the thin HPL, which was 8x4, and typically in a size of 1 millimeter. Now, going forward, a lot of our business is transitioning to large size compact laminates, which are actually 12 boards, which are 14 by 6 feet in size. So the actual representation in terms of numbers might not be doing fair justice to it, because that product in itself is equivalent to a far larger share. So one board of 14 by 6, 12 in terms of realization would be more than 20 times one board of 1 8x4. So I think that we'll need to make an adjustment for. But otherwise, there has been volume growth across the key segments. Product mix has changed. It has moved towards the higher end products. And we are going to see this trajectory taking shape going forward as well. I'm fairly confident that in laminates, you will see robust growth from this year onwards.
All right, Keshav, quick couple of questions. With regard to input costs, timber prices are more or less stable. But chemicals was a bit of a spoiler because those costs went up. How have prices behaved now if I compare quarter 2 so far in comparison to quarter 1?
I think that, it is a very volatile scenario. So in between, we thought that the worst was behind us. And then suddenly there was another spike because suddenly there was the start of the war again. So it is unpredictable. However, we have the ability to pass on the increase in cost to the market in the form of price increases. And it's not just us, the entire industry has to do the same. So I think that, short term, there could be a little more pain. I mean, I'm not particularly, economist or a war strategist, so I don't know how this is going to pan out. But I think volatility is here to stay until and unless this war is resolved.
All right, we take that point. You're not an economist or a war strategist, neither are we. We're just, hazarding our best understanding of the situation right now. For us, it's easier because we have to ask the questions. You have to deliver to your shareholders and to your customers as well. So, let's wrap it up finally with whatever range you can give us for this year when it comes to revenue and margins. And more importantly, from a analyst standpoint, people would like to understand your goal on return on capital employed and cash flow from ops as well, because the first quarter working capital was slightly elevated. But we are seeing improved ROCE as you're sweating your assets. But you've, again, embarked upon another round of CapEx. So what's your ROCE sustainable level here? And whatever guidance you can give for this year.
Right now, we have not actually embarked on any large round of capex. So I just want to bring a little bit of correction there, because it is a plywood facility in Hoshiarpur and maybe one more plywood facility coming up. Plywood facilities, as you know, are not very capex intensive.
Yeah.
200, 250 crores, you can come up with a state-of-the-art plywood plant as opposed to an MDF or particle board where the outlay would be 600 crores plus. Having said that, you're absolutely right. This year we are going to sweat our assets more. Our ROCs are going to improve quarter on quarter. And that is something that we are very confident on. With regards to the growth guidance, I think we will grow similar to last year or perhaps slightly better than last year. And margins, of course, the objective will be to improve margins quarter after quarter.
All right, take that point. Last year, for viewers' reference, you did about 19% revenue, 33% EBITDA jump, margins at 12%. Net profit obviously grew at around 44%. You are likely to better your growth in FY27 over FY26, at least on a value growth. So we'll expect over 20% growth out there. And margins, you expect improvement quarter after quarter. So we will obviously monitor that. Thank you so much for joining in. The street likes that. We've seen a bit of a spike as we speak, largely on account of your plywood volumes. You believe that it'll be a lot better than what you did last year. And second half of this year is when MDF margins will get back to that 15% mark as well. Take a short break, come back. The management of Stovecraft is waiting by to discuss their first quarter performance. Welcome back. Well, let's focus on Stovecraft. They delivered a very strong set of numbers with the record revenue number on a quarterly run rate coming in at around 480 crore rupees or thereabouts. So what's the outlook from here on? Was this a flash in the pan or is it sustainable? Well, we're now joined by Mr. Rajendra Gandhi, the Managing Director of Stovecraft. Hi, Mr. Gandhi. Good morning. Good to see you. Well, the last time we chatted, you were talking about 15% growth for the year. But in the first quarter, you've delivered a 40% growth, which has outbeat your peers as well. What's the outlook for the year? Do you want to up that guidance of 15% that you were mentioning last time around? And also tell us about margins. You know, periodically your margins get very volatile. It goes down to 8%, then it goes to 12% odd. But as operating leverage picks up, do you think this 11% margin is sustainable?
Yeah, good morning. Thank you for all those special questions. Of course, this has been a good quarter. Very good quarter, and we are seeing strong traction in the market continuing. While we are very confident of crossing that 15% growth this year, and since both the operational leverage and the financial leverages are setting, now we can definitely be in the range of 11% and grow from here on the margins.
Okay, margins at 11%. But what about revenue growth? Should it be closer to 20% instead of 15% or 25%?
We are definitely confident of growing more than 15%. So it does not limit us with the growth, but definitely 15% and above growth is assured.
Okay, give us a couple of more details then. Walmart and IKEA, how much will it contribute as a percentage of your revenues? And also exports, I think you were guiding that low teens is what you were looking at, right? In terms of a contribution. You stick to that?
We will, yeah, but we continue to grow on the export business while even the first quarter we have grown. And as IKEA revenues also start contributing, we believe we will move from this 12% to 15% before the end of next year.
Exports.
The contribution of export revenue coming to our revenue.
An absolute revenue of this IKEA and Walmart, will it be 30, 40 crores for this year?
No, it's much larger, much larger.
How much?
The export business is likely to be in the range of 200 crores this year.
That's export. But IKEA, you had said that it will be about 50 crores in FY27 and then within 3 years will scale all the way up to 250 crores,
Yeah,
right?
the IKEA revenue could be in that range. The export business is a combination of other customers also. So all put together, we believe that we'll be able to get to 15% before end of next year.
Got that. I'll just press you a little more on the revenue growth. You said it'll obviously be more than 15%. 41% is what you've done in the first quarter. Second quarter, even if you discount that entirely, the second half of this year is typically where you see the festive season coming in, the wedding season, and with the kind of traction that we've seen in induction cooktops, even though post-war they fizzled out a little bit, it is sustained at an elevated level. So it is only fair to assume that you would do over 20-25% in revenue this year, right? Are you being conservative?
No, it's not about being conservative. We're very positive on the growth side. There is a very good demand kind of traction in the market, both induction, the cooking appliances, the pressure cookers, we are seeing very high growth. With this growth, we are very confident of a very good growth. But what I want to reiterate is that we will be definitely more higher of the 15% growth on revenue.
All right.
So it is not limiting the growth to 15%.
No, I understand that completely. We just wanted a bigger number from you, which is more realistic than just higher than 15%. Take that point. But, you did say that you will, consider a buyback at the end of FY27. Where do you stand on that right now?
No, we have not announced any buyback.
No, not announced. You said you will consider.
We'll definitely explore it, and based on the feedback that we would get from our investors, then we will come back on that. But there is no buyback plans at the moment.
Okay. All right. Mr. Gandhi, if I just jog my memory back to the last interaction that we had, you were telling us about, we were quizzing you that depreciation is a large line item, and that's why your profit number looks very small. PAT margin, that is what I'm talking about. Last year, you did around 40 crores on around 1,600 crores of revenues. So it's just around 2.5%. And you had said that PAT margin will move to 7 to 8% in the next 2 years. So mathematically, if I put it in, say you grow at this pace, you'll do around 2,300 crores or thereabouts in the next 2 years. And the margin is around 7%, PAT margin, then your net profit number should move from around 40 crores to around 140 crores. Would that be a fair estimate?
Yeah, we are on the trajectory.
So you're guiding that FY28, the net profit number goes to 140 crores. That's at 7% margin.
I want to repeat that we are on the trajectory. The financial leverage is set in. The depreciation numbers remains where they are. And with increased revenue growth and our thrust on improving our margins, we are on the trajectory and the likely numbers that you have indicated.
Right. Ahead of the festive season, I think you seem to have stocked up a little on inventory as well, because we've seen net working capital days increase from 23 days to 45 days. Is that just strategic ahead of the festive season, or is that the new normal? Just wanted to understand that. And
we believe that we should be prepared for the festive season. The second and third quarter are larger quarters. We, being a manufacturing company, are also limited by the capacity that we have. So we are at the moment experiencing good growth, and we have stocked up enough of inventory for during the first quarter. And that's why you would have seen an increase in the number of days. But this will all stabilize over the period of the whole year. It gets streamlined, and it will be at the same level at where we were when we started.
20-25 days is a sustainable level here.
Yeah.
All right. And just a word on margins. You said 11% this year, but as we progress, as operating leverage kicks in, as your product mix evolves towards higher margin products, do you expect the margins to go somewhere in low teens over the next 2 to 3 years?
So, of course, we are not limiting the margins to 11%. With the financial leverage and the operational leverage set in now, you will see improvement from here. We are confident of being at that at least 11% and above. So we are not limiting it to 11%. We are confident of a better margin as we grow from here.
All right. And final question, I'm looking at it, the ex-TTK Prestige MD, Mr. Carlo, has come on your books. Are you looking at further professionalizing the management? Because there has been a lot of change at the top, which the street gets a little bit jittery about.
So you have bought this ex-TTK Prestige MD on board. Are you looking at further such changes to make the core of the business, the leadership, very, very strong?
Yeah, Chandru is a great guy. He has had probably the highest number of years spent in this industry as a professional. He is on top of the whole industry, both business and product side. We are very excited having him on board. We have also, it's a continuous endeavor to bring the best of professionals on board. Maybe there have been some times where there was a churn, but then our endeavor has always been to professionalize the company, and this will continue. We will continue to look for more and better professionals to add to the value. Add value to the company.
Okay, Mr. Gandhi, look to bring them on board is good, but they need to stay on board as well, because that churn at the top is something that makes people a little bit nervous. But
yeah, sometimes there is a chemistry that needs to match, and then we would like to have people who are more aligned with our thoughts. And then, but with Chandu, we are very excited having him. It's a short time that he has spent here, but he comes with a lot of energy, experience, and all the positives for the company.
All right, we take that point. May the chemistry lead to a lot more, growth going ahead for you and your team members. And, analysts will also keep an eye out on how the employee expenses behave once you keep getting more and more professionals. But that conversation for another day. You sound extremely optimistic about this year. We'll wish you good luck for all of FY27 and perhaps keep an eye out on the buyback that you're considering by the end of this year as well. Thank you, Mr. Gandhi, for joining.
Thank you, Mangla. Thank you.
With that, we take a short break, come back, get you more of the markets and a lot of stock-specific action. Welcome back. Even though at a reported level, the Nifty is down 200 points, the broader markets are fairly excited. We have a bunch of stocks. Berger Paints reports its numbers tomorrow. Ahead of that, the stock is higher. Remember, we saw good numbers coming in from Asian Paints, a steady set coming in from Kainzai as well. So the street expects no different from Berger. In fact, if anything, even better because of the additional kicker coming in from growth prospects in West Bengal. Additionally, we are also seeing some traction in Jindal Stainless. Remember, the first quarter, the revenues declined by high single digits, but the management is confident of slightly higher than mid-single digit growth in this year implies that the next couple of quarters will look fairly strong for the company as well. And finally, we end on something extremely delicious. We have Restaurant Brands Asia, the highest same-store sales growth in the last 15 quarters, stock up 15%, 16% and counting as we speak as well. Maybe I will coax Nigel into buying me some burgers as we wrap up on this edition of Chartbusters. So, Nigel, burgers on you. What we'll do is take a short break, and on the other side, we'll get you the team of Trading Hour. You're watching us here on Trading Gar. We come to you live from the CNBC TV 18 Motilal Oswal studio. As always, with me is Hormaz Fatakia, looking good for the market. And the reason why I say that is because of what we're seeing at the top. We have the Nifty, which is at 24,582. Do not look at the relative decline today because a large part of that is on account of this big spike that we had seen in the last few minutes of trade because of cash holding around the 24,600, something that the bulls would like, point to point. The Sensex is marginally in the green. That's a better reflector of the mood of the market right now, which is more or less flattish. And the mid-cap index as well is seeing a big performance when it comes to the breadth of the stocks. A lot of stocks doing well on the back of numbers, and the number of stocks which are advancing far more than the number of stocks which are declining by a factor of nearly 2:1. So, optically, it looks like we're at the day's low. Yes, we are, if you look at it from yesterday's close. But remember, yesterday's spike of almost 150 points in the last few minutes of trade is just getting normalized right now. So nothing really which is worrisome. Across the board, there is good gain. The only thing that we'll be monitoring as we move towards close today will be how the market performs on expiry day, as it is day 2 of CAS. Let's look at a bunch of stocks which are buzzing around right now. We have Maruti Suzuki, which has moved to the high point of trade. Trent is doing well. And ahead of numbers tomorrow, Berger Paints too has moved to the high point of trade. But a whole host of other stocks which are abuzz as well. Hormaz has moved across to the wall to tell us more. Hormaz.
It becomes all the more important, right? Technically, if you see, the Nifty could be 15 points higher. If you look at yesterday's level of 24,574, from where we actually saw that 200-point jump just in that one candle that went up. And then we are seeing this normalization take place today. Compare that to the Sensex. The same thing that happened with the Nifty Bank as well. It's still hovering around similar levels at where it was yesterday before that sharp spike. And it closed above the mark of 58,200. But in reality, as of now, 57,700 has remained a barrier for the index. It continues to remain so even in today's trading session. So as of now, the markets are flat as a flat can be, if you ignore the numbers that are on your screens as of now. The weekly options expiry today will have a big part to play as we go into that special closing auction session. Look at the result reactions today. As Manglam was highlighting, the more positives than negatives. Look at Ather Energy. So Ather Energy is the stock that I wanted to talk about, not Ather Industries. The stock is up 15% as we speak. Plenty of brokerages now. In fact, it's a consensus buy among all the 13 analysts who are tracking the stock. Nomura has targets of as high as 1,700 rupees on Ather Energy. Now, there you can see 14.5% higher on the stock. 1450 is where the stock is. Restaurant Brands Asia, of course, is the other positive result reaction that we are seeing. And of course, KEI Industries, you heard from the management earlier in the day. Restaurant Brands Asia is now 16%, and KEI Industries too seeing gains of close to 6.5 to 7% after that optimistic management commentary earlier in the day here on CNBC TV 18. On the flip side, negative result reactions. UPL, the stock had seen a bit of an up move after the results were announced yesterday, but today the stock is down 5%, even though the brokerages remain optimistic on it. Gen Resource Recycling continues to grind lower, another 7% knocked off here. Domes Industries is down 4. Butterfly Gandhimathi also reported numbers yesterday, down 7% in today's session. Look at the newsmakers. LIC's OFS is getting a healthy response. The stock still down around 7.5%, but the OFS as of 11 a.m. was subscribed 30% already for the non-retail portion. CG Power is doing well. Of course, the stock was down after the closing auction session yesterday. One of the few names that ended lower in comparison to their reference price. And SAIL doing well among the top gainers in the metal space, considering the weakness that you're seeing in the US dollar. And stocks at 52-week highs in today's session. Look at Gabriel India, that's up 3.5. Siemens is doing well, as is Deepak Fertilizers, and Rajratan Global is at 52-week highs as well. That stock trading with gains of over 7%.
All right, we take that point. Thanks a lot for that, Hormaz. Let's go across to the first management that we have on the show today. We have GE Shipping, reported a stellar first quarter, revenue doubling, net profit tripling, and debt more than halved year-on-year, driving margin expansion. So to discuss the company's first quarter performance and the road ahead, we are now joined by Mr. G. Shivakumar, who's the Executive Director, CEO of GE Shipping. Thanks a lot, Mr. Shivakumar, for joining in. You know, it's obviously at a time when tanker prices were higher, you've benefited from that, and you've taken this opportunity to perhaps, strengthen your balance sheet a little bit as well. Could you give us a sense a little more on how the rates have been so far across all the carriers? How do they compare with what we saw in the first quarter? And based on that, what is the likelihood of you sustaining the first quarter performance into the next couple of quarters as well?
Morning, Mangalam, and thanks for having me. Yeah, we had a very good quarter in Q1. The tanker markets were especially strong. We had the crude tankers and the product tankers as a result of the Strait of Hormuz disruption. While a lot of cargo was lost to the market because a lot of oil comes out through the Strait of Hormuz normally, just the dislocation of all the tonnage in the world caused the markets to spike and markets to strengthen tremendously. We have, again, most of our fleet is on the spot market, even now. Sorry?
Yeah, exactly. Yeah.
Yeah. So 75% of our fleet is exposed to the spot market. So we benefit typically from these spot market moves. And that's what has enabled those that significant increase in profits, even vis-a-vis the previous quarter, which was another all-time high profitability quarter. So the first expectation was that markets would spike because of the dislocations. But beyond the point, you would find the lack of or the reduction in cargoes beginning to weigh on the market. On and off it does. So the markets have been choppy. Today, I would say that the market for product tankers is a little bit lower than the average of the previous quarter. So the mainstay of our fleet, of our tanker fleet, is the MR product tanker, and that's lower than the spot rates for those are lower than they were in the previous quarter, which was an all-time high quarter, really. So it's a little bit lower, but again, the market is very choppy. This is again because it's so dependent on ship positions on a particular day. We see big ups and downs in the spot market. And this is where having a significant portion of the fleet spot helps to sort of average out and get a slightly higher, meaning, where you don't get hit only by the downs or by the ups.
Mr. Shivakumar, firstly, thank you for taking out time. What are the current rates right now in the spot markets? Have you seen an escalation again because of the latest flare-up that you are seeing? What's the situation on ground?
So the flare-up which is taken place, which is on the Bab el-Mandeb newly, and of course the Strait of Hormuz continues to be a little constrained. That's affecting the crude tankers more. So crude tanker rates continue to be quite strong. Product tankers are not affected as much. They are getting impacted by the lack of cargoes. So product tankers are down a little bit. MR tankers would probably have averaged $45,000 to $50,000 a day last quarter. Today, they're probably down to maybe $25,000, $30,000 a day, which is again a very high number. Long-term averages for a product tanker of this type is probably $17,000 a day, but it's lower than the previous quarter as it stands today. As I said, the market is very choppy. You could easily have this rate go up to 35,000, 40,000 next week.
Take that point. You have 3 rigs to be repriced in FY27. How much higher would they reprice at? Because your first quarter offshore business netted about 150 crores. With this repricing, what could the sustainable run rate be here? And what's the repricing outlook for FY28?
So the one update which has happened, which is very recent, so hot off the presses, is that we have received a contract for 3 years for one of our rigs, which is coming off contract towards the end of calendar 2026. So that rig will be employed after the end of the contract, the normal couple of months between contracts getting ready for the next one. So that will happen. In terms of profitability, I won't venture a guess because we have 2 rigs which need to find employment. The entire contribution, almost the entire contribution of offshore in the last quarter came from the vessels business. Right. We have had rigs idling. Last quarter, we had about, among the 4 rigs, I think effectively 1 rig was idling through the quarter. So they are not yet contributing significantly to the profitability. hopefully we will get better pricings on future contracts. And then it can contribute more. In the meantime, as I said, the offshore vessel business continues to be pretty profitable.
How much higher was the current contract priced versus the previous one?
Significantly higher than the current contract price. So it's actually coming off a little bit.
Right. No, I wanted you to put a number to the significant. If you could.
Yeah, it's we don't. Okay, it's probably $25,000 to $30,000 a day off from those rates.
Got that. $25,000 to $30,000 per day. And finally, your NAV is at the highest. Your balance sheet is at its strongest. What sort of cycle do you expect? One should see, because are you looking to maybe get some value out of the ships that you currently own, or maybe buy ships? What part of the cycle are we at?
We are at a very, very, very high part of the cycle.
Exactly.
And therefore, we are very cautious on buying. We don't want to sell because finally you have to retain some capacity to service your customers. So what we're doing is we are selling off the older ships and replacing them with newer ships of the same type. That's what we've been doing now for the last 3 years. We have done 15 of those replacement transactions so far. We will continue to do that so long as the prices remain high. Incremental capacity addition will be minimal. We are retaining most of our balance sheet capability for lower prices, where we can make sense of those prices in the long term and make a decent return on the capital that we invest in those. On the outlook side, the supply side is building up a lot. A lot of ships have got ordered. And therefore, it's looking a little bit more worrisome as we go along. In the meantime, you will get these short-term spikes, these disruptions which lead to big market moves. For that, we have our existing fleet. For the big expansion, we are willing to wait for what we would think are the right prices.
Fair to assume that you're keeping powder dry, Mr. Shivkumar, when the need arises. And are you comfortable with your debt levels as well? They have already halved. Do you want to bring them down further, or you're comfortable with where it is very quickly?
So the debt levels they have their schedule. We can't prepay that debt. So we just let it run down. It's got 2 years to go.
All right, Mr. Shivkumar, pleasure having you today. Thank you so much for sparing time and joining us. Take a break. Joined by the management of Jupiter Wagons on the other side. Stay tuned. Welcome back. On to our next management then. Jupiter Wagons is teaming up with Italy's Lucchini RS Holdings and Government Institute Simest, where both are picking up a combined 25% stake in its rail wheel arm for around 28 million euros. Joining us to take this conversation forward is Vivek Lohia, the Managing Director at Jupiter Wagons. Vivek, good morning. Thank you for taking out time. Tell us more about this first up before we get down to business this time around. What does the deal entail for you as a company and how soon does it start contributing to your balance sheet?
So thank you and good morning. So as you're aware that we have invested heavily in the wheel business and this is one of our biggest projects. And India is one of the biggest importers today of wheel sets. So this tie-up not only means a lot for us, but I think for the country itself. Because now with this partnership, for the first time in the country, you're bringing in global technology combined with Indian manufacturing. So this sets us up, then with this, I think tie up in place. Now we are set in terms of not only the Indian market but the global market in general. So the idea is that not only we become strong, and in India doesn't have the technology for when it comes to wheel sets for high speeds, for semi-high speed rail. Now with Lucchini today is the global leader in these technologies. So with this partnership, we bring that to the basket. And now with the expansion which is going to happen in the next decade in India, especially on the high speed and the semi-high speed, this is a very, very strong strategic tie-up for us.
Right. So could you give us some financial details of this agreement? There is a joint venture, I suppose, which has been formed. So what will your investment be in this? What will the partner's investment be in this? What will the total capex be? And at the same time, by when does revenue start accruing, if you could give us a sense? And what would the max revenue be at peak?
Lucchini is coming. We already have the wheel business which is there, which is under Jupiter Tatra Rail Wheel Factory. So they are coming into that business and they are acquiring 25% stake in that business itself. So it is not a new JV, but in the existing business, they are coming in as an equity partner. We start our axle production by the end of this year, and the wheel line will start in around Q3 next year. So by FY28, the company will have full production, and at its peak, we expect the revenues to touch close to 3,000 crores. And I've been stating also, we expect exports to be at least close to 50 to 60% of the entire revenue basket. Because already with Tatra Vagonka being there, they themselves have a captive requirement of close to about 20,000 wheel sets annually. And now with Lucchini partnering in, and in this deal, Lucchini comes in as not only a technology partner, but they take care of the entire global marketing right for this business. So the entire deal is structured in such a way that Lucchini is completely focused on taking this product to the global market.
Right. Just to get some more numbers out, Lucchini RS and Simest will totally put $28 million for about a 25% stake in this joint venture, right?
Yes, absolutely correct.
So this values this joint venture at around 1,200 crore rupees, 1,250 crore rupees?
So we have not factored in the debt part of it since it's a new project which is coming in. We have about close to 16 to 1,800 crores of debt in the business. So this is, they are coming in on the equity side. So it is proportionate to the equity which Jupiter has put into the business.
And the EV of this business would be 3,000 crores.
Yes, at its peak, and with a huge focus on the global market. That's the idea is that Lucchini's strength has always been they are the biggest producers globally today when it comes to high speed railway applications and but however their production costs are definitely much higher. Now with this partnership they can use the Indian industrial base, bring in the global expertise, so combined it gives us the perfect synergy to expand the global business.
What would be the peak revenue from this, Vivek? By when do you anticipate that to reach its full potential?
By FY28, I think by end of FY28, we expect the company to reach its peak revenues. And that is about close to 3,000 odd crores is what our expectation is. And EBITDA margins of, 18% plus is what we are targeting in this business.
All right, Vivek, thank you for sparing time and joining us today. Wish you good luck on this deal and on the road ahead as well. Take a short break. On the other side, we put the spotlight on LIC after the launch of its OFS. Stay tuned.
Well, the stock of the moment is LIC. The shares fall further after the government has launched an offer for sale to sell up to 6.5% stake. We have some updates coming in for which Hormaz has walked across to the wall to give us the live updates. Hormaz.
The OFS so far has been subscribed 30% as of 11 a.m. But the spotlight, of course, is the fact that the disinvestment drive that the government has embarked on all through the year, that has been the one that has taken the spotlight all through 2026. For LIC, as of now, they own around 96.5% stake. They plan to sell 6.5%. Of course, that is inclusive of the green shoe option that they have. And the potential mop-up of this, in case this entire 6.5% is subscribed, that comes up to around 31,000 crore rupees. Now, this is not the only one. There have been a slew of companies where the government has divested stake this year. Now, look at Coal India, they raised around 5,500 crores. From BHEL, they raised around 4.5. NHPC was a similar quantum. GIC-RE as well, they raised over 3,000 crore rupees. More stake sales came in from companies like IRFC, NLC India, and taking that total into consideration in Central Bank of India as well, the entire mop-up has come up to around about 23,000 crore rupees from these companies. But if you include LIC, in case that entire OFS is subscribed fully and they manage to mop up that 30,000 crore rupees, the entire stake sale proceeds will go up to around 53,000 crore rupees, and that would possibly be a multi-year high in terms of disinvestment receipts from the government. Of course, this is not the only company where the government owns more than 75% stake. The minimum shareholding norms mandate that, but still there are 14 other PSUs where the government shareholding is more than 75%. It can be as little as 2% or maybe even as high as 90%. And taking that excess stake into consideration and taking that with the current price, that value of that excess government stake comes up to well over 1.3 lakh crore rupees as of now. You take a look at the companies as well where they have excess stake. Look at LIC, of course, we are assuming the government stake to be 90% after the subscription of the full OFS. That stake at the current price is also valued at 76,000 crore rupees. Indian Overseas Bank it has been part of various forms of disinvestments, that QIPs and so on. 92% still valued at over 11,500 crore rupees. IRFC at 82% is close to 10,000 crore. FACT at 90% and Masgaon Dock as well over 6,000 crore rupees in value terms. That too has significant excess government stake as well. So the disinvestment drive is gathering steam. It continues to do so. Maybe more companies are in the offing. The government well and truly in mission mode for disinvestment this year.
Take that point, Hormaz. Thanks a lot for that. In mission mode for disinvestment, let's see what comes about. And thank you for putting that list together for us as well. Let's talk about some individual stocks as well. Shares of both DLF and Gulf Oil in focus today on the back of their first quarter earnings. Sonal joins in with all the number crunching. Sonal.
Thank you for that. Well, let me start with DLF, which was a disappointing set at a time when other companies have reported stronger bookings. The company saw pre-sales declining 83% on a sequential basis, 94% on a YY basis. This is because there were no new launches during the quarter. Most of the sales came from their super luxury project, which is Dahlias. The company, remember, has a guidance of 20,000 crore rupees in FY27 in terms of bookings. Now, all of it depends on new launches. However, their residential collections were down 15% on a YY basis, so that is also something that did not do well. The commercial segment, however, was strong. Their office lease income was up 8% on a YY basis. Their mall rentals were up 14% on a YY basis. So the commercial segment did well, but residential segment was under pressure. For Gulf Oil, it was a strong set despite headwinds that they saw in the quarter gone by due to West Asia crisis. Revenues were up 31%, EBITDA up 30%. Margins absolutely flat at 12.5%, but net profit was up 29% to come in at 123 crore rupees. The company says their lubricants volumes grew 17% on a YY basis because they did seek proactive customer engagement and effective market execution as well. Growth was seen in all the segments, be it B2C, OEM or B2B as well. All of them delivered double-digit growth for the company. So that was a strong commentary coming in as well. And they say they remain confident on surpassing the market growth as well. So their commentary continues to be very positive. And that's the reaction that we are seeing in the stock price as well.
Indeed, Sonal, thank you for putting that together for us. The numbers have started to come in already. We had three at the bottom of your screens just in the last 10 minutes. Uno Minda was one of them. The stock was at record highs yesterday. Numbers came in just a few minutes earlier. And DE Development as well, numbers flashing at the bottom of your screens. Uno Minda has moved to the day's high. DE Development Engineers has moved to the day's low. And Motherson Wiring too came out with numbers just a few minutes ago. Take a short break. Continue our conversation on the markets with Jyotivardhan Jaipuria on the other side.
Welcome back. It's weekly options expiry today. Perfect time to get in what the market setup looks like. The Nifty, obviously, as we've been pointing out right from the word go, is adjusting to the last hour spike that we saw. The Sensex is a better indicator of where the market is, which is absolutely flat on a normalized basis. The Nifty Bank as well is adjusting. So important levels to track. The first thing ahead of expiry is the fact that the put call ratio, which was overheated, and we've been pointing this out, has been coming down. So that's positive bulls. But on the way up, we are likely to see some resistance. So 24,600 call fairly active. 24,650 call on the Nifty equally active as well. 24,600 call, premium of 26 rupees, telling you upwards of 24,625 to closer to 24,675 is where we will start seeing, some sort of congestion come in. If the markets were to cross that and were there to be some volatility towards the end of trade today as well as yesterday, then maybe there could be a firm amount of short covering. At lower levels, there is strong support, no two ways about that. 24,500 put writers are extremely active, premium of 13 rupees. These are ones that expire today as well. Key levels to track. On the way up for the Nifty, the 200-day moving average is an important target to cross and sustain above. But for the Nifty Bank, which is adjusting after yesterday's up move, is fairly above the 20-day and the 200-day moving average as well, a level that it crossed in the previous trading session. So this was a congestion zone for the Nifty Bank. So long as it holds above that, no real problems. The 20-day and the 200-day moving average for the Nifty Bank as well. So around 57,500 to 57,450, important support zone for the Nifty Bank, Hormuz.
Indeed, support zones coming in for the Nifty Bank. Taking the conversation forward with Jyotivardhan Jaipuria from Valentis Advisors. Jyoti, good morning. Thank you for joining in. Over the last week, we were all talking about how resilient IT has been amidst all the chip sell-off. One man's sorrow is another man's joy. But for IT, is this now the time that the street finally begins to realize that the story is not over for them yet, although we may still see a few more quarters of pain ahead?
Yeah, so almost, my view is IT is no longer like a big growth story that it used to be. It's still a sector where you have cash flow coming in, you'll have good free cash flow. But, earnings growth will be probably high single digit or low double digit sort of thing. So that's the way you have to price it. Of course, just now what's happened is the sector's performed very badly. So there's been a huge underperformance. Consensus is very negative on it. And valuations, all said and done, have become cheap there. So, from our point of view, it's like IT is a space where, you're buying it more like you get it at very cheap valuations and you buy a bit, but not a sector where we'll see growth rates come back to what we saw in the past.
Right. Jyoti, in the past, you've liked a couple of sectors that have done well for you. One has been, cement, and the other one has been metals. On both of them, what's your call now? Because metal prices are beginning to cool off as the street is pricing piece in.
Yeah, so, in metals, most of our exposure was not direct metals. It used to be, things like pipes and all, which are like a play on the metal prices. Demand there is still very strong. So, as we see these numbers come in for these companies also, you'll find that the demand environment continues to remain strong. They've got like an initial pricing spurt at the beginning of this year. From here, I think prices will be flattish and you're not going to see that big spike coming. But, the margins are stabilizing at higher levels than what they were a year ago. And I think we'll see stable margins going forward. We'll see volume growth being strong, and that is what will drive the earnings for these companies. Cement, is going through this phase where, it's the monsoon season. It's like a seasonally weak season. Because monsoons have not done well, you probably are finding on a year-on-year basis cement prices are a little higher. But I think the key thing in cement comes, once beyond the monsoon, once we get into the second half of this fiscal year, where I think the pricing environment should be quite good. And that's why, we remain bullish that at some point we'll probably be adding to cement stocks, maybe towards the end of the last quarter of this year.
Would you be adding to chemical stocks as well, Jyoti? That's one more sector that you like, but margins have come off slightly in the numbers that have been reported so far by these companies. Still expensive on the valuation front, or would you look to add on to whatever little dip that you've seen?
Yeah, so chemicals has been a mixed bag because there are stocks which are still, they're not like ultra cheap, which they were maybe 5 years ago. At the same time, margins for a lot of them will probably start picking up now. There have been a lot of volatility around prices, but one is, China may not bring down prices the way they were, because as we know in China, the export incentives have been reduced from the start of this fiscal year. And so that will start helping, China competition remain a bit sedate. A lot of these stocks have underperformed quite a bit. So to that extent, valuation-wise, they're not ultra cheap, but at least they're not pricing in a euphoric scenario. So chemical is another space we are looking at, but of the three sectors which we spoke about, chemical is where we have our lowest exposure at the moment. In fact, a lot of our exposure more pharma than chemicals actually.
Okay, more pharma than chemical. Just a final question before we let you go. As we speak, a lot of numbers coming in from the real estate pack. Not all of them have been good. Some of them have actually been better. So you have any thoughts and exposure to the real estate space? And before we wrap up, anything fresh that you've bought over the last few months?
So, real estate is something which we have been a little cautious on because I think the demand environment is slowing down. What is continuing to do well is the high end of the real estate. And so a lot of our exposure there is actually from what I would say the ancillary to the real estate. So these are, the basically, let's say the tile space, the ceramic space. That's a segment which has not done well for the last 18 months. There the demand is picking up. I think margins will pick up. So, since you asked what we've been buying, actually we've been buying one of these ceramic tile companies. And we've added that to the portfolio in the last, I would say, 4 or 5 weeks.
The largest player or the second largest player?
Yeah, so it's not the largest player.
Not the largest player.
Let's
put it that way. Got it. Take that point. Jyoti, thank you. Always a pleasure speaking with you. We'll take a short break, come back, get you more on the markets and a lot of stocks with reaction. In fact, we'll be joined by the management of LG Balakrishnan and, they'll discuss their first quarter earnings and give you an outlook for the next year. Well, there's been a notable decline in the market, and that's led by Reliance. Just pull up the intraday chart of Reliance. Let's move to the low point of trade, and that's actually tracked the Nifty closer to the 24,550 mark as against the 24,600 mark when we started the show. But the stock on our radar is LG Balkrishnan. They've reported a healthy revenue growth, but margins have contracted, and that's largely on account of higher raw material prices. The CMD, Mr. B. Vijay Kumar, joins us now. Thanks a lot, Mr. Vijay Kumar, for joining in. And that really is the first question. Revenues have grown at around 20%. While profit growth was nearly 0%. What's caused the fall in margins, and by when will they normalize? What's the target for this year?
I said in the last quarter itself that the second quarter will be a little negative. But the first quarter we have done okay. We've done quite well. The growth has been about 21-22%. The growth in operating profit is also there. Overall, we have done less by 1.5%, but I had earlier indicated that we might drop about 2 to 3%. That's because of the steel price increase and all the input cost increases, especially the tooling material has also gone up. But I think we will come back to the original performance. We will maintain the same old 17%.
By when does that happen, Mr. Vijay Kumar?
Sir?
By when does the return to normal happen? Any timeline that you could share?
By the end of the second quarter, we'll be back to normal.
By end of the second quarter. All right. Also, Bajaj, with Bajaj having taken over KTM, do you see a rise in the premium chain export opportunity with this development?
There will be some increases, but we are already a supplier there.
So, some increase, I mean, how much higher could this be in terms of export opportunity?
By taking over this company, if Bajaj increases its overall volume, we will be part of that.
And you won't hazard a guess on the quantification of this increased opportunity size?
Oh, very difficult to quantify how much will be the increase of sale in Germany.
Got it. You've beyond these numbers, there is a joint venture that you've signed with SLGB Energy Solutions, forming a subsidiary in Vietnam as well. I just wanted to understand if you could give us a sense on the details around here. What would be the investment entailed, and what would the return on this investment be, the size of the opportunity, both on the new Vietnam JV as well as the Subsea Precision Engineering JV?
The Vietnam investment is an experimental investment. We are only going to invest a very small sum of money to see how it goes and whether we are comfortable doing business there before we increase our investment there. This is to start up a small chain division there and do as much of manufacturing in that country so that we qualify for Made in Vietnam. Got the SLGB is concerned, it's basically an engineering fabrication product, and it is meant for existing customers who are in the oil and natural gas area. So that would we would look at. It would be a long term. It would be about 2 to 3 years before it really takes off, because we have to do a lot of groundwork before that. But we are looking at around 30 to 40 crores in 2 years' time.
Okay, in terms of investments, right?
Pardon? No. Turnover of 30 to 40 crores.
In the that's in the subsea business.
Yes.
And in Vietnam, what are you expecting once, this experiment? I mean, what are the milestones of this experiment? Because I remember you had an investment in Mexico as well. What's happened to that?
Mexico, we've invested everything, but production has yet to start because we have concluded a kind of purchase from an existing customer for particular products, and we have to manufacture those products in Mexico. So it is a question of time. It will be active next year.
Okay. If I look at your gross block, that's doubled in the last 2 years. By when does that start reflecting in overall increased utilization and overall numbers?
There is a slow reflection already. LGB steel is already profitable. We're doing about 300 crores. We will do 300 crores this year in turnover. And we do a healthy bottom line in LGB steel. Similarly, all the investments that we put in are slowly beginning to reflect. Only LGB Mexico is going to take a little longer.
By when does the ramp up of your industrial chain happen, Mr. Vijay Kumar? And what is the kind of revenue growth that you are anticipating? You grew 20% this time. Do you grow 20% this quarter and for the full year as well?
Yes, we will do the same 20% growth continuously. Industrial chain is, unfortunately, the world market is very difficult right now. But we've done about 20 to 25 crores in industrial business this year.
All right, and the final question. You've signed an MOU with Brigade Enterprises to develop the property in Mysore. What does that do? I mean, it's obviously you monetizing some of the non-core land. How much does that bring to your books in terms of revenue potential? And are you looking at some other, utilization or monetization of non-core land as well?
No, it's a difficult question. The chain plant in Mysore was started about 30 years ago. The city has grown around us. We are now part of the residential area of the city. So we've passed an enabling resolution so that we can shift the factory at our convenience.
Pleasure having you today, Mr. Vijay Kumar. Thank you for sparing time and joining us. Wish you good luck for the rest of the year as well. Take a short break. Back with more on the markets on the other side. Stay tuned. Welcome back. Some very strong commentary coming in from Godrej Properties in their investor presentation. They have highlighted the fact that they are on track to meet or exceed guidance on all parameters for FY27. But more importantly, there are two things that stand out here. The first one being the fact that they are expecting to deliver 20,000 crore worth of operating cash flow by between the second quarter of FY27 and the fourth quarter of FY28. So over the next 7 quarters, they're planning to deliver around 20,000 crores of operating cash flow, and they are expecting to deliver collections between 52 to 55,000 crore and 20 to 22,000 crore rupees in operating cash flow cumulatively for FY27 and for FY28. So the stock also recovering from the lows of the day. On the earnings then today, continuing with that, Bharti Airtel is going to be reporting its numbers. Rima is here with what the street is expecting. Rima.
Thanks so much for that. So we're working with a consolidated revenue growth of about 3%, EBITDA margin stable at 57%, and a bottom line jump of 14%. Remember, Airtel Africa numbers are out and it's a strong performance, so focus will be on the India mobile business. But in the absence of a headline tariff, numbers for the telecom companies have been stable for the last many quarters. We know Reliance Jio, so even Reliance Jio's numbers, if you remember, revenue growth was about 2.5% quarter on quarter. ARPU's inched up by 0.7%. So we're expecting a steady set of numbers, no fireworks for the India business. So we're working with a revenue growth of about 2.3%. This will be driven by a combination of an uptick in subscribers and an ARPU jump of about 1.5%. But the trigger for Bharti Airtel is going to be one, headline tariff increase, but according to many analysts, it's pushed forward. So you've got a UBS, JP Morgan expecting it to happen in the end of this calendar year, and you've got some who believe it will happen in early 2027, like a Bank of America or Motilal Oswal following the state election. So that's going to be trigger number one. Secondly, the valuation and listing for Jio IPO, that's the JPL, that's going to be a trigger for the entire sector to set the valuation multiple, and the street is going to watch for continued debt reduction, and there is going to be a potential increase or a meaningful increase in the company's dividends and free cash flow. Back to you.
Right, Rima, thanks a lot for that. Some other earnings as well that we'll be tracking today beyond Bharti Airtel. Marico, good results expected, and the stock is at near record high already, has been a rank outperformer in the FMCG staple space for a while now, trading at 46 times. And the reason why there is so much confidence in the numbers being good is because we know them. The company has given us the first quarter update. Consolidated revenue growth is in low 20s, domestic volume growth in double digits, which is a multi-quarter high. The analysts have taken this and plugged in those estimates. 20.5% revenue growth is what we're working with, just shy of that 4,000 crore mark. The EBITDA grows 18.5%, margins at around that 20% mark, fairly stable year on year, and net profit growing at around 14.5% as well, with domestic volume growth seen between 13 to 15%. Now, while most FMCG companies are struggling with inflation for some of their key raw materials, Marico is on the other side of that because gross margins have improved quarter on quarter. Copra prices, which is the key input for parachute hair oil and all the coconut hair oil, is down about 45% from the peak. Value-added hair oils, a business that was struggling many quarters ago, for the last few quarters has gotten its momentum back. So that grew in about 20s. So that's a positive. And they expect strong operating profit growth due to lower input prices and strong revenue growth. So all these factors mean that these numbers will be strong. Similar is the case for Pidilite, though we will be watching out for management commentary on the margins of Pidilite a lot more, because from a revenue standpoint, no problems out there. 18.5% revenue growth expected, closer to 4,500 crores. EBITDA grows at around 15%, a little under 1,100 crores. Margin staying at the upper end of that 20 to 24% band that the management has been guiding, and the net profit grows at around 14%. Pidilite for the longest time has been delivering double-digit volume growth in their domestic business, and that here as well, you are expecting 11 to 12% growth led by the consumer business, which is likely to do about 13% volume growth. B2B likely to grow steadily at around 10% as well. Revenue growth will be further, bettered by price hikes that we've seen in a lot of these other paint companies as well. The company's guided margin band is between 20 to 24%, with the stated philosophy of passing 75% of the price hikes and taking the rest 25% on their margins. So commentary around that will be extremely crucial to track.
Indeed, keep an eye out on that as well. Just pull up Amber Enterprises as well before we sign off. There was a flash at the bottom of your screens with regards to a fire at its Noida unit. The stock has also come off the highs of the day, a percent lower on Amber Enterprises now, and that too has seen a bit of a correction there.
That has, and along with that, we have the market as well, which has moved to the low point of trade. What we'll do is wrap up on this edition of Trading Hour. Thank you so much for watching. With that, we'll take a short break, come back on the other side. The team of Halftime Report takes the market action forward. Thank you.
Heavyweight skewed moves after yesterday's big spike on NSE, leading to Nifty trading in the red even as Sensex trades in the green. Mid-caps counters trade up with metal showing strength even as IT and finance track.
The government is looking to sell up to 6.5% in Life Insurance Corporation or LIC via an offer for sale to mop up over 31,000 crores, the larger than 21,000 crore IPO size that saw a 3.5% stake being sold, puts pressure on the stock.
Ather Energy says it has a maxed capacity and is coping with a waiting period of 2 months for its e-scooters. It expects to add capacity of 42,000 units by Diwali, taking the total to 77,000 and eyes a market share of 25%. The stock revs up.
And soon, UPI payments above a certain amount may attract a charge called merchant discount rate to compensate banks for the costs incurred, and amendments to Payments and Settlement System Act can pave the way. Welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Patra and with me as always is Vinny Motiwala. Well, it's turning out to be a session which is under pressure at this point in time for the markets. So the Nifty is currently down around 1% and we do have the Bank Nifty or the banks which are underperforming in today's trading session. So we have the Bank Nifty which is down around 1.2%. What stands out, however, is the fact that the advanced decline ratio is still managing to hold up with a gain or on the positive side. So the advances are around 2,100 with around 1,951 stocks declining on the Bombay Stock Exchange. One of the reasons for that is also because of the small caps today. So the BSE Small Cap Select Index, the Nifty Small Cap 100, all of these are managing to hold up with a little bit of green, and that's possibly aiding the overall advanced decline ratio. Hi, Vinny.
Hi, Ekta. Good afternoon. A lot of individual movers in trade also coming in on the back of the numbers as well. Just in terms of sectors, we have media as well as metals, which are managing to hold on to some bit of a gain. Apart from that, you have realty, IT, banks that is on the downside and seeing a drag coming in for the markets as well. So let's watch out for that. But a lot of individual movers in terms of the trading session that are moving because of the Q1 earnings, auto sales updates that came in yesterday as well. So all of that is what we're seeing in terms of a move. But what's on the show for you all today? First up, we'll have Lata who will break down the government's UPI MDR proposal. What's changing, what's not, what it means for the users as well. So we'll talk about that. Then moving on, we'll have Yash who will join us with the CNBC TV 18 exclusive on LIC OFS and the government's message to investors. Moving on, Vivek will focus on a whole host of buzzing stocks and big movers in the trading session as well. So stay tuned in for that, and we'll connect with the management of Aarti Drugs to discuss their Q1 earnings and the road ahead for the company as well. But first up, let's get started with all the stocks that are moving around in the trading session, and we have Vivek to take us through that. Good afternoon, Vivek.
Good afternoon, and thank you so much for that. Extremely volatile trading session, especially in the last half hour. We've seen quite a bit of a sell-off emerge. In terms of individual names, what are the ones that we're tracking today? Have a look at both of the shipping companies, Great Eastern as well as Shipping Corporation. Great Eastern came out with a blockbuster set of results. Stock was cooled off after hitting the upper circuit, so significant fall from the day's high, but very sharp tanker rate is something that has aided the performance this time around. KEI Industries, very good set of numbers, margin performance much above what the street was anticipating, and management commentary was quite upbeat when they joined us earlier today, almost 7% higher on good volumes today. RBA or Restaurants Brand Asia, this particular stock after the takeover has seen a significant performance improvement, especially as far as the same-store sales growth is concerned, up 20% in the session today. Ather Energy, again, losses have narrowed significantly, very good set of numbers, management commentary very strong, 15% higher in the session today. Most of the capital goods stocks seeing quite a bit of buying, especially names like ABB after the results, CG Power, Apar Industries, all of those stocks doing quite well in the session. And Godfrey Phillips, news reports are indicating that there may be a bit of a truce as far as the promoters are concerned. Stock higher by 2%, cooling off a little bit from the day's high. On the other hand, quite a few laggards as well. Can't look beyond LIC, large OFS, large equity offering. The street has seen a bit of a sell-off after the street has given the stock a bit of a sell-off after that particular large equity offering. UPL, muted Q1, the street is not, and opinion is divided, especially when it comes to the restructuring that the company has announced in the quarter gone by. It's almost 5% lower on that particular name. Whole host of banks and NBFCs that saw a very sharp spike, especially between 315 to 330 yesterday. Most of those names are seeing a bit of a cool-off. And lastly, DOMS Industries, from the broader markets, margin pressure weighing in down almost 4% today.
Okay, all right, Vivek. Thanks very much for bringing us all of those stocks which are in focus. Well, let's talk about one particular one, which Vivek also mentioned, Ather Energy. That stock has hit a fresh 52-week high today. It's up around 14% after reporting what was a good set of Q1 numbers. Revenue growth remains strong. Non-auto revenue came in very steady. This is our Insight Edge segment on Halftime Report. So Sudarshan is going to break down the key takeaways from what the management has said. Sudarshan, over to you.
So it's been a one-way move that Ather Energy stock has been seeing over the last few months, and today also it's up 15% on the back of very strong set of earnings, and even internals are looking very strong. So first talk about the numbers. It's a strong set, adjusted EBITDA company. It's turned positive if you calculate on total income. So operating profit company has reported of 10 crore rupees versus loss of 106 crore. And in resultant, operating margin has come in at 0.8% versus minus 15.8%. Now look at the internal. Wholesale volumes company has reported an increase of 81%. Registrations were up more than 100%. Production has seen an increase of almost 80%. And quarterly pre-orders are up almost 160%. Now, company is looking to enter into the mass segment, and for that, EL platform company is going to launch on 29th August, and price for that product will be in the range of rupees 1 to 1.20 lakh. And apart from the earnings, company also enters in the F&O segment from the next series. Now, what do brokerages feel? All the brokerages have positive stance on the stock. CLSA has a target price of 1600. Nomura has a target price of more than 1700, and HSBC has a target price of more than 1450 rupees per share. Today, management did speak to CNBC TV. Let's listen in what exactly he had to say.
Our focus is not market share because temporarily we can't do anything about it. Our focus is on ramping up capacity. By end of Q4 or early Q1, it would have ramped up to its full max capacity of 42,000 a month, which will take our total net capacity to 77,000 units. Before this demand surge happened, we were already comfortably getting to 19-20% market shares. We still have hundreds of stores to add, and we have our new product EL going live in a few weeks. So we believe a rightful market share should be north of 20%, probably north of 25%. But it'll take us a few quarters with new capacity to get to that market share. So if demand does continue to surge up, we will have the option of quickly ramping into phase 2 and taking our total capacity to 14.2 lakh units. So 4.2 lakh units, 5 lakh units, and then incremental 5 lakh units, total 14.2 lakhs. So if we do have to do phase 2, we do not believe that we'll have to raise more equity capital.
Okay, that's about Ather Energy holding on to strong gains in the trading session. But let's move on, and big changes may come in for UPI. Large value transactions could soon attract a charge as the government moves to amend the Payments and Settlement Systems Act. Lata is joining us to give us details on this one. What has changed? What should we watch out for as well? Lata, over to you.
Yes, the free UPI is probably out. Some large value payments done through UPI may become chargeable, like, we pay for credit and debit cards. Large merchants may have to pay a small discount rate for this electronic facility. The government today is introducing in Parliament some amendments to the Payments and Settlement Systems Act 2007. This act currently, through cross-referencing with the Income Tax Act, places a blanket exemption on the imposition of charges on merchants for accepting electronic payments. That blanket exemption is set to be removed with this amendment. The amendment to Section 10A of the Payments Act will empower the government to notify from time to time which specific electronic payment modes will remain free of charges and which may be charged. Such a fee, of course, has been demanded by banks and the Reserve Bank because banks need huge investments if every small person-to-person transaction has to be effected and reflected in their accounts. Banks also have a headache maintaining liquidity on an ever-changing pool, changing every minute. And hence, they have been asking for, some payment to be made, some payment that they may receive for MDR, for UPI transactions. Now, what kind of transactions are likely to be charged? Chances are very small UPI amounts will always remain free, like person-to-person or small merchants whose total turnover itself is less than 2 crore rupees. But very large payments like over 2,000 rupees and made by large counterparties, large merchants, may elicit a charge of 0.05% of the total amount transacted, and the merchant will have to pay it. The fee amount that banks earn from the merchants, should be used to build payment infrastructure. That's also likely to be part of the rules. So when will these charges come? The process is like this. First, the amendment will have to be passed in Parliament. Then it will be notified in the Gazette. And then the Reserve Bank or the MPCI will make operational rules as to who will charge, how much will the charge be, how will banks get that charge and how they will use it. Those operational rules will be the last step.
Okay, all right. Lata, thanks very much for bringing us all of those details. We'll take a short break on that note, but we'll get you a lot more on the markets. Yash joins us with the CNBC TV 18 exclusive on the LIC OFS and the government's message to investors. That story coming up next. Stay tuned.
Welcome back to Halftime Report on CNBC TV 18. Now Nifty is around the 24,500 mark. Let's watch out for that. It dipped below that and then it's again around that level. So we'll keep an eye out on where it's going to be headed. Today's expiry as well. So that'll be key to watch out for. But let's keep it going now. And LIC remains in focus today. And this came in after the government's 6.5% stake sale that we have via an OFS. Now sources tell CNBC TV 18 that the government has assured investors there will be no fresh OFS in LIC for the next 2 to 3 years. Yash has more details on this one. Yash, over to you.
Well, speaking about the offer in the first place itself, as far as the total OFS itself is concerned, it's been a long-awaited issue which has been in the works. As far as the total size is concerned, as you said, about 6.5% of total issue, out of which about 2.5% would be as far as the base issue is concerned, with an additional green shoe option of an additional 4%, which makes it together 6.5%. The floor price has been fixed at 382 rupees per share, 11% discount to the last closing price. Now, at the full issue size, the government is expected to raise over 31,000 crore rupees. As far as the post OFS government holding in LIC is concerned, that will come down to about 90% from 96.5%. Almost a year ahead of the timeline which was granted by SEBI. Now, CNBC TV 18 has also learned that the government has assured all its investors that there will be no further OFS in LIC for the next 2 to 3 years, with the large issue size aimed at avoiding any smaller or frequent, stake sale which the government could have otherwise done. Further, what we've been given to understand is that the government has held meetings with more than 50 domestic and global funds ahead of this much-awaited launch as far as the OFS is concerned. It has also secured strong investor commitment for the issue. Now, on this particular story, CNBC TV 18 has written to the Department of Investment and Public Asset Management, that is DIPAM. A response from them is still awaited. But let's very quickly look at the journey that LIC has had. More than 4 years after the LIC's listing, the numbers tell a very interesting story. While the insurers' fundamentals have strengthened in that journey of 4.5 years, its market valuations, that has moved in opposite direction. At the time of listing in May 2022, LIC's issue price adjusted for that 1:1 bonus issue, that stood at about 474 rupees per share. The current OFS floor price is 391 rupees. Market capitalization has declined from about 6 lakh crore odd to around 5 lakh crore, which is where it stands today. But the operational matrix, they've improved sharply. Embedded value, that has risen from 5.39 lakh crore to all the way up to 7.89 lakh crore. VNB margin, that has expanded from about 15.1% to 21.2%, while the share of non-participating products, which is a very positive metric, as a percentage of the individual APE, that has jumped from 7.12% all the way to 35.11%. Now, despite the strong improvement that we see, LIC's price to embedded value multiple, that has fallen from 1.1 times at the time of listing to just about 0.64 times currently. Now, the government's fundraise has also become significantly larger. While the IPO saw a 3.5% stake sale or stake dilution for 21,000 crore rupees at the time of the IPO, the current OFS proposes to sell about 6.5%. This includes the green shoe option and is expected to mobilize around 32,000 crore as far as the stock is concerned. Very quickly, looking at the stock tracker itself, as I said, there has been a significant downward movement that we've seen in the stock. At the listing, it was about 436. The all-time high which has been made by LIC stock is 468. All-time low is 361. So it's moved all in the band of that 100 rupees, where all-time high, all-time low, and the listing price really remaining largely unchanged.
Absolutely. Well, thanks, Yash, for bringing us that comprehensive detail with regards to LIC's OFS. The stock itself is just about lower by around 10 to 11% on in the past 1 year. But we'll do one thing. We're going to take a short break. But up next, we're going to go full tilt on the markets. We have Rohit Srivastav of IndiaCharts.com. He'll join in to discuss the new closing auction session for F&O stocks. Stay tuned. Welcome back. Well, for the markets, the Nifty is around 250 points lower. That's what it is indicating. And the advance decline ratio, when we started the show, was in the advances favor. So that seems to now be flattening out and is more even keel. And as you can see, there is a little bit of a crisscross which is taking place. So the declining stocks seem to possibly be overtaking the advancing stocks. So there is a worsening in terms of the advance decline ratio, which is taking place at this point in time. Auto stocks such as Hero Motor continue to do well. That is also ahead of the RBI policy. So that stock is up around 2%. Hindalco continues to show some amount of traction on the upside. So that stock is up around 0.8%. Remember, it's gained around 13% this year. And Apollo Hospitals from the healthcare space is also doing well. So Apollo Hospitals is up around 0.6%. Those are the Zydus Wellness numbers. Net profit down around 7% on a year-on-year basis. Well, the lack of active market makers make the Indian market more prone to volatility in gas. That's the word coming in from Rajesh Baheti of Cross Seas Capital. He also adds that gas was meant to help the index funds rebalance without added tracking error. Listen in to what he had to say. We'll then get Rohit Srivastav to talk a little more about it.
I think the lack of active market makers in India, the fact that there is STT, the fact that stock borrowing and lending is a very onerous exercise in India makes the Indian market more prone to volatility in the closing auction session, which will not reflect the actual mood of the market. If the whole idea of the CAS was to allow index funds to rebalance without incurring a lot of tracking error, then the F&O session can expire prior to the closing auction session based on the last half an hour or 45 minutes, whatever you might deem fit, prices, and let the F&O expire and let the official closing price not be the price at which the F&O expires. I mean, we had the currency expire at 12:30 or 12:15 p.m. based on the RBI spot rates at that time and nothing to do with what the markets were doing here. And secondly, even in the US, the quarterly options, the triple witching contract does not expire on the closing auction system determined prices. They expire on the next morning based on the opening rates. And in the US, the opening rates take close to about half an hour to be determined. And so in half an hour, it's difficult to fix the market.
That's a word coming in there. But let's move on and also bring on board Rohit Srivastav, founder and strategist at IndiaCharts.com and Strike Money, to talk to us about this as well. Rohit, hi, good afternoon. Thank you so much for joining us on the show. Now, yesterday, what happened is something we saw a spike, the difference that comes in between Nifty and the Sensex as well. What are you making of it? Today is expiry as well. So how are you reading the current scenario, the current charts, technicals? How are you transpiring everything in today's trading session now?
So see, yesterday's session was definitely very, very unusual. And I say that because we didn't get, very normal behavior. When you see that the cash closing comes in, 200 points above the actual trade that we saw at 315, the variation is too high. And the real question is, can you hold on to those levels? Something which was proven wrong today morning because the market opened higher and sold off immediately, and you actually negative 150 points. So you gave back most of those gains that you saw overnight. In fact, you didn't even see the GIFT Nifty move that much as you did the CAS Nifty reading. So something's definitely amiss as far as what happened yesterday, whether we accept it or not. But what this means is eventually you will need to figure it out and, benchmark to what the global systems are. Now, today will be the real test as to whether we've corrected the issues that we faced yesterday, because what is expected is that if you're going to use the cash-based Nifty closing to settle the trades, because today is the weekly expiry, if you're going to be settling the trades based on that, then there are going to be a lot of gains and losses that people will be making after the 315 close. And these are unaccounted for. We don't know what that's going to look like, especially if there's going to be a 200-point move. It can mean a win for some people, and it can mean a huge loss for some other people. And I think that's the part that we are really worried about, how today goes. And it's day 2, so we've had time to correct whatever happened yesterday. and hopefully we won't see the same kind of volatility. Otherwise, it will create some kind of scare.
Rohit, hi, welcome to the show. Well, exactly on that point, that considering that it is weekly expiry today, how exactly do you expect traders to possibly alter their strategy in lieu of what we saw yesterday?
So a couple of things might happen. One of them is that people might want to close out all their longs and shorts by 315 itself. They might not want to carry it forward and take the risk. But there's a different mindset. So there are also these very short-term speculators, the guys who bet on weekly expiries and bet on one-day option expirations. So this is a very speculative group. They might have a very different approach. I was speaking to some traders in the morning, and I found that people are actually buying calls and puts expecting more volatility today. Now, during the day, we've already seen that, so that's good. But it's possible that there are people who will start betting on the idea that why not just buy calls and puts at 315 and hope that it moves another 200, 300 points like yesterday. But will those bets really pay off? It depends. It may happen that a lot of people end up buying options expecting some wild move, and today you might actually not get a wild move. So let's see. There are going to be two types of people who will be taking action today. One is those who don't want to take that risk, especially writers who don't want to leave positions open, would want to square off. Whereas buyers might actually want to bet on some kind of wild move post the market close. But eventually, I'm hoping that NSE figures it out and streamlines it in line with what happens globally. We don't really see that kind of volatility in the cash segment.
Absolutely, we do not see that volatility in the cash segment globally. But Rohit, just one thing. Given this expiry, we have already finished half the day so far. Have you seen any varying signals so far in the charts as well? Too much volatility, or this is, we do see volatility coming in for expiry day normally as well. Apart from yesterday's, move, that gap up and then gap down that we saw today, is that, other than that, anything else that is different today or one should be alert about?
I think intraday we've already seen 400-500 points of move, which is pretty large. Many times on expiry day recently, we've been seeing less volatility. So a lot of buyers and sellers end up losing their option values on expiry day because of the premium loss. Today is actually ending up being a little different on that front, that people actually gaining from volatility. So it's turning out to be a little interesting. I'm not sure it's because of what happened yesterday, because because yesterday's move would have scared a lot of people who were bullish. Imagine that the market has been going up for the last 5-6 consecutive days. People might want to close out their long positions before expiry, not wanting to deal with the volatility that might happen post expiry time.
Right.
All right, Rohit. Okay, go ahead. Are you in a position to just answer one more quick question, Rohit? Looking beyond today's expiry, what kind of changes do you think that the exchanges or the regulators need to make in order to iron out these issues?
So what we can think of, if we just look at how the system executes, there's a window, somewhere between, 320, 330, where you can place, 315 to 325, I would say, you can place these open market orders or limit orders, right? So that is the room in which these wild movements happen. For example, what we saw yesterday, and this could be a function of some block trades or algos, that most of the spot prices were up by around 0.8 to 1% across the board, whether I look at Reliance, ONGC, multiple stocks. So it's not that, there were 2-3 stocks that moved up or down that caused the index to move up. It's a complete basket that moved higher that caused the 200-point blip. So that means somebody executed a basket, market, or limit order at a higher price, and that caused the Nifty movement. Okay, and I guess NSE needs to look into that. What was it within the guidelines, or do the guidelines need to be tweaked that no single order or market order can move the index by more than a certain percentage, but we have room for it to move by 2-3%. So it's pretty significant. Then the next question arises: is the post market activity really liquid enough to handle those size of orders? So Does that make it more volatile? Are we really ready for this kind of a system?
Okay, Rohit, we'll have to wait and watch how today's trading session actually ends. But thank you so much for joining us and helping us understand more, at least what to watch out for in today's trading session as well. So thanks so much for that. But on that note, we're going to slip into a very short break. After the break, we'll get you more on markets and we'll focus on UPL as well, which has been under pressure today. Stay tuned. Welcome back to Halftime Report on CNBC TV 18. As of now, the Nifty is at 24,515, down almost more than 200 points, 261 points in the trading session so far. Now, in terms of the moves that we've seen in the last few minutes, we had Zydus Wellness that reported their numbers just a short while ago. That stock is down in trading session. We have KEI Industries, that has come off significantly as well. It's in the last 30 odd minutes, it's down almost 2.5% as well. From the day's highest point, we're seeing a decline coming in. So will be key to watch out for on that front as well. Marico is expected to report its numbers. Let's watch out for that also in the trading session. But UPL, that's slipping in trade and that's down almost 6% today. And this is despite them reporting a steady Q1 number. What is actually the highlight over here? Why is the stock down in trade as well? Let's go across to Ria to understand that. Ria?
Well, yes, today UPL has fallen nearly 5.5% after closing by nearly 3% higher yesterday after posting a steady set of results for Q1. Now, this time around, they have seen stable performance in Q1, which is generally a seasonally weak quarter for them. Revenue growth has come in at 10% versus the guidance of 10 to 14% for Q1. EBITDA also up by 15% versus the guidance of 14 to 18%. So they have met their guidance on both of these fronts. The profitability this time around has been supported by a 50 crore rupee forex gain for them, and overall the volume has declined by nearly 3%. While this is muted, this is in line with what the street was estimating for Q1. Now, for the full year of FY27, the company has given guidance growth. For revenue growth, they have estimated 7 to 11% growth, and for EBITDA, they are targeting growth of nearly 10 to 14% for the full year of FY27. And further, the management has also said that Q2 is expected to be stronger for the company, and they do expect margins to normalize during the second half of of the year, largely due to seasonality, but this will still remain materially above what we saw in FY26, so margins are expected to increase on an overall basis. And apart from this, they have announced a management change for the company. Mike Frank will be stepping down as the CEO of UPL Corporation, which is the global crop protection business. This is with effect from the 31st of August 2026. He will be stepping down due to personal reasons. And Jay Shroff, who is currently the group chairman and CEO, will also be leading the global crop protection business here on, along with some other senior leadership. So today, the stock seems to be reacting negatively to this management change, and also seeing some profit booking after yesterday's move. But overall, it has been a steady quarter for UPL.
Okay, steady quarter for UPL. Well, the other stock which is managing to hold up at this point in time is Syngene. Remember, it came out with a very disappointing set of numbers this quarter because of the loss of one particular, reducing business from one particular client, but it's holding up today. So up around 2.4%. Remember, Biocon comes out with numbers tomorrow, so it'll be important from that context. But we'll take a short break. Up next, we'll connect with the management of Aarti Drugs to discuss their Q1 earnings and the road ahead. Stay tuned. Welcome back. Well, it's definitely a down day for the markets. Advanced decline ratio also just about trying to maintain some kind of semblance at this point in time. Just before we get to Aarti Drugs and talk about it, there is one particular stock which should come up for you. That's Blue Jet Healthcare. Remember, it came out with its numbers during markets yesterday, and at that point in time, there was a steep reaction on the downside for Blue Jet, but today it's managing to hold up a little bit with a gain of around 0.3%. They did hold their conference call post-markets yesterday, where they did say that there is a Q-on-Q improvement which has taken place, and the improvement in the quarter is aided by the normalization of customer inventories. So that stock just about holding with a gain of around 0.3%. That is an update on the markets as well, where the Nifty is just about managing to hold on to 24,500. Remember, yesterday we did hit 24,600 on an intraday basis, but today it seems as though we're just about holding 500 levels by the skin of our teeth. But let's get talking about Aarti Drugs then. It came out with its numbers a couple of days ago. It received, reported a decent set. Margins came in at the highest level that we've seen since Q4 of FY25. In fact, specialty chemicals also small section of the business, but reported good growth. We do have Adish Patel, who's the CFO of the company, now joining in. Adish, thank you very much for taking the time out. Well, it's a 19% growth that you reported this time in terms of revenue. So just take us through what the volume and the pricing picture is, especially pricing, considering that the last two fiscals pricing has been lower.
So this particular quarter, we saw year-on-year growth of almost around 20%, but majority of the growth was driven by pricing. And mainly it was on the account of Iran-US conflict. So the pricing growth was roughly around 16 to 17%, and around 3.5 to 4% volume growth was observed. So what we expect is that volume growth should ideally have been better, but because of the sharp hike in prices, especially during the start of the quarter, there was some impact on the demand of the products.
So just to get that into perspective, which was your key product which probably saw that price increase? Was it metformin, where prices rose by around 20% because of the conflict?
Yeah, very much so. Anti-diabetic segment was heavily affected by the conflict, and some antidiarrheal products as well. But once April and May month were particularly, the prices were very high, and after that there was some cool off which was observed. But again, because the war has restarted, the pricing level, though it is not as high as March and April, but it is still higher than as compared to the last year.
But still higher versus last year. Hi Adish, good afternoon. This is Vinny joining in the conversation. Then, overall in terms of growth, would this time also be more pricing-led growth, and how much higher? Means, again, would you see 15-16% you said last time you saw as a pricing growth? Then Q2, what are you envisaging so far?
So as of now, the pricing is still high. Means at least I would say, let's say around 10%, we can expect a pricing growth year-on-year basis. And last year, what we have seen, the prices were almost stable for the last 4 quarters. I'm talking about the last entire financial year.
So what would their volumes also be in Q2 then? Are we seeing an improvement at least in terms of volumes? Now pricing has come off a little bit. It's 10% approximately. Then volumes, are they seeing an improvement? Overall guidance also for FY27, if you give us that number as well.
Okay, so overall, considering the values and also taking into account the reduction in the expected growth in volumes, we still feel that we should be able to clock somewhere around 10 to 15% of revenue growth and a much better EBITDA growth of around 18 to 20% for the given financial year. What happens is, in the higher price market, typically the export volumes, they don't suffer that much, but the domestic market is quite sensitive to the prices of APIs.
Okay, that point is taken. For metformin, then just give us an idea, because you're trying to increase your capacity as well. When it comes to metformin, you're looking at the US markets, you're looking to apply, supply to the US markets. When exactly do these plans come about?
Yeah, so our first capacity which will come into action would be the first expansion from 1400 tons per month to 1700 tons per month. That would be a EDQM approved facility, European approved, that we should ideally see within 8 to 10 months time period. and the US FDA block, which is adjacent to that in the same location of around 500 tons per month, that we can expect within 12 to 14 months.
Okay, so you're expecting the US FDA approval for that particular unit which will supply metformin to come in between 12 to 18 odd months. Just tell us, Adish, your specialty chemical segment, it's a small part of your business, but it did exceptionally well this quarter.
Yeah, so it is mainly on the account of the Greenfield project which we commissioned last year in the month of September. So initially the utilization was lesser in the quarter of December, then it improved in March, and then in the quarter of June, it was roughly around upwards of 60%, 60 to 65% was the utilization. And that was the main reason why the spec chem segment did great volumes in this particular quarter.
Adish, could you also help us just understand in terms of the breakdown for exports, domestic market across your segments as well, API, formulation, how has it been?
Yeah. So for the standalone company, which comprises of spec chem business and the intermediate and the API segment, there our split is around 68% is domestic for the last quarter and around 32% exports. But on the formulation part, on the formulation side, almost 70% is exports and around 30% would be domestic.
Okay. Well, Adish, just wanted to get back about the US FDA approval for one of your facilities that you're looking at. Besides metformin, what else are you looking at when it comes to the US markets? How much do you think you can probably scale up as a percentage of sales?
Yeah, so our current E22 block, which got US FDA approval last year, from the sales standpoint, it is not that high. It was roughly around 80-90 CR, but then from the bottom line perspective, it would make a much more significant impact on the overall P&L. And however, we are also expanding under the same API number. We are putting up 3 more production lines. We'll be announcing that capex soon. So that will take up our revenue potential to roughly around 200 crores for the entire US FDA block in future. And as of now, we are already looking to start commercial supplies probably next year for antibiotic sedative segments and anti-inflammatory segments from the US FDA block.
Adish, what is that additional capex that you would be looking to put in then? Any figure for that one that you could help us with?
So as of now, the figure is not out yet. But what we envisage overall means from the consolidated standpoint, including the formulation investments which are going on, we feel we might clock around 150 plus minus crores this year and probably around 200 odd next year.
Okay. All right. Well, we're going to leave it on that note, Adish. Thanks very much for joining in and speaking with us. So that is Aarti Drugs. The stock is managing to hold up around 1 to 2% in today's trading session. There's been a margin improvement which has taken place, and the revenue growth of around 19% has primarily been led by pricing improvement because of the conflict which has taken place, as compared to volumes which are up only around 3.5 to 4%. We'll take a short break, but up next we'll get you a lot more in terms of specific stocks. Stay tuned.
Welcome back to Halftime Report on CNBC TV 18. As of now, when you look at the Nifty, 24,500, just holding on to that level, right? We're seeing a bit of a pressure coming in here. Day's lowest point around that is where the Nifty continues to trade at. What's happening to Nifty IT as well? Let's take a check on that. That also is around the day's lowest point, Nifty IT. Nifty Bank also is not much of a support today coming in, right? Nifty Bank also is trading around the day's lowest point. So that is what we're seeing in terms of a move coming in for the Nifty IT, Nifty Bank as well. Let's pull up the broader end of the market. What is the mid cap doing now? Nifty mid cap also has inched lower in the trading session. So Nifty mid cap is also around the day's lowest point. Slight bit of a recovery, but still around the day's lowest point is what it's trading at. In terms of individual movers that we're seeing in the trading session as well, Lupiel continues to be under pressure. We spoke about that. We have Motherson Sumi Wiring, Zydus Wellness, ITD Cementation. All these names are under pressure, trading with cuts of more than 4% for all these names. So let's watch out for what happens over there as well. We have United Foods that's reported their number as well right now. And you can see it at the bottom of screens. We're seeing a bit of an uptick coming in for United Foods. We'll watch out for the revenue growth as well as the profits of the company. You saw it at the bottom of your screens. As of now, at the day's highest point is what United Food trades at. But KEI Industries, right, that's also in focus. And the company has reported a decent quarter. The con call is going on as well. We had margins that beat the expectation, but what did the management of the company say to CNBC's EV18? We had Anil Gupta, CMD, who spoke about the company's volume growth and guidance. Listen in.
Think of that our overall revenue growth will be in excess of 25% for the full year. It will be substantially more, and the volume growth will be there. I'm not able to quantify exactly the volume growth at this moment because I don't have the numbers. But there will be a substantial improvement in the revenues and the volume growth in the coming quarters. We would try to achieve anywhere between 11 to 12%. Earlier, we were always giving guidance between 10.5 to 11%. Now I can say that we will be able to maintain it between 11 to 12%. And I mean, maybe that if the volume growth is from the new facilities comes up much bigger, then it may improve also. Our export will be close to 16 to 18% of our total turnover this year. The first quarter numbers are less because our export to Middle East was impacted badly, and also exports to United States was also impacted due to tariffs. Now we have a very strong export order book and a very healthy book.
Okay, so that's KEI Industries. That stock is up around 6% The company is saying that they do have a healthy order book. Remember that stock is spiked around 19.5% on a year-to-date basis and is building on gains in today's trading session. Well, a couple of other stocks which are managing to hold up include a few which have managed to hold up on a year-to-date basis as well. So Ricoh Auto, for example, is up around 4.6%. It's gained around 9% on a year-to-date basis. GM Financial is doing well today, so that stock is up around 4% And like we mentioned, there are a couple of others such as Syngene, which is up around 2% in today's trading session. On the downside, however, Dabur just taking it on the chin. It's adding to its losses that it's accumulated on the year. So it's down around 18% on a year-to-date basis and it's down around 3.5% today. Oberoi Realty also joining the party of the losers. So that stock is down around 3% And Divi's Labs, which did see a strong run-up post ahead of its numbers as well, is seeing some amount of profit booking. So that stock down around 2.5%. But let's shift to the Nifty pack. We have Bharti Airtel, which will be reporting its Q1 numbers today. Reema's here with the street expectations. Reema, over to you.
Thanks so much for that. So for Bharti Airtel, it's a mix of what the company does in Airtel Africa, the India mobile business. Now, the Airtel Africa numbers are out and it's a solid set. So on a consolidated basis, the street is still working with about a 3% top line growth quarter on quarter, margins around 57% with a PAT growth of 14%. But the attention is on the India mobile business. And in the absence of any headline tariff increase, numbers for whether it's Jio or Airtel India business have been fairly steady. So they've been moving this 2, 3, 4% kind of quarter-on-quarter growth. Even Jio this time is a 2.5% revenue growth with margins stable and an ARPU increase of 0.7%. So basically what I'm trying to say is that Bharti's India mobile numbers will be very, very stable. We're working with about a 2.5% top line growth. It will be a combination of subscriber adds and an ARPU increase of 1 to 1.5%. But if you look ahead, the triggers for Bharti Airtel, it's going to be on home broadband. That's been a fast-growing segment for the company, data centers under the enterprise business, and the big tariff increase. The tariff increase hasn't taken place in more than 2 years. Some believe it could happen towards the end of this calendar year. Many believe the BOFA Motilal Oswal maybe sometime in 2027 after the state elections. So tariff increase is going to be one. Secondly, in terms of JPL valuation and listing, because that will set the benchmark and valuations for the entire sector, and what happens with respect to free cash flows and whether there is enough to increase the dividend from here on. So those are some triggers, but generally for Bharti, there is no trigger in the current quarter, so it's expected to be a fairly steady showing.
Okay, Reema, thank you so much for that. That's about Bharti Airtel. But on that note, just a quick check in terms of the markets again. We just went below the 24,500 again as well, trading at the day's lowest point. 24,490 is what now the market is trading at, down with cuts of around 290 to 80-90 points in the trading session. But with that, we're absolutely out of time on this edition of Halftime Report. Thank you so much for tuning in. Up next, your business lunch should take you through all the market action.
Let's see skewed moves after yesterday's big spike on the NSE, leading to the Nifty trading in the red, even as the Sensex trades in the green. Small caps trade up, with metals showing strength, even as IT and financials drag.
The government is looking to sell up to 6.5% in Life Insurance Corporation via an offer for sale to mop up over 31,000 crore rupees, the larger than 21,000 crore rupee IPO size that saw a 3.5% stake being sold puts pressure on the stock.
Ather Energy says it has maxed capacity and is coping with a waiting period of 2 months for its e-scooters. It expects to add capacity of over 42,000 units by Diwali, taking the total to 77,000 and eyes a market share of 25%. The stock revs up.
Soon, UPI payments above a certain amount may attract a charge called merchant discount rate to compensate banks for the costs incurred, and amendments to Payments and Settlement Systems Act can pave the way.
Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormas Fatakia. With me as always, Arundhati Raman. And Arundhati, good afternoon.
Hi, Hormas. Good afternoon. You know, the Nifty now below that at 24,497, below that 24,500 mark. And we saw that big divergence because of those new CAS rules, right? So we're seeing that difference there. The Sensex is down 0.3%, but the Nifty down over 1% today.
Big divergence today as well, and a mean reversion, if you can call it that, because of that one sharp spike that you saw yesterday. From 24.59 from 574 to 774 in just one take. And even if you take that level into consideration, the Nifty is at the lows of the day, below the mark of 24,500, technically down around 80 odd points as we speak, today being the weekly options expiry as well. So that is also playing its part. The Nifty Bank was the other index that saw a similar move compared to the Nifty, and in yesterday's session, now below the 57,500 mark. It was trying to hold on to that level yesterday until that very sharp spike towards the close, which took it above the 58,000 mark. So the session today becomes all the more important because of the fact that we are going to have the same closing auction session like yesterday, but today being the weekly expiry as well, that might add to its own fair share of volatility. And of course, for the cash market names, of course, things go as per pace, but there are plenty, and I mean plenty of results that have come in the last few minutes. United Food Brands, Symphony, Keystone Realtors, VRL Logistics. You lose count of the number of results as you're counting down to the end of the earnings season.
Absolutely, and the last 30 minutes of trade is going to be crucial today to watch out for. But on the sectoral front, the media pack is one of two sectors in the green today. Nazara is up 3.5%, Z up over 1% after yesterday's big crash, and Saregama India up 2.5%. But now it's given up some of those gains, about 1% higher in trade. The metal pack managing to eke out some gains there as well. SAIL is up nearly 4%, Hinzinc up nearly 2%, and Hindalco Industries up 1.5%. The top losing index is that Realty pack. Prestige and Oberoi seeing cuts of over 3%, while DLF is down over 2% in trade. Private banks also not doing well today. HDFC Bank, ICICI Bank, Axis Bank, all of them over 1% in the red. The IT pack also giving up their gains and in the red today. But our top focus today, LIC shares fall after the government launches OFS to sell up to 6.5% stake. Let's go across to Hormas for the details and to also look at other stake sales that the government has done so far. Hormas?
It's received a healthy response so far, has the OFS. In just the first couple of hours, the non-retail portion has been subscribed almost 70% as we speak as of 1 o'clock. But the big news being the fact that the much awaited OFS it was for LIC. The 96.5% is what the government owns. The 3.5% was what they had divested during the IPO. They're planning to sell 6.5%. Of course, this is inclusive of the 4% green shoe option as well, and if in case the entire 6.5% is fully subscribed, then you would end up seeing the government mop up over 31,000 crore rupees through this stake sale. But LIC is not the only company that they have done stake sales this year. Look at Coal India, BHEL, NHPC, GIC as well. Fundraising of anywhere between 4.5 to 5,500 crores. They raised 3,000 crores from GIC as well, and of course other companies like IRFC, NLC India, Central Bank, this taking that total mop-up so far to around 23,000 crore rupees through this offer for sale mechanism. And if in case the LIC OFS is fully subscribed over 6.5%, then that will add another 31,000 crores and will take the total tally to over 53,000 crore rupees. That will be a multi-year high for this investment receipts for the government. But if you take into account the fact that the minimum shareholding norms are still not compliant for a lot of the other government-run companies, at least 14 PSUs still have government stake in excess of 75%. And that excess stake, if you take it via the current price, is valued at almost 1.4 lakh crore rupees across these 14 companies. Which are these 14 companies? Of course, LIC continues to lead the pack. We are taking the stake at 90%, assuming that the full OFS is subscribed. Even that excess 15% stake is valued at over 76,000 crore rupees. Indian Overseas Bank also at 92%. The excess stake valued at over 11,500 crores. IRFC, FACT, Mazgaon Dock, they have anywhere between 6 to 10,000 crore rupees, that excess stake that the government owns. So the government's disinvestment drive has been gathering pace over the last couple of months. It continues to do so as well. And the government definitely being in mission mode when it comes to disinvestment this year.
All right, Hormuz, thank you so much for taking us through those details. Now, shifting focus to India's UPI payments ecosystem, the Finance Ministry has gone ahead and proposed to amend the Payment and Settlement Systems Act. The proposal has raised questions over whether UPI transactions could become chargeable again. My colleague Ritu Singh is joining us with all of those details. Ritu?
Well, let me start with the fact that UPI payments, especially for consumers that you and I do, that remains free. There's no question on that. But the government has proposed a legal change that can pave the way for charges on certain UPI transactions in the future. Now, the proposal changes Section 10A of the Payment and Settlement System Act that currently mandates zero charges on certain prescribed digital payment modes. And that protection is linked to Section 269 SU of the Income Tax Act, which requires eligible businesses to offer the prescribed electronic payment modes. Now, the government wants to remove this link and instead give itself the power to notify which payments modes must remain free. So simply, this change will not really bring MDR on UPI immediately, but it will create the legal flexibility for the government to potentially introduce charges later. And that is why the industry sees this as a precursor of sorts to MDR on UPI, particularly for large merchants. Now, we understand the structure that has been discussed could include, P2M transactions, that is person-to-merchant transactions of more than 2,000 rupees, while smaller merchants and, low-value transactions, they will remain MDR-free. Jefferies estimates that an MDR, it assumes a 15 to 30 basis points per transaction, can create a revenue pool of 5,000 to 10,000 crore rupees for payment platforms as a whole by FY28. It says transactions of more than 2,000 rupees account for just 4% of P2M transaction volumes, but 67% of the value. Now, typically, if you look at MDR, how it's structured, it is shared across the payment ecosystem. So that will include the merchant's bank, the acquiring bank, the UPI app, and the payer's bank as well. And Jefferies estimates that payment platforms like Paytm, Pine Live, etc., they can retain around 5 to 10 basis points of the fee. And for companies like Paytm and Pine Labs, that could create a meaningful revenue stream. In fact, it estimates 300 to 700 crore of potential revenue for Paytm and 50 to 150 crores for Pine Labs.
Ritu, thank you for that update there. Now, shifting focus to the high flyers of the day, Ather Energy and KI Industries both buzzing on the back of strong results. Earlier today, we caught up with the management of both the companies to understand where the business is headed for the rest of the fiscal. Take a look.
Our focus is not market share because temporarily we can't do anything about it. Our focus is on ramping up capacity. By end of Q4 or early Q1, it would have ramped up to its full max capacity of 42,000 a month, which will take our total net capacity to 77,000 units. Before this demand surge happened, we were already comfortably getting to 19-20% market shares. We still have hundreds of stores to add, and we have our new product EL going live in a few weeks. So we believe the rightful market share should be north of 20%, probably north of 25%. But it will take us a few quarters with new capacity to get to that market share.
We would try to achieve anywhere between 11 to 12%. Earlier, we were always giving guidance between 10.5% to 11%. Now I can say that we will be able to maintain it between 11 to 12%. And I mean, maybe that if the volume growth is from the new facilities comes up much bigger, then it may improve also. Our export will be close to 16 to 18% of our total turnover this year. The first quarter numbers are less because our export to Middle East was impacted badly, and also exports to United States was also impacted due to tariffs. Now we have a very strong export order book and a very healthy book.
On that note, it is time for us to head into a short break, but more news and updates coming up on the other side. Stay tuned. Welcome back. You're still with us on Business Lunch. E20 fuel is under the scanner. In a letter dated July 28th, the auto industry body SIAM has flagged a sharp rise in fuel injector and pump replacements and pointed to chloride and moisture contamination as the culprit. CNBC TV 18 Shivani Bajaj has the details.
Well, fuel contamination back in news. Sources have told CNBC TV 18 that the government has swung into action after the automobile industry flagged serious concerns over fuel contamination in E20 fuel. The concerns are detailed in a letter written by the industry body SIAM to the Ministry of Petroleum as well as Natural Gas, assessed by CNBC TV 18. Now, according to this letter that we have seen, automakers have reported a sharp increase in the replacement of fuel injectors, of fuel pumps, EGR valves and exhaust components. SIAM says field investigations have traced these failures to corrosion and wear caused by high chloride contamination in E20 fuel. So these are alarming signs. Following these concerns, sources tell CNBC TV 18 that the government has held a series of meetings with oil marketing companies as well as automakers and has directed OMCs to strengthen fuel quality and monitoring at petrol pumps across the country. SIAM says fuel samples from vehicles vehicles showed chloride contamination of up to 500 mgs per kg, while some retail outlet samples recorded levels of up to 350 mg per kilogram. It has also flagged excessive moisture in E20 fuel, warning that it can cause phase separation and leave vehicles stranded immediately after refueling of such contaminated fuel. The industry body has urged the government to prescribe mandatory chloride limits in fuel specifications, identify the root cause of the contamination, and also tighten quality checks across retail fuel network. Back to you.
Shivani, thank you for that update there. Now, the RBI's Monetary Policy Committee is meeting tomorrow. Ritu is now joining in with the key expectations. Ritu.
Well, this RBI policy is shaping up to be less about the decision itself and more about the message that comes with it. All of the respondents to our poll are unanimous on what they will not see in this policy, and that's a rate action. The view is RBI still has enough room to wait and watch the incoming data and see the impact of all of these global developments before it has to change course. But the bigger debate is on what happens after this MPC meet. Now, 40% of our respondents believe that RBI will not hike rates in this financial year, but the remaining 60% do expect at least one rate hike. And if the RBI does hike rates, the economists that we spoke to don't really expect it to happen immediately. Most believe that the earliest move would come in October or perhaps even later, which will give the central bank more time to assess the impact of all of these developments. On growth, the economists are not really expecting RBI to change its view just yet. 7 in 10 believe that the central bank will retain that 6.6% GDP growth forecast for the year, with very few expecting some sort of an upward revision. Now, it is a similar story on inflation as well. Most of our respondents are expecting RBI to stick with that 5.1% inflation forecast for now, which also explains the expectations that are being built around the governor's tone. Now, a strong majority believe that there will be a balanced wait-and-watch messaging. In other words, acknowledge the risk, but avoid committing to any particular direction on rates just yet. On liquidity, despite that FCNR rush and other foreign inflows, most don't really see any liquidity-linked announcements in this policy. The view is RBI can always step in later if excess liquidity starts building up. Now, the real focus is going to be on the commentary. The investors are going to be watching out for cues on future rate path. Most importantly, RBI's assessment of inflation, growth, how it plans to manage liquidity as these foreign inflows come in, and whether it continues to stress its commitment to bringing inflation down to the headline 4% mark. Those signals could end up having a much better, bigger impact on markets than the policy decision itself.
So, Ritu, there with what we can expect from the MPC tomorrow. In fact, let's take a look at where members of the CNBC TV18 Monetary Policy Committee see repo rates headed. Here's an outlook.
What will the MPC do to the repo rate on August 5th? First, Samiran, your call.
No change.
Okay. Sonal, your call.
Hold.
Saumya.
Hold.
Ajit.
Hold.
Dr. Sen, the committee is already overwhelmingly hold.
Hold.
Hold. All right. So that's a unanimous vote, exactly as our poll also suggested. The other question is, okay, if there is no rate hike or cut in August, how many rate cuts or hikes are you all expecting in calendar 2026? So, Sonal?
None.
None. Okay, no changes in rates. Samiran?
No rate hikes in 26, more likely 27.
Okay. Saumya?
No rate hike.
Okay. Sajid? You have to repeat it. I think you're on mute.
No rate hike, though the risks are increasing.
Okay. So that's hawkish. Dr. Sen?
One rate cut possible.
Ooh, okay. That makes it a divided house.
Take a short break then. More news and updates follow on the other side. Stay tuned. Welcome back. On to updates from West Asia. Then US President Donald Trump says that talks with Iran are underway, warning that the negotiations are Tehran's last chance to secure a deal to end the 5-month-long conflict. Speaking to reporters, he said that Iran faces a decapitation if it doesn't strike a deal, and that he plans to open the Strait of Hormuz literally by tomorrow. Listen in.
Maybe get something, but I want to give him every last chance before decapitation. Very tough to do what we have planned, still planned. We'll see what happens. But it's a very, very tough thing to do. I think I'm very proud of the fact that I'll give people a chance. This is a big move. To do an attack that big on a country, I'd rather not do it. Now, we've already, through lots of large attacks, but they were normal large. Hopefully they'll come to their senses, because what happened cannot have a nuclear weapon, but hopefully they'll come to their senses. When we talk, we say we're talking. If we're not talking, when you ask me, no, we're not talking, I'll say it. But we are talking right now, we're talking, and we're talking at the request of Iran, backed by Saudi Arabia, backed by UAE, and backed by Qatar in particular, but others also. We're talking about the Strait, the opening of the Strait, having it open literally by tomorrow, completely open. And that's phase one. And phase two is we then will talk about the nuclear capacity, the nuclear, as we've been mentioned. Basically, it's, I think, the denuclearization.
Meanwhile, Tehran denies holding talks with Washington, saying it is speaking to Oman about the Strait of Hormuz. It says progress has been made to provide a temporary safe route in the waterway. Now, the U.S. military says it is continuing to strictly enforce its blockade of Iranian ports and has so far redirected 44 commercial vehicles, disabled 2 and boarded 2 others.
Well, the numbers continue to pour in, and I guess that is possibly the bigger focal point right now, even as the markets continue to remain choppy. Look at United Food Brands, that's locked in a 5% upper circuit after profitability returned this quarter. The operating performance was also strong. Margins have expanded as well. The stock is up 240% this year already, is the United Food Brands. Of course, erstwhile known as Barbecue Nation, the stock doing well, and Keystone Realtors as well. Numbers coming in just a few minutes ago, and the stock is up 8% as we speak, among the top gainers in the broader markets today. So 7.5% higher on Keystone Realtors. And of course, Ather Energy continues to remain 15% higher among the top gainers in the broader markets as well. What's at a 52-week high right now is Deepak Fertilizers. That one continues to move higher, and KEI Industries has moved to the highs of the day, 7.5% higher after the management clarified that the Sanand plant revenue is going to be between 1,500 to 2,000 crore and not 3,000 crore as they had earlier projected. Take your leave on this edition of Business Lunch. Plenty of earnings still coming up, so don't go anywhere. On the day I take your leave, but Midcap Radar comes on the other side.
Good afternoon, welcome to Midcap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra, with me as always Vivek Iyer. Vivek, good afternoon. Well, after that last minute stellar rally yesterday, a lot of those gains, markets have paired them off, and we are starting the show with the Nifty at the day's low. But earnings, they continue to be the center of attention again today.
Right, good afternoon, Sonal. They're not trickling, they're gushing in, especially when you're talking about the mid and small cap spaces. Our small cap index is the only index that's managing to hold out above water at this point of time. But a lot lined up on the show, an important corporate conversation as well. So let's start off with the top headlines. Benchmark indices trade with cuts, with the Nifty falling below the 24,500 mark. IT, auto, realty dragged the most, while metals emerge as the sole sectoral gainer. Broader markets underperformed.
A strong show in Q1 for GE Shipping. Net profit sees a multifold jump aided by growth in its shipping business and improved operating margins. Stock rises 3%.
Earnings-led sentiment on restaurants brand Asia. The company records quarterly revenue and EBITDA at record levels. The India business outperforms with 24% top-line growth. Stock surges.
A muted show in the June quarter for Torrent Power. Profit sees a 10% downtick while margin remains flat. LNG disruption impacts thermal power plants and higher finance costs dent profits.
A steady show in Q1 leads to a positive move for Minda as shares trade with gains of nearly 3%. The company's revenue sees a healthy growth of 24%. Auto volume remains strong. EV momentum continues.
Okay, all right, those are the top headlines that we are tracking. The bigger headline being what's happening on the benchmark index, which is at the day's low. The broader markets too are under pressure, but they are not falling as much as the Nifty for now. Small cap index is the other one, which is on our radar on the back of continuous earnings, which are trickling in. But yes, it has come up from the highs, but still in the green, outperforming the benchmark index for now. But as I said, the markets are shrugging off the worries around West Asia development for now, at least, yes. But earnings, massive reaction here.
That's right, and also equity supply today of almost over 34,000 crores is something that's keeping the market on edge. All of the insurance names today, LIC, HDFC Life, ICICI Prudential Life, all of these names, especially the life insurance names, all of them under significant selling pressure. But this is our special segment, Mid-Cap Movers. Upasana is standing by the wall to take us through all of the mid-caps that are moving around in the session.
Well, certainly the Nifty mid-cap index is down about 0.5% as we speak. Let us first focus on the top gainers in today's trading session. Topping the list is CG Power, up nearly about 6%. Then SCI, which is up nearly about 3%. Data Patterns has also seen a good move, up nearly about 3%. Bajaj Electrical is the next one on our radar. It is one of the key volume buzzers today. Volume up 12 times the weekly average ahead of its result. And lastly, the sugar stock, that is Awadh Sugar, and also the other sugar stocks, they continue to extend gains that was seen in yesterday's trading session as well. Now let us look at the key focus on the companies that we are seeing the positive and the negative result reaction to. Stovecraft up nearly about 1%. Unimec Aerospace is seeing a sharp run up of nearly about 5%. D Developers, DOMS and Motherson Wiring taking a hit of nearly about 4 to 5%. Now on the flip side, let us look at some of the top losers in today's trading session. Mind you that the Nifty Realty Index is also under pressure today. Kalpataru Limited, Oberoi Realty, both of them are down nearly about 4%. Manappuram Finance, MRPL and UPL seeing a sharp cut of nearly about 3 to 5%. So overall, these are the stocks that we are keeping an eye out on.
Okay, all right. Thank you, Upasana, for joining us as always. So those are some mid-cap movers that we are tracking very closely. It's a good time to get a technical check on the markets. Dharmesh Shah of ICICI Securities is joining us for just that. Dharmesh, good afternoon. Thank you so much for joining us. Do you expect some major moves again, the way we saw yesterday in the last hour of trading? What are the next important levels on the Nifty?
Good afternoon, Sunil. Absolutely, I think so the way the market seems to be panning out. The week started on a very strong positive note, but we believe, I think so, today's, I think so, Nifty seems to be facing some bit of a selling pressure around 24,600. Going forward, what we believe, I think so, sustainability about 200-day moving average is important, and which we expect to hold. And overall, I think so, the way the things are panning out, if you look for the market for last 14 days, we have seen a good correction from 24,600 to almost 23,600. But this 14 days of fall is getting retraced in just 6 trading sessions, indicating a more of a faster time of retracement, more of a positive bias going forward. So yes, faster retracement supported by falling the crude oil prices. And again, I would say from the monthly perspective, July was the first month where the market made a higher high, higher low on the closing basis on the monthly. So all this indication indicates, I think, so the going forward market should be look for target of around 25,200 to 25,500 by end of August. So overall, I think so the way any dip towards 24,000 to 24,100 should be looked as a buying opportunity. As far as today's Nifty is concerned, yes, some bit of a selling pressure cannot be ruled out. And from the intraday perspective, again, from the Nifty spot, 24,400, 420 remains to be the very strong spot.
Okay, Dharmesh, those are your views as far as the markets are concerned. What are your individual trading picks for the day?
As far as individual pick are concerned, yes, we remain to be constructive, positive for auto sector as a whole, where Hyundai again remains to be our top pick. Again, Hyundai, if you look from the medium-term perspective, the stock has been most underperformer inside the auto space, has been trading in this range of 1850 to 2000. Finally, has witnessed a breakout with a strong gap up opening, sustainability about 200-day moving average, with strong sets of volumes, indicating I think so a long way to go for Hyundai. But from a short-term perspective, I think we expect the stock to head towards 2320, getting a stop loss of around 2180. So Hyundai is one which we like inside the auto space. Apart from Hyundai, again on the microfinance side, we remain to be constructive, positive for Ujjivan. Again for Ujjivan Small Finance Bank, on the monthly chart, if you look, I think the stock has witnessed a cup and handle breakout, supported by strong sets of volumes above 72. We believe, I think so, any dip towards 68, 69 should be looked as a buying opportunity for target of 81, keeping a stop loss of 67. So Hyundai Motors and Ujjivan Small Finance Banks remains to be a top pick.
Okay, all right, take that point. Thank you so much for joining us, Dharmesh. So those are some technical bets. More numbers coming in. REITs absolutely flat with some negative bias for now. Net profit up 7.5%, but there has been a decline in margins on a YOY basis. The stock has come up from the highs. We'll look at some more internal details for this one, but for now, we'll slip into a break. When we come back, we'll connect with the management of DE Development Engineers to discuss their Q1 numbers and the road ahead. Stay tuned for that.
Welcome back to Mid-Cap Radar. Whole host of results, as you can see on the bottom of your screen. Bharat Seeds has seen an EBITDA jump up of almost 30%, stock higher by almost 4% in the session. But an important corporate conversation is lined up like we promised. D Development Engineers has seen a bit of correction in trade. This is despite reporting a stable set of Q1 results. Revenue saw a jump up of over 31%. EBITDA margins expanded as well. To discuss this as well as the outlook for FY27, we are joined by Mr. KL Bansal, who is the CMD at the company, to discuss more. Well, good afternoon, Mr. Bansal, and thank you so much for joining us. Well, first up, let's do a quick hygiene check. At the start of the year, you had given a revenue guidance or a top-line guidance of 1,500 crore rupees. Is that something that you continue to stick to? And also the EBITDA margin guidance of 19%. Both of these after Q1 seems a bit off, or the implied ask rate is quite high, but would you stick to the guidance?
Still, it remains the same. We are absolutely on track as far as top line is concerned and EBITDA levels are concerned. Historically, Q1 is always the lowest. But still, we have performed much better than our year on year. We have growth in revenue. We have growth in operating EBITDA. We have growth in PAT. So, I will again reiterate that we are absolutely on track, that we shall do minimum 1,500 crores and with 19% plus EBITDA by close of this year.
Okay, all right. So you stick to your guidance for FY27 despite a muted Q1, which you say is always the case for Q1, and you cover up for it in the next quarters. Wanted to speak to you about piping revenue, which grew 33% on a YY basis, but the EBIT margins were up only 37 basis points. Why is the operating leverage here not kicking in? What kind of margins will the piping segment see going forward? Explain to us what the plans are in that particular segment.
When you're on proportionate basis, once your top line is little lower than, the average numbers which we perceive for the whole year, the percentage definitely rises, that's the only reason for that. Otherwise, there is no other reason that, your fixed cost is always there. So, but as far as all other factors are concerned, they are well within control and they are well within our, stipulated figures also. So we don't see any reason that there should be any concern on meeting the numbers till the end of the year. We are 100%, I will say that, certain that we shall be meeting those guidelines which we have already given.
Okay, so on track to meet all of the guidelines. Well, just deviating for a little bit, there, like you mentioned, there's been a bit of a confusion related to an approval, from shareholders as regards to a 2,000 crore rupees loan. What is the entire development about, and can you clarify exactly on what this particular item entails?
It is some sort of a regulatory requirement that, whatever debts we have taken from the bank earlier or even existing, which are right now not more than, I think, 1,100 crores, which is the sanctioned limits. And the total debts may not be more than 800 to 900 crores on our books as of now. So it's just a regulatory requirement that we have to give an undertaking under that particular section, which is mentioned in the board resolution, that if we are not able to pay the debts, the bank is free to convert the debt as on that date to the equity. So, that's just a regulatory requirement. Why this confusion has come, it's beyond us to understand. But there is absolutely no new debt is there. Whatever we had promised, we are just sticking to that. There is absolutely no thought also that we shall go in for any new debt. So, it is just some sort of a confusion which I am trying to elaborate, which I am trying to clarify, that it is nothing new. It is just some sort of a regulatory requirement which was required to be fulfilled earlier, but since it was not done earlier, we have done it now. That's the only thing.
Got it. So your debt remains between 800 to 900 crore rupees. There's no additional debt that you've taken.
Yeah, there's no additional debt.
And the cost of debt also remains the same, Mr. Bansal. What is it currently?
It's by end of quarter, it's almost around 600 crores only. 600 crores.
Okay, that is the debt for now. That's the gross debt or the net debt?
It's a net debt.
Okay, and what is the cost of debt that you have?
It's less than 9%, ma'am.
Oh, okay, all right.
Oh, okay. Let's talk about business then, after that particular important clarification that you've given us. Give us a sense of the current order book, close to 2,000 crore rupees. After Q1, what have been the orders that you've booked? end of FY27, where do you expect orders to stand at?
So we are already standing at around 2,400 crores of order book as of now. And we do expect that, when we close the year, we should be anywhere around 3,000 crores.
Okay, you had given a 2,000 crore FY27 order inflow guidance. So you're moderating that slightly, or you're sticking to that? I mean, there would be a proportion of the order book that does get executed this year as well, right?
No, I am telling you that this 3,000 crores worth of order book should be there after execution of this 1,500 crores.
Okay. All right. Yeah, get that point. The export order inflow was expected at around 1,000 crore rupees for FY27. How much of it has already happened in Q1? What is the current mix that you're seeing? And are the concerns around West Asia crisis over? Are you able to bring back the export growth that you used to see earlier? How is the situation in that market?
Ma'am, we are on status quo only. We continue to have almost more than 50% share towards export. We are bound to do more than 50% of our turnover in this year also. And, the incoming order flow is also aligning to that target only, that, the inflows are almost equivalent to 50% of our total order book at any given time. And the same case is even now also. And we do not foresee, and we have not seen any, adverse impact on this for this war, ongoing war. So, we are absolutely, as a matter of fact, I will say that we are not concerned on what is going on at this particular moment. It may have something in future, but right now we have not faced any. And we are completely insulated against any such thing for the coming quarter, as we have all the materials available with us. And most of the materials which are going are either in the domestic sector, or they will be going to the Western hemisphere in the globe. So, they have decided on some other routes. We are not affected by any shipping routes also. Of course, the cost is little higher, but that cost is borne by our customer.
Okay, so it's a pass-through as far as higher costs are concerned.
Yeah, well, because it's in their scope only. I mean, the freight, our terms are FOB basis only. So for sea freight is in their terms only, actually.
Now, given the fact that, you have a higher proportion of exports in the order book, more than 50%, like you just mentioned, going forward, what is the aspirational EBITDA margin number we can look at? And number two, last time around, you had also mentioned, 120 to 130 crore annual revenue contribution from a US-based EPC client. What is the status on that front?
I couldn't get your question, sir. Sorry.
First is the aspirational EBITDA margin target. And number two, last time around, you had mentioned that you expect an annual contribution of 120 to 130 crore from a US-based EPC client. What is the update on that front?
It still remains the same. EBITDA levels, as I told you in the beginning, we do expect that we shall be crossing 19% line. And, as far as the export orders are concerned, we are already standing at more than 60% of the order book right now. As far as the exports are concerned, I think you are talking of seamless plant. You are not talking of the other thing. So seamless plant also, we have told that we should be doing a revenue of almost around 200 crores, and we are aligned to that also.
Okay, take that point, Mr. Bansal. Thank you so much for joining us today and taking us through your plans for FY27. So the company sticks to its guidance for FY27, and there's no extra debt on the books. It stays at 600 crore rupees in terms of the net debt figure for now. We'll slip into a short break. When we come back, we'll get you more on the markets, talk about some more stock-specific moves. Stay tuned for that. Welcome back. You're still tuned into Midcap Radar. Well, some very important flashes at the bottom of your screen. This is a clarification which is coming in from the Ministry of Petroleum and Natural Gas, where they talk about how fuel quality across the board is monitored on a regular basis by all the three oil marketing companies, and advanced and elaborate testing protocols are already in place. And they say that further checks have been instituted, which talks about testing 8 to 12 times a day. This is across 87,000 outlets. They have tested over 2,000 samples. They have been tested for chloride and sulfide, because there were media reports, according to them, which were suggesting that this is something which is causing corrosion in engines and causing some issues with the parts of a vehicle. They say only 2 cases of chloride contamination have been found in the entire country till now, and sales from those pumps were suspended immediately. So these issues have been addressed at length. They also talk about how OMCs have been instructed to take proactive steps to detect any possible contamination in the entire fuel supply chain. So this comes on the back of some clarification where the oil ministry is conveying to the users that there are no such issues around contamination when it comes to chloride and sulfide, which could be possibly corroding the material of any vehicle or causing issues with respect to mileage. Only 2 of them were tested that way, and those operations have been suspended immediately. And talking about number of checks being done across the outlets. So here the number that they've given is around 2,000 samples across 87,000 outlets is what they have checked.
Well, very, very important flashes that you've just addressed. Very important to note this: the quality of fuel that you're receiving at petrol pumps, and continuous testing is being done, is what the oil ministry has been saying. But moving on, one particular stock in focus is actually KEI Industries. This is after the company revised its FY27 revenue contribution from the Sanand plant during its conference call. Upasna, listened into the call. Upasna, what is the clarification the management gave?
Well, one of the important clarification coming in, which management has clarified during its earning call, that FY27 revenue contribution from the Sanand plant will be in the range of 1,500 to 2,000 crores versus the 3,000 crore guidance shared by the management today morning post its Q1 numbers. Now, let us look at some of the other important con call highlights given by the management. Management said that the export growth remained muted, as we knew, but this was mainly because of the non-execution of several orders from the Middle East and also the custom duty on US. It has also guided that the exports will grow substantially in the upcoming quarters. And now coming to the total capex, it has incurred total capex of 1722 crore till 30th of June, and it expects another 300 crore of capex to be spent in FY27. Now, the Sanand capacity addition is taking time to ramp up, which is why the inventory levels are high, is what the management highlighted, and it is hopeful to grow 20% plus in the next 2 to 3 years. That is the medium to long-term guidance given by the company. Now, talking about the capacity utilization of Sanand, it says that the Sanand phase 1 capacity utilization has reached 50% of the capacity, and it is likely to improve in the upcoming quarters, and which is when the revenue recognition will also improve going forward. Now, let us look at the FY27 guidance given by the management. It sees the revenue growth in excess of 25% for FY27 and has also given a margin guidance which is revised higher to 11 to 12% versus 10.5% to 11% given earlier. And also it has indicated that the export, which was the key pain point this quarter, this contribution of the overall turnover will be in the range of 16 to 18% on full year basis. So certainly a stock on our radar, a lot of clarification and highlights given by the management.
Well, thank you so much, Upasna. We had the management as well. A slip of tongue happened, post which there was a clarification coming in the conference call. Been on top of all of the developments as far as KEI Industries is concerned. Cooled off a little bit after hitting intraday high. But with that, it's all the time we have on this edition of Midcap Radar. MF Corner when we return.
afternoon. You tuned into MF Corner on CNBC TV 18. I'm Vinny Motiwala, and along with me, Sonal Bhutra as well. So, good afternoon to you.
Good afternoon, Vinny. And India's top 50 companies are getting a fresh ETF wrapper. Jio BlackRock is launching its Nifty 50 ETF with the NFO open this week. We'll discuss the valuations, pricing, and the field of existing Nifty ETFs, all in focus. Who should look at an ETF when it comes to this particular category? To help us understand more about this, we are joined by Sid Swaminathan, who's the MD and CEO at Jio BlackRock Asset Management. And before we come to you with a lot more questions, just giving a brief about the NFO to our viewers as well. This particular NFO opens on 4th of August. That's actually today, and it goes on till 11th of August. We'll be representing 50 largest stocks of Indian market with total market cap of around 53.7% of the overall market. The 50 companies span across 13 sectors. It's basically the Nifty 50 index, which will be the underlying in this particular ETF. The interesting data in the presentation was about how the sector composition has changed in last 10 years. Financial services has emerged as the most dominant one, and we of course have seen IT going down substantially as well from highs of 2000 to 2010, and sectors such as autos, oil and gas, which were dominant during inception and first 10 years, are much smaller. And I track the oil and gas space. I've seen how most of these constituents are moved out of Nifty as well. So we've got interesting entrants here. We have Eternal, new age companies, all of them making way in this particular space. But Sid, always a pleasure speaking with you. So thank you so much for joining us in the studios today. When we talk about such passive funds, right, usually what we track is tracking error. We talk about expense ratios as well. So what will the actual expense ratio be here? How do you differ it versus other Nifty 50 ETFs which are already in the market? Because that helps an investor make a balanced decision as well.
Yeah, firstly, thank you for having me. Always happy to be here, and it's a pleasure. So I think, yeah, that's a very relevant question, and there's a few layers to it, right? So from a tracking as well as a let's call it a pricing perspective, we want to price this as competitively as possible. Now the actual pricing will come out when we get through the NFO period, but that's kind of how we see it. But especially for the ETF, and I think this is something that not everyone is naturally kind of aware of in terms of what is the total cost of ownership. That's kind of how we look at it, right? Because there's multiple layers to an ETF versus just a regular mutual fund. So to simplify, there's three things really that we look at. So one is the actual expense ratio. So everyone knows that, everyone understands that. The second is, you pointed it out, is the tracking difference. So that's actually like how close can the ETF track that index? Because ultimately that is what we're trying to do here. We're trying to get you or the investor returns that are as close to that index as possible. It's never going to be perfect because there's real life, let's call it challenges like transaction costs, et cetera, but we want to try and get as close to that as possible. So, there is somewhere where, again, different, let's call it ETF issuers or asset managers can differentiate themselves into what kind of techniques they use to maximize that kind of return in terms of how close we can get to the benchmark. So that's something that we really pay close attention to. And then the third actually is the exchange dynamic. Now, ETF by definition is exchange traded. That's what they're called, ETFs. So when you actually when individuals go to buy or sell these, there is an exchange price of the ETF, right? And that can actually have an impact as well, because it's not just a single price that you see on the screen. You buy at the bid, and you have the other side of it as well. So that is important. So how liquid these instruments are on the exchange is also a very important dynamic. And you can see differences even with the existing ETFs, but not all of them have the same bid-offer spreads. So that's another area that investors need to look at. And also from a, let's say, manufacturer perspective, we pay really close attention to. And that has a lot of dynamics around, how do we have the right market maker ecosystem? We can get into those details, but we want to keep that as tight as possible so that 1 + 2 + 3, the expense ratio, the tracking difference, plus the exchange bid offer is as small as possible. That's the total cost of ownership.
Okay, point taken there. Sid, overall ETFs now have been picking up pace, right? Do you think retail investors are going big on ETFs versus pure mutual funds? Is that what you're seeing on the ground, and is that the trend maybe that's shaping up now?
Yeah, I still don't see it as ETF versus mutual funds. I think it's one and the other.
But bridging some bit of that gap, right?
Yeah, and it's a relevant question. So if we look at some of the numbers, right? So Currently, the overall kind of passive universe is about, let's call it 15 lakh crores is the AUM that we have in passive, which is what, 18% of the industry. So that's, come a long way in the last sort of few years. The split between that is majority ETF. So 11.5 lakh crore-ish is about ETFs, and the remaining 3.5 is index. But then within the ETF, there's another layer, right? So of that 11.5 lakh, almost 90% of that is actually institutional. So institutional, like big pension funds, etc., corporates are big players in the ETF market. So if I actually look at retail, there's about 1.5 lakh crores of retail in ETFs and 3.5 lakh crores of retail in index funds. So if you look at it that way, actually, it's still a big, index funds are still a big retail play. Now, they have different use cases. So, and this is one of the important points on why ETFs versus mutual funds. For someone that's, let's say, just starting on their investment journey and wants to adopt, okay, I want to get exposure to the market, I want to set and forget it. The index mutual fund is probably still the best way to do it. You can do it very easily through SIPs. You can stay invested, stay consistent. We all know that's a fantastic story. But for a slightly more nuanced investor who's already into kind of the, let's call it the DMAT ecosystem, likes that intraday tradability, likes that liquidity to see, okay, I can trade in intraday, I can express my views faster, move faster. ETFs is like the perfect vehicle for them to do that. So it's actually solving different use cases for different types of investors. And that's why I think there's room for both. Now, taking one step back, just looking at the ETF on its own, there is still a huge runway, right? Now, if you put some of the, let's call it the global numbers into context, globally, ETFs are at $22 trillion is the AUM globally. And they just crossed 22 trillion, I think, in May this year. So if you convert that from what India has about just over $100 billion. So ETFs globally, 22 trillion. BlackRock alone, the firm I came from here, manages over $5 trillion of ETFs, BlackRock alone. So from a runway perspective, there's a long way for ETFs to go. In markets like the US, ETFs have become the actual choice of investment from a wrapper perspective for retail. So most of retail in the US now goes towards ETFs. Not quite happened here yet, but I think there's a long way for us to go.
And the depth that we have abroad or the US markets is much more than Indian markets for now, and ETFs are not considered the go-to investment asset as yet. Of course, the underlying is still a lot of other asset classes, but yes, as you said, there's a long headway that we have if it comes to ETF as well. Since it is a Nifty 50 ETF and we talk about large cap valuations versus mid caps, let me just stick to large cap valuations. Are you comfortable with the valuations now for you to come with this product in the market right now?
Yeah, so for one of the things we want to make very clear is that we're not launching this now just because we think large cap is super attractive right now. This is a much longer term view that we have on kind of the overall ecosystem, how investors access different products. And if you think, or you said it yourself, right? These are the bellwether of India, right? Over 53%, as you said yourself, in terms of the overall market cap. So if anyone thinks of hey, I'm in the DMAT ecosystem and I want to get access to kind of core India story exposures, this is what you come towards, right? Now, yes, there'll be times when this will be a good time. Like right now, you could argue, well, we've had a little bit of a correction, so maybe it's a good time to enter, but that's not really the goal of us launching it now. We're launching it as it's the bellwether product. We have a full suite of ETFs to be launching in the coming months and years. So we're just getting started here.
Okay, just getting started here, but okay, actually we're going to slip into a very short break. We'll come back after the break and continue this conversation as well. Viewers, do stay tuned in. We'll be back. Welcome back to MF Corner on CNBC TV 18. We still have with us Sid Swaminathan, who is the MD and CEO at Jio BlackRock Asset Management, and we're discussing their new NFO, the ETF that is coming in as well. So it's interesting to know more in terms of details. Now, Sid, we've spoken about ETF as a whole for the industry, the ETF that's coming up as well. But what's the difference between an ETF NAV and its market price, and when can they actually start diverging? If you could help us understand all of that as well.
Yeah, that's a really important dynamic. Happy to get into that. So the NAV is the NAV. I think it's very, let's say, well known. So it's essentially the value, sum total of the value of the securities that are actually in the fund. So that's kind of a more obvious one. The market price is less so. So that's really when you go to the exchange, and that's where these instruments are transacted. What is the price at which people are willing to buy and sell? So that can differ. Now, typically, there is an arbitrage mechanism that kind of ensures that these two don't go out of whack too often, right? Because if you think about it, if, let's say, the market price goes above the NAV, like there will be market participants who can basically do the opposite, right? They can come and kind of create the ETF and then go and deliver it for the price. And that brings the price closer together. So that's the arbitrage mechanism that's set up by the ecosystem to ensure that the two don't diverge. That doesn't mean it never happens. It can happen. So there can be times of market stress. There can be liquidity events. Maybe the participation from the market makers is low. These are the kind of things that can cause the two to diverge. So what issuers like us need to do, because from an investor perspective, you want it to stay as tight as possible. So what we need to do is make sure that, firstly, we have a broad ecosystem of market makers. So people who are actually there on the exchange, like making those prices for our ETFs. So having a wider collection of them is really important. We've engaged for our ETF, like with the biggest ones here. We're actually also talking to some of the more international market makers as well that have worked with BlackRock internationally to come to India and actually grow the ecosystem. That's something that we're working towards as well. And then it's about the technology that you have to interact with the market makers. And here again, we've brought some of the BlackRock technology. We call it ESP, so ETF Servicing Platform. We brought that to India for our ETFs. Which means that any friction that, let's say, an asset manager might have in interacting with the market maker, we can try and automate, make it easier, make it more transparent for them. Because the easier it is for the market makers, the more transparent it is, like what is inside the ETF, the more confidence they have in terms of, okay, I know how to hedge it, or I know how to market make it, and that should bring the spreads tighter as well. So that's the ultimate goal, is to make sure that the market price on the exchange is as close to the NAV as possible. And that's what we're all working towards.
Okay, so while we have spoken about ETFs, and this is one category which is picking up, we were speaking about how we need more products in the ETF space, which India doesn't have so much as of now. But for somebody who's starting the investment journey, and this question comes to us every time because the interest in the mutual fund industry is only increasing by the month. We are seeing that in the AUM numbers as well. What would be the best category for somebody who's starting out right now? Because we do have so many options available. It can get overwhelming for an investor at times. But for somebody who's looking at a long-term investment, what would your suggestion be? I know risk categories are different, it's personal, but just a basic checklist.
Yeah, keeping it simple always helps when you're getting started. And like I said at the beginning, like you can stick to whichever ecosystem you're in. So if you're already in this kind of DMAT ecosystem, and that's a big ecosystem. Like I didn't talk about that. There's over 22 crore DMAT holders here. So that's a huge amount, right? Then start simple with a selection of ETFs. So a core bellwether kind of ETF like the Nifty 50, always a good one to have in your portfolio. You can mix it with a bit more of diversification. So you can go a bit more into the mid cap, small cap if you want to have access to other aspects of the market. Some commodity ETFs to kind of balance out kind of the risk return profile. So you are now starting to see, from a building block perspective, more and more ETFs come to market. So that's good. It can get overwhelming very quickly because you then get confused. But keeping it simple in terms of some equity, some commodity, maybe a bit of fixed income is a great starting point. And then as investors mature, learn more about the markets, learn more about what kind of asset allocation they actually want, what their risk profile is, then they can get into more of the let's call it complex or esoteric products, which are available now in ETF wrapper as well. And on the other side, mutual funds, similar, The only difference there is there's other ways to kind of build their portfolio. You can do it through SIPs, much easier. You also have active funds. So there, I would say, if you want to have like a broader, more active equity core as well, you can think about all the major equity funds like the Flexi Cap, et cetera, that exist in the mutual fund space. But apart from that, you don't really want to complicate things too much when you're just getting started.
Absolutely. Don't want to complicate things when we get started. Simple is the best way to go forward. But, recently, obviously, you all had the SIF launch as well, a month back approximately, Prism Hybrid Long Short Fund. SIF as a category, obviously, it's a new launch, but it comes in with that minimum investment that is required as well, right? So, who should be looking at such a category? If you could talk to us about that as well.
Sure, yeah, when we moved on. So that is complicating it a little bit.
A little bit. That is for someone who is
and there's good reason for it, right? Because in India, now we have, many, many different sets of investors. So you have the investors that we've just talked about, which are the ones that, are looking to just get into the markets, looking to get started investing. For them, simple products, SIPs, basic ETFs, check, job done. But you also have investors now that have been invested in the markets for 5-7 years. They've accumulated a decent amount of wealth by doing that, predominantly through equities. Let's be clear on that. That's where it's all come from in the last 5-7 years. And now they're in that, let's call it more nuanced state where they're looking at, okay, that's great, I've accumulated this wealth. I've now had about 18 months, 19 months of the equity markets not doing much. How do I get exposure into my overall portfolio that is more all-weather, right? And that's where something like an SIF comes in, because it allows the usage of derivatives. So it allows the underlying funds to be more positioned towards generating some kind of returns outcome regardless of what's happening in the market. So something like a hybrid. And when you look at the SIF numbers since launch, so we are at what, month 10-ish since the category launched. About 18,000 crores of assets have come in, which is a great start for a category that started from 0 10 months ago. More than 13,000 crores of that 18,000 are in the hybrid category. So that's the recognition from the market that this is the category that's giving me these kind of consistent, steady, let's call it between 9, 10, 11% returns for lower risk, regardless of which way the market's going, up, down, sideways, right? So it's good to have a certain allocation. We're not going to say put everything in there, but have a certain allocation to those kind of funds. And that's why you're seeing the more nuanced investors starting to kind of allocate. The minimum ticket size is reflective of that. So it's kind of a selection mechanism, if you want to have to call it, because to be in those kind of strategies, you need to have experience, a certain amount of wealth to get into it. So that's why I think it fits really well for that segment of the investing population.
So if you want to go one step ahead in your investment journey, after you have made like a decent mutual fund portfolio or an ETF portfolio, I think SIF is for investors like that, slightly more informed, slightly more aggressive in their investment avenues. But we have to talk about Gift City, because that's become the new passage to international investments. Do you think this is the place which will become the go-to for investors now that a lot of these LRS limits from mutual funds have been capped, the AMCs that is? And is it slightly more difficult when it comes to compliance? Because compliance always becomes a headache, be it the onshore or the offshore funds. Of course, right now I'm talking more from a retail investor perspective. Do you think this is the go-to for international products?
Yes, for a certain segment of the investors. I always caveat everything with for the right segment, right? And the good thing in India is so many different segments. There's something for everyone. But important development, Gift, right? If you think about the overall market cap of India as a part of a global equity benchmark, we're under 2.5% right now, right? And if you look at kind of the Indian investors' allocation to outside India, now these numbers aren't very available, so it's a bit of an approximation. It's actually less than 1%, right, in terms of their own allocation. Now, we're not saying that actually that's completely wrong because you need to have 90% outside because that's what the global market is. We're not saying that, but it should be more than 1%. So having a more globally diversified portfolio is another way to kind of get a better kind of risk-adjusted return. So that's well recognized. Now, it's been constrained because of the cap that you've talked about, and Gift kind of allows that access. It's starting to get more and more, let's call it streamlined. I'm not going to say it's without friction. I think the onboarding can still be a challenge. The FX can still be quite expensive in cases. So we're trying to work on these solutions to make it easier for people to onboard so that they're not paying up to 2% sometimes on the FX charges, make it more efficient. And I think once you create those kind of pathways, then that will grow much faster. So we're working towards that. We've got our entity license. We're working on the funds. So hopefully in the next few months, we'll have something.
So for Gift City, there are minimum thresholds or minimum investment amounts that are actually larger or much more than what we would see in mutual funds. What is the reason for that? Because that's across AMCs.
Yeah, and it's similar to the SIF
yes,
as well, right? It's a similar thinking. The good thing now is you also do have the retail funds that are, let's say, higher than what you have for the domestics. It's not 500 rupees, but it's actually lower than an SIF. So some of them go as low as $5,000, which is less than an SIF. So similar thinking, right? You need to have had a certain amount of experience and overall asset allocation and wealth accumulated to get into these. Because for people before that, there is more than enough in terms of what an asset allocation can be done domestically. It's only after that that you want to start adding into these. But that's why the starting point is there. Again, like I said, as the ecosystem matures, so all of these onboarding frictions and then the FX charges, all of that starts coming down, I think that will open up. And then the funds themselves will also, over time, I think, start lowering their minimum requirements as well. So it's a bit of an evolution that needs to happen. But the high-level thinking is exactly the same as what we have for SIFs.
You know, Sid, just one quick one from me. I want to know 2 categories maybe that we should watch out for that are doing well in the industry, whether it's on ETF sides or mutual fund side that you're watching out for now.
So within categories, so SIF is definitely something that we're looking very closely at. Like I said, the industry is young so far in that space, but it's seeing great growth. We've had a great experience. We launched our SIF last month. We did about 150 crores in the NFO, but we've seen another 20% growth in the week or 10 days after. So we're seeing good interest there because it is satisfying kind of that, let's call it, need for a certain segment of the population. So we're looking at that very closely. And then the second one is international investing. So that's the next big thing that we're also focused on. But one of the, I think the interesting parts about the market is there's always a lot of evolution. So we're looking at retirement. That's something that we're paying a lot of close attention to. We'll be coming out with something in that space in the next few months as well. ETFs, we're just starting to scratch the surface with this launch. There's a long way for that. So we're super excited and super bullish about where we're going to go from here.
A solid lineup is there from Jio BlackRock AMC. So, so definitely investors are looking forward to that. And it's always a pleasure speaking with you. So thank you so much for dropping in and explaining to us different aspects of investing into mutual funds and the ETF landscape as well, because that's growing rapidly in India. Thank you so much for joining us. And with that, it's a wrap in this edition of MF Corner. But stay tuned for Closing Bell to take you through the last hour of trade.
beyond market headlines to understand the reasons for the day's movers and shakers and get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Bit of a mixed opening is what we're watching out for in terms of the Asian markets responding.
I want to give them every last chance before decapitation. Very tough to do what we have planned.
There you can see that one perpendicular line that goes straight up, and that was the closing tick that you saw on the index of that special first day of the special closing auction session.
24,550 is the first resistance, and then 24,940 is the bigger one, which is a projection of the last up move that we have.
The volume growth will also be substantial as the production ramp up is coming up in the new facility.
Basically, the change you're seeing is we are up. We are up from yesterday's close. We're down from yesterday's 330 close, but from the actual 315 close.
My guidance is what I said on the call yesterday. I think there are still going to be a few ups and downs over the next few quarters, but the trajectory does look better.
Pre-UPI is probably out. Some large value payments done through UPI may become chargeable, like, we pay for credit and debit card.
As far as the total OFS itself is concerned, it's been a long-awaited issue which has been in the work.
Well, this RBI policy is shaping up to be less about the decision itself and more about the message that comes with it.
What's happening on the benchmark index, which is at the day's low. The broader markets too are under pressure, but they are not falling as much as the Nifty for now.
That's the day so far, and we are down, 300 points, but technically we're down about 100 points from yesterday's 315. If you cut out the 200-point spike, we are down 100 points. That's the way to look at it. 24,470. This is closing bell. We're coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. Nigel and Rima with me, guys. Hi, afternoon. And if I can just quickly look at the Nifty and take a look at what is happening, I'll give you a quick sense of that. Today is day 2 with regards to this entire CAS and closing auction mechanism. And starting 315, that entire action, which of course yesterday was pretty dramatic. Hopefully this one is going to be a plain vanilla state kind of thing. But the after effects of what happened yesterday is still on your screens right now. At one point you had the Nifty down, the Sensex up, and all kinds of things, because the closing price was inflated, was not real. So, not real in the sense trades executed, but it essentially was not supported by volumes and just sort of not explained in a good enough way. So the mid cap and small cap indices have all come off. I just want to make a quick mention of oil, which I think has come up to about 86 or so, 86 plus. So from a steady 84 in the last 24 hours, there is a bit of an up move which has happened as far as Brent oil prices are concerned. That's the only other macro variable looking at. Otherwise, numbers are coming in thick and fast. Guys.
Well, indeed, I'm looking at some of those numbers. So on the way down, it's Greaves Cotton came out with numbers earlier. The stock is down 12% here. Net profits have come down by 22%, despite a 31% increase in the top line. Margins have contracted very sharply, and you can see that 12% decline in that. The other one is BASF. Very strong number. Good numbers, revenue growth at 28%, but on account of an extraordinary income, a gain on sale of their subsidiary, a little bit, that's contributed to the top line, and that's the reason why the stock price is up nearly 7.5%. The other one is Keystone Realtors. Here, net profit has jumped from 14.5 to 53 crore, and that's another one, a big mover. Restaurants brand Asia, double-digit gain on that. Strong revenues, good operational performance. The company has reported its highest ever quarterly revenue and EBITDA. Top line growth 18%, EBITDA growth 38%. So can't take your eye away from all these earnings reactions swinging on both sides.
Well, that's right. Just take a look at alkyl amines. You know, as we started the show, we just got those set of numbers. I remember, I think Pankaj Shibriwal was the one that was identifying chemical-related names, and he said that could probably be earnings upgrades that come about. I think alkyl amines is one of the stocks as well that they have in their portfolio, if I remember correctly. Pull up the intraday chart. That stock has moved to the high point of the day. Sharp spike out there. You know, the numbers look quite good. They should reflash for our viewers on the screen. And that explains why the stock has just taken off up close to around 9%. Another stock that's actually fallen off the cliff is Maupin Laboratories. And that one now has spiked up to the high point of the day. So Maupin Laboratories came out with a set of numbers, I think, locked in upper circuit. Restaurant Brands Asia as well. You know, you can't get a burger now. It's up close to around 20% as we speak, pending buy orders on both those two names.
Action-packed, 1 hour coming up of trade, 1.5 hour of closing bell. Let's tell you what we have for you. The Nifty has tested the 24,500, broad-based selling seen across indices, barring the small-cap index. A sea of red across sectors with metals bucking the trend. Nestle slumped to the day's low following cautious commentary from the management. In a meeting with analysts, key takeaways coming up. The star of today has been Ather Energy, extending gains on the back of a strong June quarter. Ambitious guidance for the current fiscal. A deep dive coming up on closing bell. And in earnings expected later today, we'll tell you what we're expecting from Bharti Airtel and Marico. But first up, how should you position yourself in the last hour of trade? Mitesh Thakkar joins in as always. Mitesh, net down close to about 100 points before the spurt that we had. So 24,460 on the Nifty. So it's snapping that 4-day winning streak. From here on, what's the trade?
I think on the index now, the breakout which happened was about 24,400. We are practically back there. Now, that's the level which I'm watching. In case we start closing below that, maybe, we'll have some kind of a reversal. But till that level is holding out, I'll assume that the breakout is valid and we might again start moving up after, bouncing back from these levels. So 24,400 is the level to watch. And on the stock side, the Steel Authority is buying. Keep a stop at both levels of 169.5. Look for a target of around 179. And UPL has had some kind of a breakdown, so that's call on the sell side. Keep a stop at about 603. Look for targets of 555.
Okay. Thank you very much for that. We'll come back to you for more trades. For now, Amisha Vora, Chairperson, Managing Director of PL Capital, now joins in. Amisha, morning. Afternoon. Thanks for joining in. So at the PL desk, can you explain what happened to us yesterday at CAS and what should we expect considering today is the Nifty weekly expiry?
I think there was, as I could see, there was a lot of option recovery, short covering by both FIIs and DIIs of their hedge positions. What I can see that once again, we have given in a lot today. And that too, I think, is largely because of the expiry-related adjustments. But the undertone, according to me, both because of the results and because of the breadth of the market, continues to be.
I think we're losing the line, Amisha, with you. Allow us to just fix that because the frame is freezing, the audio is not clear. We'll have both fixed. But let's tackle some of the earnings which have come through in the last 30-40 minutes, right? Nestle is under pressure on the back of cautious commentary. There was Pidilite as well. But Nestle, to begin this, Mangalam, take it away.
Well, for Nestle, the earnings came a lot earlier, and those were a solid set of earnings, which is why the stock continued to do extremely well and has been an outperformer in the FMCG space. However, it's the analyst day which is currently underway, and the company has gone ahead and uploaded their PowerPoint presentation on the exchanges. The one thing that has the street a little worried is the fact that they are seeing near-term moderation in demand. And that is a bit of a concern, largely because of a couple of facts. You're looking at the El Nino-related issues, and at the same time, you are expecting some sort of, overall consumption and F&B growth, which is a watch out as per management in the very short term. Though they're pretty confident of their own growth areas, which is basically penetration-led volume growth, cost optimization via value chain, key investment in brands and capacity scale up. They're looking at tech-led sales and acceleration, typically the kind of stuff that FMCG companies speak about in their analyst days as well, and eventually speaking about disciplined margins and cash generation. But the fact that they are watching demand moderate in the very near term has the street a little worried on account of two factors. One, the stock has outperformed, and over the last 4 quarters, ever since Manish Tiwari took over, the growth of the company has been phenomenal. Look at Q1 FY26, Q2 FY26, Q3, Q4, and this quarter as well. So the revenue growth on a low base has only increased, and the current quarter is the last one where you had single-digit growth as a base on which you've grown 25%. Going forward, can this growth rate sustain or not is a question. And secondly, because of the outperformance of their growth and the stock, it's trading at 60 times FY28 price to earnings. One would say staples anyway are expensive at an elevated multiple, even though the stocks haven't done much. But in that as well, Nestle trades at a significant premium to the industry. So the street thought maybe it's best to take the profits out.
Got that. Mangalam, Pidilite's overall volume growth has come in at 11.3%, and this seems to be bang in line with your poll of 11 to 12%. So numbers in line. I can see the stock move up a bit, up 0.5%. Well,
for Pidilite this time around, the moat has been in their pricing power. For Fevicol or the brand that they have, it's definitely pricing power which is doing well for them. Consistently, the company guides for double-digit volume growth, and consistently they go ahead and achieve it as well. This time around as well, Street was working with a number of 11 to 12%, 11.3% is what the company is reported. But look at the overall performance. The CNBC TV18 poll on the revenue was closer to 4,400 crores, and now the company has gone ahead and reported 4,500 crores. One would have imagined that maybe there could be margin compression because of the sharp surge that we've seen in their key raw material, which is VAM prices, and the company itself guides for 20 to 24%. But guess what? The first quarter they've done 26% margins. The EBITDA is 1,200 crores against the poll of nearly 1,100 crores. And the net profit as well, there's a near 16-17% beat at 884 crores versus 774 crores. Growth has been led by both their B2B verticals as well as their consumer business. Consumer business was the one which was likely to lead growth. But here as well, the real problem is not about their performance, which has been extremely consistent. It's about two things. One, valuation, and going forward, can they beat this 26% margin guidance itself? Because, the company typically guides for between 20 to 24%, and the last couple of quarters, it's gotten at the higher end of that range. So does this now mean that the company will start pushing volumes more and keep the margins in a lower band or not is something that the street will be tracking. So by virtue of its own strength and own high base, the stock ceases to move.
Okay, all right. Thanks a lot for that, Mangalam. Well, let's hop across to Amisha Bora. I think we've got that line fixed. Amisha, how are you approaching the space? Nestle has taken a sharp downtake. Pidilite looked a little bit better, but the stock has come off from the top. Your view?
I think the bit of a worry which has been seeping in is also to do with monsoon, inflation, crop prices, commodity prices is also somewhere it will seep in, and that's why to buy the consumers of commodities rather than maybe a better trade could be the manufacturers of commodity, which is from agri perspective, I would say sugar. Because if you are aware, the way sugar prices have shot up, I think in commodity, most of the gain comes down to your EBITDA and PAT, and the prices have shot up from something like, I feel 36, 37 to almost 47. So we will see more of this. And, some of the other performance also you've been just talking about, for example, Pidilite. As such, we are very bullish. But it is also, the EBITDA is also capturing increased prices and sometimes stock of raw material, which was little earlier collected. But if you see now, it will even out. So expansion of EBITDA margin going to be a question mark for consumer segment in particular.
Amisha, by the way, there was a news which kind of went under the radar, not on CNBC, but generally there was not too much news around it. The government, the cabinet has cleared this national exploration policy. It's called Samudra Manthan. The plan is to spend some 84,000 crore rupees, where the government essentially is going to provide half the cost of drilling an oil well. this is, in the sea. And there's a limit. I mean, there are all sorts of details, but up to 600, 700 crores for 50% of the cost of drilling, which is about 1,000 odd crores a well. And this is 84,000 crores, which the government has said they want to spend by 2031. I mean, it kind of goes back to energy security and, finding more oil within us and, reducing imports and all of that. And if you look at, ONGC and Oil India, which are the two explorers, you'd say, well, what has happened? I mean, the stocks have not done very much at all. They've been reacting to oil prices, and oil prices have been both up and down, and so have these stocks. But then you look at something like a small name called Deep Industries. I don't know if you can pull that stock up. But I was just looking, last 8 days, I think the stock's up about 45%, since this policy was first talked about. And I think, of course, it was cleared after that. Just a one-way move on something like a Deep Industries, which basically is essentially does exactly this, which is, works with ONGC on maintaining wells, helps in exploration, everything which this policy is expected to facilitate. I don't know if you have a view, Amisha, on the policy or, the ramifications. Deep, I'm sure you really don't cover. If you do, would love a view. Go on.
I'll tell you, government did before on onshore policy also a lot. Earlier, it was very much reserved for ONGC and oil. Then they opened it up to the extent that the entire data as to what are the findings on different onshore fields were now available, say, for last 3 years on a government website. And private sector could actually go ahead and bid. So, like Deep Industry, which is into drilling, there is a company called Asian Energy. I think even they would have done very well from the this one, and they were aggressively bidding for this onshore blocks. You're very right. This offshore policy is also extremely positive. And for a large company like ONGC, in the short to medium term, this may not make a difference in terms of when will they find success, what will be the proportion of that success to the current revenue. But Deep Industries also had their fair share of pain, and I know that I've seen them about a 10-year back. They went through the entire restructuring also. But having said that, they have a long experience in this offshore drilling. And these are contracts which are now, under the new regime, very well drafted. When the contracts are better drafted, both the sides will have better clarity. So I think that this is a very positive thing, both for some of these small companies like the Asian Energy. They'll definitely stand to benefit. And I'm very sure there must be many more that doesn't immediately come to my mind.
I want to make one more point. Deep, by the way, also owns about 75% in another listed company called Dolphin Offshore. So that is the other one. So, small companies. Deep is now, I think, 4,000 crores market cap. Dolphin Offshore is about, I think, 1,600, 1,700 crores in market cap. But that's the other kind of same lines of businesses. If you're interested to know more about the policy, you can go to the CNBC TV 18 YouTube page. And we did a program with the former MD of ONGC, another global expert, and Prabal Sen as well, to talk about this policy which has been cleared by the government just about, 8 or 9 days ago. So, this is going to be operationalized. The rules are going to be put out in terms of specifics, etc. But you'll get a broad overview if you're so interested. Just wanted to put that out. Nigel.
Well, let's move and talk about steel prices then. Well, flat prices have remained more or less firm, while rebar prices, they have snapped the losing streak, and that's something interesting. Now, as you can see, both the pricing should come up for you on the screen, which is flat, which is essentially HRC, as well as rebar prices, which are longs. The gap between the two has come down to roughly around 7,000 to around 7,500 rupees per ton. Now, rebar prices, well, they're seeing a fair bit of action as prices have increased by close to around 2,500 to around 3,000 rupees from the recent lows. That's from the lows of mid-July. But remember earlier, they had corrected by close to around 10 to around 12,000 rupees from early May all the way to July, which is a little bit surprising to see that sort of a correction, particularly on the long steel. So an improvement is coming about now in long steel prices after nearly a 3-month correction. And that's where you're seeing that even though it's monsoon season, well, you're seeing long steel prices, the prices are being bid up. And I believe there's another price increase that's being pushed through in this month itself. Now you'll wonder what's causing this pullback. It's monsoon season, longs are more into construction and those sort of activities. Well, there are a few factors are playing out. One is the seasonal shutdown of some of those steel mills. They have shut down because of the monsoon. So there is some supply that's got onto the system. Also, profitability had come down to very low levels, because imagine someone who is making 10-12,000 of EBITDA per ton, and suddenly the price itself falls by close to 10-12,000 rupees odd. So the profitability had come to very low levels, which has caused some of these mills to shut down. And also the domestic flat to long spreads, that had increased to around 10 to around 11,000 rupees per ton, which is very, very high. So that's getting corrected a little bit. And now as we speak, the difference between long as well as flat steel has come down to around 7,000, 7,200 rupees per ton. In terms of stocks that are buzzing around, Jindal Steel is seeing a decent amount of move, not only today, the last few days. SAIL as well as seeing a move even in today's trading session. Remember, both these two, we are highlighting them first because they have relatively higher exposure to long steel in comparison to the industry. But the entire industry will gain because everyone has some portion of their product mix, which is towards longs. So this price increase that's coming about on long steel, well, that's what's going to help a lot of these companies, in particular those that have higher exposure as of now. So that's why you're seeing maybe a relatively better move on SAIL as well as Jindal Steel. Amisha, you want to comment on this? What do you like from the metal space? I'm sure you like gold, but we'll keep that aside for now. Ferrous, non-ferrous, particularly in the steel names, what do you like?
No, I agree with you. See, the kind of what I'm relating a few dots is to the fact that the bank's higher credit growth has been this time contributed by corporate credit growth. So it's been double-digit corporate credit growth after a long time. In this decade that we are seeing things bouncing back, which tells us that no doubt a bit of working capital requirement would have increased, but largely the capex cycle is back in the economy. And when that is back is the time that longs also do better. Of course, we need a very positive government policy regime because this is a very global commodity. But at the same time, the domestic demand continues to be very robust. So we continue to remain with the kind of last quarter's pain or a slowdown a little bit, positive on the sector.
Amisha, what about Ather Energy? Clearly the stock of the day, firing up, very strong numbers. They have so much demand. But they don't have the capacity, but that capacity will come on stream. And separately, even their software business, the non-auto revenues, is growing. Stock is up nearly 15%. And this is a stock, Sudarshan now joins in for it more. Sudarshan, they just did a QIP, 1.5-2 months back. It was at 1,200 and today it's at 1,450. Break down the key triggers, the key takeaways from the chat with the management.
It's been a strong move that stock has been seeing over the last few months, and just yesterday company has come out with Q1 FY27 earnings. Looked very strong on all the parameters. Just if you take a look at the headline numbers, company has reported adjusted EBITDA positive for the very first time. If you calculate on the total income, and EBITDA has come in at 10 crore rupees versus loss of 106 crore in the same quarter last year, and in resultant margin has come in at 0.8% versus minus 15.6%. There is a sharp improvement. Now look at the wholesale volumes. Company has been seeing a very strong growth, and that's also because of the EV theme. EV growth just in July for the entire industry was more than 80%, and for Ather Energy, wholesale volumes in Q1 FY27 have increased by 81%. Registration numbers more than 102% up. Production too has seen an increase of 79%, and quarterly pre-orders up almost 160 crores. And if you take a look at even non-auto revenue, now the contribution is at 14%. Company believes that it might maintain at these levels or slight uptick, but the demand on that front also, because more than 90% of the customers who buy Ather scooters go for this Ather stack that company has named it. And also on the capacity front, company is going aggressive because the demand is so much that company has been unable to match that demand, and because of that they are looking to increase the capacity at a very rapid pace. Now apart from that, EL platform company is looking to launch on 29th of August, and that will mark the entry into the mass segment, and price for that would be in the range of 1 to 1.20 lakh rupees. And apart from this, company also enters F&O segment from the next series. Now all the brokers who have the coverage on the stock maintain positive stance. Nomura has a target price of more than 1700, CLSA has a target price of 1600, and HSBC has a target price of 1450 rupees.
Our focus is not market share because temporarily we can't do anything about it. Our focus is on ramping up capacity. By end of Q4 or early Q1, it would have ramped up to its full max capacity of 42,000 a month, which will take our total net capacity to 77,000 units. Before this demand surge happened, we were already comfortably getting to 19-20% market shares. We still have hundreds of stores to add, and we have our new product EL going live in a few weeks. So we believe the rightful market share should be north of 20%, probably north of 25%. But it will take us a few quarters with new capacity to get to that market share. So if demand does continue to surge up, we will have the option of quickly ramping into phase 2 and taking our total capacity to 14.2 lakh units. So 4.2 lakh units, 5 lakh units, and then incremental 5 lakh units, total 14.2 lakhs. So if we do have to do phase 2, we do not believe that we'll have to raise more equity capital.
Amisha, all 13 brokerages who track Ather industry are bullish on the stock. Sometimes that marks a top, but this is a company which is still, you feel, in the nascent stage of EV penetration, and the company now has supply to meet the demand, unmet demand. What is your view on Ather?
See, the broader trend of EV is here to stay. And with the kind of jolt that Indian economy we got in last 6 months because of the Hormuz, the government policy support to consumer tilt has all very aggressively been going towards alternate fuel, or you can say EV. And I think in that, their product acceptance has been very good. So I think market will continue to chase the leader, and there is no looking back on that.
Okay, all right, Amisha, we'll have to thank you on that note. Thanks a lot for joining in. I look forward to chatting up with you soon. In fact, we had Jinesh Joshi of PVR. You know, he had joined us a few days ago. We were talking about Z, but he was extremely positive on PVR. And, you know, he said that Spider-Man's collections are close to 200 crores, thereabouts. They've launched a couple of new offerings. That's the stock actually of this afternoon, PVR. People going to the movies or not? Probably that's debatable. But just take a look at that. Flying away, 3.5%. And in the last, I think, 10 days or so, the stock is up close to 20%. Quite a big bounce back out there. Let's do a quick check on the F&O markets. Though, well, if you look at the PCR, you know, we were mentioning that it was getting to the upper end of the range at around 1.4, 1.45. I mentioned this yesterday, even the start of today. It's normally when you see that happen, you know, either the market's consolidated or they pull back a bit. So I think it's going according to the textbook now. PCR has come down to around 0.84 or thereabouts. This is not such a bad scene. Now, in today's trading session, you have the weekly expiry that is play out. And the bears believe they want to defend the higher levels. 24,500 call, just take a look at that. The premium yesterday when we closed up was $100. It's come down by a third because the direction of the market has come down and time value of money as well as getting eroded. As is the case with 24,550 call. Premium yesterday at the end of the trading session was around 72 rupees. That's come down to around 17 rupees. So aggressive writing is what you're seeing. So if you just punch in those numbers, you know, in terms of an upside today, the 24,530, if we get to that level, then the bears will actually want to defend that mark. We're close to 60 points away from here. So the bears will feel they're on top till that 24,530 mark is held out just for today. So keep an eye out on that front. Individual stocks that are on focus, Nalco, as well as SAIL. You know, there is a hint of some kind of buying that we're seeing on both these two stocks. Keep in mind that they saw a big correction and now they're seeing some fresh buying. Some kind of short covering is what we're seeing on both those two counters. On SAIL, in fact, it's quite evident that there is a short covering bounce that's playing out. While on the flip side, UPL is the one that's come in for a lot of shots getting into the system in today's trade. So I think we should keep an eye out on that name as well. Well, time to slip into a short break. On the other side, though, we have the alpha manager of the day, Shreyas, who's waiting for us. Stay tuned.
Welcome back. We've got the market, which is now at 3 o'clock mark, still down 300 points and 24,467. So, yesterday's 200 points is gone and then another 100 points more. So actually, in that sense, you're down about 100. Shreyas Devalkar is with us, Head of Equity, Axis Mutual Fund. Shreyas, good to have you with us here. Thanks for joining in. So what's keeping you busy, and let me ask you, what has really stood out to you in terms of any trend you've seen across this earnings season? It seems to me, generally speaking, revenues are strong, profits are strong, but margins, more often than not, are under pressure.
Sure. Good afternoon, and thanks for inviting on the show. Yes, the results and your observation is exactly right. If you notice, generally, whenever nominal GDP growth picks up, the top line growth also improves. So this time around, you are seeing the top line growth is higher. Actually, the top line growth of broadly Indian basket is around 17% odd, while the PAT growth is around 8%. That is the expectation. So this inflation, in terms of price increases, which various players have taken, is getting reflected. The credit growth is also getting reflected in the credit growth of India. So the headline indicators, as far as the top line growth is concerned, are good. Even within that, if you look at the volume growth, is not as bad. Means when the war started, one would have expected a lot more damage, either by way of volume impact or by way of asset quality. So on both these account, whether you take SMEs or retail loans, there is not much impact. Actually, there is not much impact which is highlighted by many companies during this quarter. So all in all, the results, and I would actually call out, is better than what one would have feared when this war started.
Shreyas, before the earnings came out, everyone thought this is going to be a washout quarter, but it's actually turned out to be very strong, as you pointed out. So where was the disconnect? Why did everyone get it so wrong? How come demand has been so strong?
It's a combination of multiple things. Just to take a case in point of the credit growth. Now, if you look at the credit growth last year, same time, actually, it is a combination of multiple things. So, and as I said, credit growth last year, same time, it was hovering around 10-12%. So there is a good form of base effect which is playing out. That is one. Second is there is a shift from bond market borrowing to bank borrowing. And that is also one more angle which is playing out. And third angle is the inflation, obviously, wherein corporate is borrowing for working capital. Even in case of, say, consumer loan, one AC one would have bought at, say, 25,000 rupees last year. Today you are buying at 30,000. So to that extent, the loan growth is there. So there are multiple things which are playing out. I just explained it by way of one example of, say, credit growth, which is getting reflected. In terms of volume, now if you take auto volume, if you take the EV penetration, the EV growth is very good. Even though there is a little bit impact on overall volume of ICE growth, though that impact also is much lesser than expected. Again, here I would call out that yes, the government has rightly absorbed a large part of crude oil price increase. That also has played out. The interest rate, again, the policies have been really pro-growth. So when the currency depreciated, the coordinated effort which both central bank and central government took to actually bring in foreign money through FII route in the bond market, rather than resorting to the interest rate increase. So that also has been the pro-growth. So it is a combination of multiple factors which is getting reflected in good results.
All right. Hi, Shreyas. Good to see you in. Well, if you are allocating fresh money, what would you do? Do you think the larger caps is what you would bet on, which have actually underperformed? If we look at it from the start of this war itself till date, mid and small caps have done much better. The headline index is still close to 10% away from its all-time highs. Your view, how would fresh allocation be?
Again, this debate has been there for now multiple years. So it's not even today's debate. In today's context, the way I would look at it is large caps, the sectors which are large cap oriented, where there is not much re-rating. In some cases, there is a de-rating. like in case of private sector bank, IT services, and there is a lack of re-rating in consumer staples, auto OEM, and oil and gas. So these are the large cap oriented, maybe, which may comprise of say 60-70% of large cap broadly. Now in this pack, what we are trying to do is wherever there is an incremental data. So as you always know that valuation per se doesn't warrant a return in the market. There has to be improvement in the earning growth trajectory. So definitely the credit growth has been one of the factors because of which we in last 3 to 6 months, which we increased the weightage in the banks or lenders, basically, whether it's bank or NBFC. On the other hand, we need to wait out for factors like the crude oil. Because normally in case of large cap, these companies cannot outgrow GDP growth beyond a point because they are too large. Whatever they do, they're not able to outgrow the GDP growth beyond a point. And from that context, one need to take a call on, yes, the crude oil is sustainably going down to 70s or below the way it was pre-war. If that is the scenario, then definitely with the valuation in hand, this pack will give you a good return. And that's what we are watching out for, some of these triggers. And when it comes to the mid and small cap, yes, the earning growth has been there always. Even this quarter, there is no issue in the earning growth. And within that as well, there is a re-rating. See, as far as this mid and small cap is concerned, valuations are concerned, we are now actually in the mid-cycle of this pack. So here there is no valuation correction. We got returns more because of earning growth and re-rating. So if you look at absolute return of this mid and small cap on a 1 year, 2 year basis, they are not commensurate to their earning growth. They are good. They are better than large cap, but they're not commensurate to the earning growth, primarily because the valuations has been high. So we have been selective in this SMID space. So most of our exposure in this small and mid cap space is around manufacturing as a broader theme. It is also around healthcare and some pockets like capital markets, etc. So manufacturing, we are playing through capital goods as well as auto ancillary, because both of these packs are a good representation of India's manufacturing story. If you look at in case of auto ancillary, some of them are benefiting from exports, EVs, even in case of non-auto like electronic manufacturing services, defense, aero, rail. So there are multiple such options or optionalities which are available in this space. So these are the packs where we are focusing our attention on, knowing fully that yes, the valuations are high, but one need to then, when such is the scenario, when valuations are high, you need to really focus on the optionalities and the probability of that playing out.
Yeah, got that. You know, just the other story, Shreyas, we've been tracking, of course, is this what looks like the government enabling or providing itself with the provision so that it may, if it so chooses, start to sort of apply MDR on UPI transactions. Not everything, not on person to person, is largely going to be on merchants above a certain value of transactions, etc. Has been widely reported now. We don't know when it will happen, but I think the government's taken the first step towards it. Ritu is here with what this could mean for companies. Ritu, take it away.
Well, let me start with the fact that UPI payments remain free, but the government has proposed a legal change that can pave the way for charges on certain UPI transactions in the future. Now, here's what's been proposed today. Section 10A of the Payment and Settlement Systems Act says certain prescribed digital payments cannot be charged. That list is then linked to Section 269 SU of the Income Tax Act, which specifies the payment modes that businesses should offer. Now, the government wants to remove this link. Instead, Section 10A will allow the government to decide through a notification which payments modes should or should not remain free. So, this does not immediately bring MDR on UPI, but it simply gives the government flexibility, legally speaking, to introduce MDR on some UPI transactions in future if it so decides. And this is why the industry sees it as a precursor to MDR on UPI, particularly for large merchants. Now, we understand the structure that was discussed could cover person-to-merchant transactions of more than 2,000 rupees in value, while smaller merchants and low-value transactions could remain MDR-free. Now, Jefferies estimates that an MDR of 15 to 30 basis points, for instance, that could create a revenue pool of 5,000 to 10,000 crore rupees for payment platforms together by FY28. It says transactions of more than 2,000 rupees account for just 4% of the P2M transaction merchant volumes, but 67% of the person-to-merchant transaction value. Now, MDR fees typically shared across the payment ecosystem, and Jefferies estimates payment platforms can retain around 5 to 10 basis points, and for companies like Paytm and Pine Labs, that could create a meaningful new revenue stream. In fact, it estimates 300 to 700 crores of potential revenue for Paytm and 50 to 150 crores for Pine Labs if MDR is indeed brought in.
Rizu, thank you very much for that. And Pine Labs, one of the founders, of course, put out a tweet which we, carried earlier, essentially arguing and batting for MDR, essentially giving global examples on how, even with a charge, penetration is much higher than where it is in India, and perhaps, this needs to be properly funded now. Shreyas, any thoughts on this story? And do you own any of these names?
It's very difficult to predict what exactly will happen, but definitely there are steps being taken as highlighted. But whatever names we would hold in entire space of fintech or payment, it is not exactly just based on this event per se.
Okay, but you own them, but not just for this.
Sorry?
I'm saying you own this, but obviously this is not the only reason. That's what you're saying.
Yeah, some of them we own, but not all.
Okay, got it. I just want to quickly, if you can pull up the stock of Blue Jet. The results came. The results were largely in line, although they were a bit of a disappointment, and the stock came off about 8% from the day's high. And of course there was a call later in the evening. And look at that. There was a bit of an attempt at taking the stock higher, but it's essentially sold off from the highs once again. And at the margin, at least for those who perhaps subscribe to the QIP, and maybe the story is long run, etc. But there is certain disappointment with the numbers, and in a way, what was promised before the QIP in terms of what's possible and how both lines of businesses have turned a corner and what actually has come through. So the promise is still there. It was made on the call, but the stocks, of course, are sold off from the day's high.
I was just checking the Blue Jet QIP price. The indicative issue price was 506. So even if assuming it happens a little higher, it's still comfortably above the QIP price that it was in early July.
The guys who put in there, they're not, it's basically not gone anywhere essentially, right? And the reason I made a mention of this is because, the last time around when they did the QIP, this is actually almost the second time this is happening. There was a QIP which happened, I think, last year. And there were, again, lots of promises made before the QIP. The QIP happened. Nothing really fructified in that sense. But this time maybe this really the dye businesses turned the corner. The sweetener businesses, the call, as the management mentioned on the call, but it didn't show up in the numbers. And the expectation in some quarters was that this quarter, Q1 itself, it'll show up in the numbers. I think they did 98 crores in EBITDA. Expectation was. It was in line with what was the published estimates, but there was a promise, which I think, and that's the reason why, despite the call, the stocks come off the day's high. Shreyas, we'll thank you there. Appreciate you joining in, and good speaking with you. We'll just take a quick commercial break here and get you some trading ideas on the other side. Mitesh is going to come back in just a bit. Okay, well, it's that time. It's day 2 and it's the closing auction session, CAS, right? If we can quickly look at the Nifty, it should stop trading now. I don't think it should. Can we have the Nifty up and the Nifty bank? So this between 315 and 320, it's a bit of a dead zone. 315, the Nifty will stop trading, and futures will keep trading. So these are futures rates that we are looking at. They are still live, but the cash rates close. So maybe if you look at the Nifty and the Nifty futures together, you'll get a better sense that we are 24,565. So now keep this in mind, because any change, for example, yesterday's 200-point change was on top of the 315 price, and that's the price that we were referring through the course of the day, saying that the market is only down 100 points because the last 200 points came out of nowhere. So 24,566. Sorry, that's the futures rate. The cash rate will come up. Yeah, there you go. 24,463. That is the closing as far as 315 is concerned. 320 is when the CAS session will start. Mitesh is with us. Maybe we can sneak in a trade or two. Mitesh, what do you have?
NTPC is a STBT. Keep a stop at 344. Look for a target of around 338, 337.5 kind of a thing. And the other one is CAMS, which is a BTST with a stop at 801 for target of 825.
Okay. Expecting to see fireworks, Mitesh, today?
I have no idea. In fact, yesterday also left very confused, and today also I'm still trying to understand how this mechanism works.
Yeah. And if you remember, yesterday, same time, right about now, you had the UPL numbers which came, 315. And, cash was not trading, futures were trading. But 24,463, that's the Nifty rate on top of which we will track changes which really come through. So, we will have UPL, by the way, is down 6% or so right now. 581, 582 or so. I think there's 3 minutes to go, so let's utilize that time to look at some expectation as well. I think today was a very busy day with earnings, but tomorrow I think we don't have many. Bharti will report though. So Rima, take us through the preview.
Well, Bharti, on a consolidated basis, we're working with about a 3% revenue growth, margin stable at 57%. Airtel Africa numbers are already in the bag. They were known. They came out last week, and it's a strong set of numbers. The focus will be on the India mobile numbers. And here, it's expected to be a very steady quarter. No fireworks, no blowout numbers, because there hasn't been a tariff hike in more than 2 years. And for the last many quarters, we've seen both Jio and Bharti report these, 2, 3, 4% kind of a revenue growth on a quarter-on-quarter basis. So this quarter, again, for the India mobile business, we're expecting a similar 2.5% revenue growth, some subscriber addition, 3 to 4 million on a quarter-on-quarter basis, and plus there will be an ARPU increase. But again, the ARPU increase is just going to be 1 to 2%. That's because it's the normal migration from 2G to 4G, which is boosting the company's average revenue per user. In terms of triggers, because the numbers are unlikely to have any sort of a trigger, unless a little bit home broadband does well. The enterprise segment is something the street is tracking, but the trigger is going to be the headline tariff increase. When does it come? There are some brokerages who believe it will come towards the end of this calendar year. Some have deferred their expectation to next year after the state elections. And then the JPL, that's Jio Platform Limited IPO, because that's in a way sets the benchmark once again for the telecom business of Bharti Airtel. So these are the two big triggers to watch. But as I said, there hasn't been a tariff increase. So therefore, the incremental growth in numbers has been very subdued and steady for both Bharti and for Jio. But more numbers, and Marico this time on Mangalam's radar.
Well, Marico is likely to report a good set of numbers, and the confidence that I have in these numbers is not brought about by me, but by the company's first quarter update itself, where they say that this time around they've done over 20% in revenue growth, and at the same time their volumes have been multi-quarter high in double digits itself. So the analysts have plugged those numbers in. However, the stock is mildly under pressure today because the entire staples space has seen a knockdown after Nestle's PowerPoint presentation did say that demand in the very near term could moderate. However, Marico has their own growth triggers. If you look at what the analysts have plugged in, 20.5% in terms of revenue, close to around 4,000 crores. The the EBITDA grows around 19%, which means that the margins would be stable around 19.8%. This compares with a little over 20% same time last year. And the net profit also showcases a mid-teen sort of growth. Now, Marico is different versus others when it comes to the raw material prices, largely because their mainstay, copra, which is the raw material for parachute oil, has actually seen a decline of almost 45%. So as a result of which, the gross margins are likely to improve quarter on quarter. The volume growth that is expected is closer to 12 to 13%. And value-added hair oils, which was a business which wasn't growing well, has now got growth momentum over the past few quarters. That too is growing in 20s. Add to all of this, they have growth triggers in the form of their digital-first businesses as well as the food businesses. So Marico likely to outperform and do well.
Can we take these flashes off? Mangalam, thanks very much for that. Can we take these flashes off and put the Nifty and the Sensex, please, at the bottom of the screen? Because because the cash session has started, and we will have 24,463, which is the these days rates will start to nothing so far, but stocks etc. will perhaps be starting will be moving. So we should the F&O stocks. Which will be part of the closing auction system, which essentially will be trading, and then there will be price discovery, etc., which takes place. So, yeah, we should just keep that on. Actually, Nifty and Nifty futures perhaps will help, because the futures price, I mean, just to see if there's any unusual movement as far as the Nifty is concerned, like yesterday, that'll give us a real sense. Jay Bala is with us. Jay, great to have you with us here. Thanks for joining in. So it's a bit of change as far as market structure, etc. goes. What did you do? How did you look at the? Did you look at the Nifty futures to analyze post close yesterday?
I looked at Nifty itself, Prashant, but I took the price where it closed at 3:15 p.m. See, the CAS is an international best practice, but there seems to be some chinks particular to the implementation on the NSE. BSE seems to have done pretty well. So, right now, what I'm doing with is the Sensex closing price and the 3:15 p.m. price of Nifty 50.
Okay, all right. Got that, Jay. Let's focus on levels then. Hopefully, we don't get a big shocker in the next 15 minutes or so. But you have been bullish, holding on to that stance?
That's right, Nigel. At 3:15, the Nifty had already crossed the important level of 24,602 that I was tracking. So this is a bullish signal, but you can take other signals too that the market's presented. The Nifty Auto Index came within 10 points of all-time high, and that's a bullish sign. And the Nifty Equal Weighted Index, that has already hit record highs. So that is telling you the broader market is delivering a bullish signal. The CAS right now could be a minor distraction. I think the broader trend will assert itself. So I'm expecting these things to get ironed out in the next couple of sessions. So once that's done, whatever the broader market is signaling, that's going to be the direction of the Nifty. And I'm expecting fresh record highs to come through. But there is still the risk that's coming from a new risk that's coming from crude. Crude it shouldn't cross 93.5. So it's not my expectation. But if it does cross 93.5, I will turn bullish on crude. I will expect it to cross 145. So right now, my expectation for crude is to once again go below $67 with an intermediate support at about $72.
Got it. Let's welcome in Rajesh Baheti as well, who's back with us on this entire cash system, which is underway. Rajesh, welcome back. The Nifty, price is unchanged from 315, right? One of the things when you joined us in the morning is that essentially brokers need to, and this I've heard from others as well, they need to display prices at any point in time during the auction system, what the discovered price will be if the auction were to end at that point, that particular point. And I think that is not available on many broker terminals. I'm not sure if that has been a problem, Rajesh.
So even in my terminal, I'm not seeing the index values changing at all. And just to make it interesting, let me tell you, anytime in the past, if the index was at 24463, the 24,700 call would have been close to zero. At 322, it was trading at 7 rupees. So this is the kind of uncertainty that has been built into the system.
Should the price change though? Should you be seeing the price change?
Do you want us to trade without us?
No. At this look on stock. Yeah. no, stock.
It's obvious, isn't it? Even the index, isn't it obvious?
Even the index, yeah. Because I mean, I am assuming that we'll have some of the stocks up, and I think the stock values are changing. But you should be able to see it on the index as well, right?
Absolutely.
Yeah. But even on stocks, right? I mean, the feedback was that it's not visible on many terminals. So that perhaps was a problem yesterday.
So yeah, I mean, I'm looking at, forget the technical glitches. Let's say we fix that. We still haven't sorted out the fact that what happened yesterday had nothing to do with the index, whether it would have been live or not. It was clearly not the intended close. You saw how the index immediately went down 200 points first thing in the morning. And you could argue that if you have an index fund and you got into the market yesterday, you didn't have any tracking error. Well, come this morning, you're down 0.5%.
Yeah. Got it. We'll have the index values come up, I think so it's 326, 328, and between 328 and 330, I think the value, the trading stops randomly, and then the value will come up, and that you'll suddenly see the value change. Hopefully not 200 points like yesterday, and it'll be in line with where the Nifty futures is, or with some amount of spread, but nothing like what we saw yesterday. I think Jay is with us. Jay, if we can get you back in, just to talk on the markets. I mean, this cash session aside, which we are tackling with Rajesh, what are your thoughts in terms of what you're seeing today's session specifically, and the 100-point drop from yesterday, 315?
Yeah, so it's just a normal pullback within the bullish uptrend for me. So I would expect the Nifty to hold about 24,100 for this, initial hiccups to get solved. Once that's done, I'm expecting the broader trend to resume higher. As I said, the Nifty equal-weighted index, it's already hit record highs. But we should be keeping the focus on broader stocks rather than the Nifty 50 stocks. Let that the hiccups get solved, and then we can focus on the large cap names. And as I said earlier, the Nifty Auto Index, it's crucial. It's without a Nifty Auto Index scaling fresh all-time highs, there's no bull market. So that is it's almost there. We have Nifty Auto Index came within 10 points of doing that. So everything is okay for me, but this is a minor hiccup in my opinion.
All right. Let's talk about stocks then. Bala, Jay, give us some more.
Yeah, Ashok Leyland, bullish on it with a stop loss of 147, and expecting it to scale back to fresh all-time highs. And I have actually two. I have Vedant Fashions, but the stock was 8% when I scanned it, but now it's about 16-17%. The stock is looking like it might go to. It might be a turnaround candidate from the recent 295 low of 2026. But since it's at 16%, the risks have become a little bit higher. I have another pick, Anup Engineering, with a stop loss of 1999, possibly heading to fresh 52-week highs from current levels.
All right, interesting times. We're getting some updated rates that are coming out there. At the end of the session, as Prashant had mentioned, 24463 was the number on the Nifty.
Oh dear.
There we go.
So
24615. That's the number that we're going to be working with right now. That in all probability will be somewhere where we close at. So CAS has been good for the bulls again. And today's the problem is that it's weekly expiry as well. So it gets even more tricky.
So Nigel, look at that. This is, so you are now once again
150.
150 points, right?
150 points.
150 points
150,
higher,
right? Yeah.
from 315. Maybe we should just quickly, can we put a flash up saying that Nifty has settled, at the end of the cash session, Nifty has settled 150 points higher compared to the 315 level.
Correct.
And this is the problem that we tackled with yesterday as well, and I think the same thing has happened now as well. Yeah, there you go. the Nifty Bank, I think, has also made a move, right? 500 points.
The intraday chart of the Nifty Bank should come up, actually.
Yeah.
That will be even more startling, more than the Nifty.
400-point change, almost 400-point change on the Nifty Bank as well. And maybe just look at the Sensex as well if we can. And we should put out the same information for the Sensex. And you know, the Sensex is down about 0.25%. I'm not sure if there's any big change there.
Big change in the Sensex.
No big change?
No.
Okay, no big change on the Sensex, but that's the Nifty Bank chart. It's a big move. By the way, remember, you heard that bell go off, the closing is done, but futures are still trading. So then now what do you do, right? Nifty settled 150 points higher versus 3:15 p.m. level. That's the flash. And Nifty Bank is settled, I think, 400 points higher, approximately, compared to the 3:15 p.m. level. Rajesh, there you go. So once again, something similar like yesterday.
Absolutely. So at 3:15, you were at 24,463. Ordinarily, the 24,600 calls would have been trading at 50, 60 paisa, 30 paisa, 40 paisa. Now it's going to close at 16 rupees or whatever, 14, 15 rupees. I mean, it could have been 100 rupees. So are we playing bingo here? So that's the question. And I want to add one thing. Now the BSE looks very orderly today, but BSE does 5% of the cash volumes. I don't know, it'll even be lower on the CAS segment. And we have the BSE expiry on Thursday, 30% in option segment market share, 5% in cash segment, and you will close the BSE Sensex based on the BSE closing option segment. How dangerous is that?
So just give us a yeah, sorry, for viewers who are, and lots of viewers have written in that, you know, saying, well, somebody's written in, well, he's new to the markets and we're seeing this change. Just simply put, Rajesh, on the option side, if somebody is trading on a day like today, what is the risk that you were describing? Just describe it to us simply. Take a strike and describe it.
See, normally you would expect options price to have theta decay towards the close of the day because they're expiring in a few minutes. But here, because you're playing bingo now, so anything can happen. So there will be no theta expiry, theta decay. If it happens and people buy and you can manage the index by putting in trades, then you could make a big lottery. So there will be big winners, big losers, and nobody knows what and why. So nobody really knows. 150 points, the market has gone up. From 15.15 to 15.30. Do we know why? No.
Yeah.
No, Rajesh, you were giving an example with a strike. If you could just repeat that.
So, for example, let's put it this way. Ordinarily, if you look at all the historical data, let's take the 24,500 call. The 24,500 call would have been trading at 5 rupees if the index was at 24,463 at 3:15. Now that call, instead of closing at $5 or closing worthless, is going to close at 115 rupees.
Got that. Absolutely. You know, so that's the big point out there, that premium was only 5 rupees, which has gone to around 115 rupees. So that's the kind of move. Rajesh, just one question. Do you think we're trying to fix a problem which wasn't a problem in itself? You know, that was some kind of feedback that I got yesterday. I just wanted your view on that. And the other view I wanted to ask you is, you know, if we're trying to do the CAS session, should it be restricted just to big rebalance days, the Nifty rebalance, the FTSE rebalance, the MSCI rebalance? Otherwise, the HFT guys only stand to gain. Just wanted your view because a lot of thoughts are coming in there. Just wanted to know what you think about it.
I've actually suggested a solution in the morning that, you know, have the CAS after the derivatives get expired. You don't have to have the derivatives closing completely coinciding with the official CS determined price. I mean, the index funds and the guys who want to rebalance should have nothing to do with the derivatives market on the expiry date. So why should you have this phenomenon where the derivatives market is exposed to a price discovery in the CS session? I don't understand that.
Yeah. So, yeah, you essentially, the futures market can close at 3:15. And then you can have the cash, basically.
3:30, whatever
price, but de-link it, right?
Yeah,
that's what
absolutely.
you said.
De-link it and then have your CS and have the official close.
Yeah, yeah. One feedback, Rajesh, on the other side, right, is that and that BSE point is interesting as well. What you said is that the cash BSE's share in options is 50%. Whatever, these are all approximate numbers, but large.
30%, 30%,
35%.
Yeah.
And in cash, it's very low, right? Single digits.
Yes.
So then,
and you will have the cash there determine the settling price of the options on Thursday.
Yeah.
So Thursday you might have the NSE closing very orderly and the BSE going all over the place.
Yeah, it could well happen. You know, in terms of the closing auction session and the fact that so I was told that before putting this out and rolling this out, you know, this was studied, and examples all over the world, etc., were also studied. And what they found essentially is that bulk of the volumes in any case happens in the last half hour. I mean, on rebalance days, in the last 30 minutes, right? So it's not as if, and this has been a criticism some brokers have made, that it'll suck out liquidity from through the day and it'll focus it in these 10 minutes. And the pushback in terms of data, which somebody was telling me, is that on those days, last 30 minutes is when bulk of the action volumes for that day anyway take place. So it's not, I mean, it's a different issue, but I don't know if you have any thoughts, Rajesh.
No, so I did give a comparison within the between the US markets and the Indian markets, how the US markets, the big banks, the regular banks are also allowed to do market making in equities. They have a very, very solid market making division. You are seamlessly able to borrow and lend shares. There's no STT. So even a 0.10 bips difference, you can arb and you can trade it there. It doesn't happen in India. So on days when the index rebalancing happens, you might technically think that you've got no tracking error, but the index itself will be an error. So next morning going to come back and either be 2% up or 2% down. So I don't know how this applies to the Indian context. And in terms of the derivatives, it has nothing to do with index balancing. So why expose the derivatives market to this risk? At least decouple that.
Yeah. Look at the Nifty August futures now, if you can. That's the Nifty Bank futures. Yeah, so 24,615. And the futures have not really, obviously, why should they move? I mean, they're not going to ramp up to what the futures are, but 24,548 is the 24,548 is the August futures level. And you know, we'll have to, if this goes on, we'll have to kind of, at least in terms of the, you know, how we're able to show this happen. I think that 315 cutoff is important for everything, for Nifty futures, for Sensex futures, because I think that's the only way to compare how things have moved, how things have changed. And I think same is true for all the stocks in the F&O, which are part of this CAS system in that sense. So tomorrow morning, Rajesh, everything, I mean, say US is flat and there is no additional Q one way or the other, up or down. I mean, the pre-open should correct this, right?
Absolutely. 150 points for the taking. So 150 points down, maybe if not 150, if things are good, looking good. We've had that correction, then 50 points. But certainly 24,614 is not the close that the market was indicating for today.
You know, Rajesh, you said that there is no reason or there's no way to find out why this has happened. If we take, say, the 50 stocks on the Nifty, take their 315 close and look at the price at 330, wouldn't this 150 points show up, be accounted for?
What do you mean?
The Nifty is the value of the underlying 50 stocks, right? I'm saying that if the Nifty is moved up 150, it should show up somewhere.
Yeah, but see, if the CAS is not filled with market-making companies and there are no market makers in India, if you cannot arb a 0.5, 0.10% difference, then you're likely to see a big move because the CAS is going to have imbalanced order book and you're likely to see a big move and clearly the tail will be wagging the dog, and that's what's happening last 2 days. And I'm warning that on Thursday, you could have a real problem on the index, on the BSE, because 30% market share in options, 5% in cash market, practically zero probably in the closing auction segment, and you could have 10 trades tilt that index 1,000 points up or down.
Okay, got that. Rajesh, Thank you very much. I mean, I think, busy days for us, busy days for you also as we track this with you.
I got out of my position, but that's not the point.
Yeah. You got out at 3:15, is it?
You have to, right? I mean, you're not going to play bingo here.
Yeah. Okay, Rajesh, thank you very much once again for joining us. And we will continue to have you on till this settles. And you're making lots of valid points, and we will continue to get insights from you. Thank you very much. Okay, I think the F&O session has also come to an end, and maybe now we should just sort of put that up. The Nifty futures is closed, Sensex futures have closed, stock futures, everything, options, everything has now come to a close now as far as the future F&O segment is concerned. We'll take a quick commercial break here. We will come back and continue on programming more on, of course, the cash session and the implications thereof.
Welcome back. Today was the day 2 of CAS, and once again we had a little bit of fun and games. In the end, 150-point surge on the Nifty. The Nifty ultimately ending down 160 points, 24,614. The Nifty Bank too ended down close to about 0.6%, having surged 450 points towards the end. Numbers coming in from Marico, bang in line with expectations on the top line, 3,957, meets the CNBC TV 18 poll. EBITDA, though, has come in higher than expectations, and it's a good 40 crore ahead. Expectations, 819 crore versus 779 crore, and that leads to a little bit of a margin bait. So EBITDA margins have come in ahead of our expectations by 90 basis points to 20.7%, and that is also driving a bottom line beat. 652 crore is the net profit on Marico. So Marico revenues in line with expectations, but margins and profits have come ahead. The stock today ended the day down close to about 0.6, 0.7%. But the big cue that we're tracking is going to be RBI's Monetary Policy Committee. The 3-day meeting started yesterday, and tomorrow at 10 o'clock we will get the outcome. Ritu now joins in to tell us what the key expectations are. Ritu.
Well, this RBI policy is shaping up to be less about the decision itself and more about the message that comes with it. All of the respondents to our poll are unanimous on what they will not see in this policy, and that's a rate action. The view is RBI still has enough room to wait and watch the incoming data and see the impact of all of these global developments before it has to change course. But the bigger debate is on what happens after this MPC meet. Now, 40% of our respondents believe that RBI will not hike rates in this financial year, but the remaining 60% do expect at least one rate hike. And if the RBI does hike rates, the economists that we spoke to don't really expect it to happen immediately. Most believe that the earliest move would come in October or perhaps even later, which will give the central bank more time to assess the impact of all of these developments. On growth, the economists are not really expecting RBI to change its view just yet. 7 in 10 believe that the central bank will retain that 6.6% GDP growth forecast for the year, with very few expecting some sort of an upward revision. Now, it is a similar story on inflation as well. Most of our respondents are expecting RBI to stick with that 5.1% inflation forecast for now, which also explains the expectations that are being built around the governor's tone. Now, a strong majority believe that there will be a balanced wait-and-watch messaging. In other words, acknowledge the risk, but avoid committing to any particular direction on rates just yet. On liquidity, despite that FCNR rush and other foreign inflows, most don't really see any liquidity-linked announcements in this policy. The view is RBI can always step in later if excess liquidity starts building up. Now, the real focus is going to be on the commentary. The investors are going to be watching out for cues on future rate path. Most importantly, RBI's assessment of inflation, growth, how it plans to manage liquidity as these foreign inflows come in, and whether it continues to stress its commitment to bringing inflation down to the headline 4% mark. Those signals could end up having a much better, bigger impact on markets than the policy decision itself.
Indeed. Thank you very much for that, Ritu. In fact, let's also take a look where members of the CNBC TV 18 Monetary Policy Committee see the repo rates ahead. Take a look.
What will the MPC do to the repo rate on August 5th? First, Samiran, your call?
No change.
Okay. Sonal, your call?
Hold.
Saumya?
Hold.
Ajit? Dr. Sen, the committee is already overwhelmingly hold.
Hold.
Hold. All right. So that's a unanimous vote, exactly as our poll also suggested. The other question is, okay, if there is no rate hike or cut in August, how many rate cuts or hikes are you all expecting in calendar 2026? So, Sonal?
None.
None. Okay, no changes in rates. Samiran?
No rate hikes in 26, more likely 27.
Okay. Saumya?
No rate hike.
Okay. Sajid?
Increasing.
You have to repeat it. I think you're on mute.
No rate hike, though the risks are increasing.
Okay. So that's hawkish. Dr. Sen?
One rate cut possible.
Ooh, okay. That makes it a divided house.
All right, no rate hikes and probably a rate cut. That's what the panel had to tell us. I'll tell you what, we'll slip into a short, we come back. We'll continue to get you some interesting stuff. Well, PVR Inox is rolling out low-cost, hyper-efficient sub-brand called Smart Screens in Tier 2 and Tier 3 towns. My colleague Rachna caught up with Ajay Bijli, the MD of the company, on the company's growth plans and the roadmap ahead. Let's listen in.
When you look at our screen portfolio of 1,780 screens, only 3 to 4% of our screens are in what I call growth towns, which are still emerging. And we are surprised by the consumerism happening there. The appetite to watch movies is there anywhere in the country, every nook and cranny. So we said that while our main growth engine remains, the big city rollout that we're doing, but even this should not be ignored. And now the time has come. So we've identified almost 300 cities now where we believe smart cinema can be introduced now, starting off with Muzaffarpur.
So what is the ticket cost like in a Muzaffarpur, and what came out of the bill to make it 30 to 35% cheaper than a regular PVR standard ticket?
So a lot has happened behind the screens. The engine is we've tweaked it a little bit. No compromise on, the consumer will not feel any difference, but of course we don't have recliners, we don't have formats like IMAX and 4DX and all, but it's a very good high quality experience. The capex, first of all, is about 1.9 crores per screen as compared to the capex which is there in normal cinemas that we do.
What I also want to understand is that these places would be worth only if a film lands there, right? And a distributor would decide that if they want to distribute in that particular area. So how is that going on, the negotiations with distributors, if there are any?
Well, there are no negotiations. I mean, so far, so many markets and catchments over the last 36 years we've been to where there was no cinema or a single screen was there or something. So obviously we are joint at the hip. So if there is a new multiplex, new PVR opens, they're also very keen. They know there's a latent demand in that, in city, in that catchment. So they supply. And when they do supply, obviously the spoils of the box office are shared between us and them. So there won't be any content supply issues in these places.
I also want to understand that, let's say, the kind of conversation that we saw on social media when Odyssey came in, IMAX was exclusively earmarked for Odyssey. Does that impact other movies? Like this also happened during Dhurandhar when we saw Project Hail Mary didn't get as many screens as a Dhurandhar did, rightfully so for the demand, but there was this sort of angst among the people who were waiting for Hail Mary to come in. How do you sort of navigate that?
Well, you see, IMAX, we only play movies which are made on IMAX. So therefore, in fact, it won't be a very good experience if in an IMAX theater you show a non-IMAX movie. So actually, because the film is made on IMAX. I mean, Christopher Nolan's film Odyssey was an exception because he shot on IMAX camera full.
Interesting conversation there. The other story that we'd like to highlight is GMR Airports. That's added another landmark project, taking its portfolio to 5 airports in India. The newly inaugurated Bhogapuram International Airport in Andhra Pradesh is a greenfield airport that is expected to become the new aviation gateway for North Andhra. CNBC TV 18's Madiha Mujawar caught up with GMR's IP Rao. Listen in.
This airport has become like a pivotal for the growth of Andhra Pradesh, and this is a gateway of east. You can see that from the center such a way, right from east that up to Calcutta and toward this side now, west side, you can complete the whole thing is available for this. And because being center, really what happened, Visakhapatnam is one corner, now it's become from Visakhapatnam, Vijayanagar, Srikakulam. Not only the central east and also go the farther east also. That's one thing. Second thing, this airport has completely built a greenfield. So when you're doing the greenfield airport, we have taken what is the best available technology. It should be now technical improvements lot have happened. So this airport taken the best output of all smartness. For example, right from facial recognition, you're seeing no conventional counters. You're seeing only SBDs and CUS machines. You may surprise Visakhapatnam tied to city. Where is this? So we brought the technology up front. And also go up and see security angle. Not only we have put regular security machines, we also put body scan, full body scan to have testing. So you can imagine this airport has taken this. This is on the front side what you're seeing it. And also there's a smart washrooms which have sensors are there. We'll also give that complete analysis of the floor, water, what's happening, anything going wrong, we'll come to centrally, we'll be able to communicate. Before passenger reacts, we react.
Does that mean that this is in your portfolio, this is the most advanced airport?
I can say yes. Because, what is the best in all airports we've taken here, obviously. obviously.
So you've invested over 5,000 crore in building this airport.
4,800 crores.
Nearly 5,000 crores. How soon do you expect to recover that cost?
See, we don't get it. Today I'm getting, tomorrow I'll get it. Investor, no. It's his own plan of action, his own thing, depending on the traffic demand. You know that regulator, all regulated income, what comes depending on it, 3 years, or 10 years, or 12 years.
What is the period in your mind, sir?
I don't want to guess it, I won't do it.
And with that, it's a close on this edition of Closing Bell. Thank you very much for watching.
Hello and welcome to Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening. Crude oil prices rise amidst conflicting signals from the US and Iran on the status of the negotiations to end the 5-month-old war. President Trump claims talks are underway, calls it a last chance for Tehran. The Strait of Hormuz remains choked. A cargo vessel gets hit by a projectile near Oman.
Based on a shortage, they're making too much money. I don't like it. When we're finished with Iran, you're going to see the prices drop through the floor. But they made too much money. Too much money.
President Trump turns up the heat on oil giants again, pushes them to cut prices as they book bumper earnings amidst the Gulf oil squeeze. BP's profits more than doubled to $5.7 billion. Saudi Aramco's profits jumped 33%. The Sensex and the Nifty end in the red even after pairing losses in the closing auction. Banks and mid-caps also declined. 35 out of the 50 Nifty stocks end with cuts. The rupee remains on a tight leash, but bonds rally on the eve of the RBI's monetary policy. 100% of market participants polled by CNBC TV18 expect the status quo. 60% expect at least one rate hike this fiscal. The government tables a bill to amend tax laws, removing a blanket ban on network fee on prescribed digital payments. Industry sees this as a precursor to impose a merchant discount rate on UPI payments to large merchants. Sources say smaller transactions and merchants could remain charge-free. The government's disinvestment mop-up is set to cross 53,000 crore rupees. The 6.5% stake in LIC kicks off through an offer for sale as the centre eyes 31,000 crore rupees. Sources say there will be no further stake sale in LIC for 2 to 3 years. Nvidia places chips on Sarvam, leads a $74 million funding round in the homegrown AI company. Investment is part of a larger $300 million fundraise, valuing Sarvam at around $1.5 billion. Meta executive scheduled to meet government officials tomorrow. IT Secretary says the tech giant would be asked to clarify on a host of issues surrounding child sexual abuse material, WhatsApp username policy and safeguards against content takedown for prominent personalities. The meeting comes days after a video of Prime Minister Modi on Facebook was briefly removed. Meta attributed the incident to a technical error. The food safety regulator prohibits Dabur from selling products with 100% claims, including honey, ghee, edible oil and other items. Says such labeling is against the law and misleading. Dabur says its product labels comply with the law and is seeking legal advice on the future course of action. Well, straight to the top story this evening. Conflicting signals on the status of negotiations between the US and Iran. Now, President Trump has warned Iran that it has one last chance to reach a deal. Here's a look at the latest developments. President Trump says he wants to give Iran, quote, one last chance before decapitation. Trump went on to say he will not let Iran charge a fee for transit through the Strait of Hormuz. President Trump also maintained that talks are underway, reiterating that the US attack stopped only because Iran and other Gulf nations asked him to do so. However, Tehran refuses to back down and has warned of a full-scale offensive operation if the US escalation continues. Military advisor to Iran's supreme leader said Tehran will not tolerate the US naval blockade in the strait. He also warned of serious risks and casualties to US forces if it continues. Meanwhile, in Gaza, the US-led Board of Peace has said Israel will not withdraw from Gaza until Hamas completely disarms. This as Israeli forces killed at least 19 Palestinians in Gaza in strikes over the weekend. Here's President Trump issuing a warning to Iran.
I think we're going to maybe get something, but I want to give them every last chance before decapitation. Very tough to do what we have planned, still planned. We'll see what happens. For some reason, when they're talking, they don't like saying that they're talking. So I say, wait, we're in talks. Big deal, we're in talks. And they'll sometimes deny it, even though they spend hours and hours together talking. No, the talks are going along.
Well, that's President Trump, and all of this impacting Brent crude prices, which have surged past the $90 mark after briefly retreating in yesterday's session. Now, shipping traffic in the Strait of Hormuz remains constrained. According to chip tracker Kepler, the waterway recorded just 9 transits on the 2nd of August. A cargo vessel has been hit by a projectile near the Gulf of Oman. Crossings in the Red Sea are also lower. The higher oil prices are boosting balance sheets, though, of oil companies. British oil giant BP's profits more than doubled in the second quarter. Meanwhile, revenue rose 47% to $70 billion. The world's largest oil company, Saudi Aramco, has also seen a 33% jump in its profits in Q2 despite shipping disruptions. Aramco has managed to insulate its supply through its east-west pipeline in the Red Sea. President Trump has turned up the heat on oil giants, once again accusing them of making too much money and pushing them to cut prices. Oil giants like BP maintain that prices depend on global commodity prices. The firm also said it is prioritizing availability of products that consumers need the most, like jet fuel and diesel.
Based on a shortage, they're making too much money. I don't like it. And I should be the last one to say, because I'm a big free enterprise guy, nobody bigger. And, you know, you're going to see oil, when we're finished with Iran, you're going to see the prices drop through the floor. But they made too much money. Too much money. Chevron, too much money. ExxonMobil, too much money. When you look at one company where they made 12 times what they made the year before, they're going to give some of that back to the public, and they better cut the retail price.
Well, that's President Trump pushing oil companies to cut prices. A Ukrainian drone hit a crowded beach in southern Russia, killing 7 people, including 3 children. Now, nearly 40 people were injured, with more than 17 taken to hospital. Russia has accused Ukraine of deliberately targeting civilians. Some Ukrainian channels claimed electronic warfare may have disrupted the drone's signal. 25 American states have sued the Trump administration over its latest tariffs pegged at between 10 to 12.5% on goods from 60 trading partners. Now, these states have called the taxes a pretext for replacing the import taxes that the Supreme Court had struck down in February. These states have asked the U.S. Court of International Trade to declare the duties unlawful and also order refunds. So that's the latest legal challenge being mounted against the 301 tariffs. On to the market action back home. It's day 2 of the new closing auction rules, and it was another day where the Wall Street saw a sharp jump in the final minutes of trade. At 3:15 p.m., the Nifty was at 24,436. That's 3:15. 3:30, 24,615. A 150-point up move in just a single tick. Meanwhile, the Sensex, which was at 78,315 at 3:15, jumped to 78,429 at 3:30. The Nifty closing over 0.5% lower, while the Sensex ended only 0.2% in the red. The Nifty Bank slipped 341 points, closing 0.5% lower. So that's the Nifty Bank for you, and the Nifty 100 also lower by a little over 0.5%. In the money market, the rupee on a tight leash against the dollar. The currency was largely flat as it remains above the 95 mark. 10-year bonds rallying in trade, and the yield softened ahead of the RBI's monetary policy. 95.37 is the dollar rupee for you. And of course, track all the monetary policy action right here on CNBC TV 18. We will bring you live coverage. So what are the markets expecting from the RBI tomorrow? All market participants polled by CNBC TV 18 expect the RBI to leave the repo rate unchanged. So a status quo policy is what the street is expecting, while most also forecast no change to the central bank's FY27 GDP or inflation projections. But 60% expect at least one rate hike this fiscal. That is the expectation as far as the rate hike cycle is concerned. The government has tabled a bill to amend tax laws which give it flexibility to impose network fee on certain UPI payments should it desire so. The move has fueled industry expectations that it could pave the way for reintroduction of a fee on large UPI transactions made by an individual to select merchants. Remember, the bill has only been tabled. The proposed tweaks only give the government flexibility to notify which digital payment modes would attract a fee. Ritu joins us now to decode the proposed amendments and its implications. Ritu, what does this mean?
Well, let me start with the fact that UPI payments remain free, but the government has proposed a legal change that can pave the way for charges on certain UPI transactions in the future. Now, here's what's been proposed today. Section 10A of the Payment and Settlement Systems Act says certain prescribed digital payments cannot be charged. That list is then linked to Section 269 SU of the Income Tax Act, which specifies the payment modes that businesses should offer. Now, the government wants to remove this link. Instead, Section 10A will allow the government to decide through a notification which payments modes should or should not remain free. So, this does not immediately bring MDR on UPI, but it simply gives the government flexibility, legally speaking, to introduce MDR on some UPI transactions in future if it so decides. And this is why the industry sees it as a precursor to MDR on UPI, particularly for large merchants. Now, we understand the structure that was discussed could cover person-to-merchant transactions of more than 2,000 rupees in value, while smaller merchants and low-value transactions could remain MDR-free. Now, Jefferies estimates that an MDR of 15 to 30 basis points, for instance, that could create a revenue pool of 5,000 to 10,000 crore rupees for payment platforms together by FY28. It says transactions of more than 2,000 rupees account for just 4% of the P2M transaction volumes, but 67% of the person-to-merchant transaction value. Now, MDR fee is typically shared across the payment ecosystem, and Jefferies estimates payment platforms can retain around 5 to 10 basis points, and for companies like Paytm and Pine Labs, that could create a meaningful new revenue stream. In fact, it estimates 300 to 700 crores of potential revenue for Paytm and 50 to 150 crores for Pine Labs if MDR is indeed brought in.
Well, that is the big uncertainty and the big question. If MDR is brought back, of course, that bill has been tabled. It has not been passed just yet. As of today, there is no change. Shares of LIC fell nearly 9% in trade after the government launched an offer for sale to pair 6.5% in the state-owned insurer. The government is eyeing around 31,000 crore rupees from the issue. Sources tell CNBC TV 18 that the centre has assured investors there will be no further dilution of LIC's stake over the next 2 to 3 years. Hormuz joins us now to bring us the latest on the NIC stake sale and the government's disinvestment report card. Hormuz.
It's a healthy subscription to the non-retail portion, fully subscribed when it comes to LIC on the first day. But the bigger story is the fact that the mission mode that the government is in when it comes to disinvestment this financial year. Now, of course, the LIC OFS was a much awaited one. The last time the government sold stake was during its IPO back in 2022, which was around 3.5%. Now it plans to sell a 6.5% stake, provided the green shoe option is fully subscribed as well. And if that happens, they'll be able to mop up a cool 31,000 crore rupees. Of course, LIC is not the first company where they have mopped up stake this time around. Look at Coal India, BHEL, NHPC, GIC, other companies like IRFC, NLC India, Central Bank. Together, these offer for sales have managed to garner over 23,000 crore rupees for the government. Now, if you include, assuming that the full OFS for LIC is fully subscribed as well, that will take the tally past 53,000 crore rupees, which will be almost 2/3 of the government's disinvestment target, which is close to 80,000 crore rupees for this financial year. Of course, LIC is not the only company, again, where the government stake is in excess of 75%. There are 14 other companies as well. Now, if you take the excess government stake in these 14 companies, which is above 75%, that total value as of the current price comes up to nearly 1.5 lakh crore rupees. Now, which are those companies? Of course, LIC tops that list. We are putting the government stake here at 90%, assuming that the OFS is fully subscribed. That excess 15% stake is valued at over 76,000 crore rupees at the current price. There's Indian Overseas Bank, IRFC, Masgaon Dock, all of them having that excess government stake valued at anywhere between 6,000 rupees to 11,000 crore rupees. So it's a big disinvestment drive that the government has embarked upon. It is only through these offer for sales that the tally may cross 50,000 crore. If you add more the QIPs and so on, that number goes even further, and the government definitely looks to be in mission mode for achieving that disinvestment target.
All right, many thanks, Hormuz, for joining us. Paytm ended about 0.5% higher after a large block deal. Around 1.49 crore shares, or 2.3% of the company's outstanding equity, changed hands. The shares were traded at an average price of 1,367 rupees apiece, valuing the transaction at over 2,000 crores. We learned from sources that Saif Partners was the likely seller. The floor price was at a 5% discount to yesterday's closing price. Nisho also in focus on the back of a big block deal, over 10 crore shares changing hands worth nearly 2,000 crore rupees. Elevation Capital and Peak 15 Partners entities were the sellers, offloading the stock at 182 rupees apiece. The sale was at a 5% discount to Monday's closing price. The stock had listed in the markets in December last year after a blockbuster IPO. Shares of Dabur slumping in trade after the food safety watchdog, the FSSAI, ordered the company to stop selling several food products carrying the 100% claim. Now, the FSSAI claims that the terminology is ambiguous, unverifiable and potentially misleading to consumers. The food regulator has said that its prohibition order covered products that include honey, apple cider, virgin coconut oil and other products carrying these claims. Dabur has said that its product labels comply with the law. It's seeking legal advice on its future course of action. We will head into a break, but up next, NVIDIA places the chips on Sarvam, leads a $74 million fundraise in the homegrown AI company. That and more when we return. Apple's annual sales in India crossing 10 billion for the first time in FY26. As per Bloomberg, iPhones drove the bulk of the growth, with iPad and MacBook demand also on the rise. The milestone comes as Apple expanded its retail footprint in India, so 10 billion in FY26. Gaming company Nazara Tech has appointed Raymond Stauffer as its new chief executive officer. The company's founder, Nitesh Mittersain, will step down from the role to focus on long-term strategy and portfolio direction. This came as the company announced its first quarter results. Nazara's revenue dropped 14% on an annual basis. The company also reported a net loss of over 82 crore rupees in the June quarter. Fast fashion giant Shein is reportedly planning to launch its initial public offer in Hong Kong as early as the middle of August. Reuters reports that the company is targeting a valuation of $30 to $40 billion. This is significantly lower than its $98 billion valuation in 2022. NVIDIA has bet big on Indian AI startup Sarvam. The chip giant led a $74 million funding round in the homegrown AI company. The investment is part of a larger $300 million fundraise, and this will value Sarvam at around $1.5 billion. Rachna brings us more details. Rachna, take us through the contours of this investment and NVIDIA's bet on Sarvam.
Well, NVIDIA has been powering Sarvam AI for a while now, but today it wants a piece of the company itself. Sarvam's board has approved a fresh raise of about $74 million. That's roughly 698 crore rupees. This is as per a filing with the Ministry of Corporate Affairs. Now, NVIDIA leads it with 238 crore rupees. That's about $25 million. Gladebrook Capital follows it with 190 crore rupees. Gaja Capital puts in 95 crore rupees. And a set of family offices and angel investors make up the balance. Now, three things are worth noting here. First, that this is not a fresh round. It is the second close of a Series B that was never actually completed. Sarvam announced $300 million back in June and closed only 234 of it. That left about 66 million on the table, and this tranche covers that gap and adds a little more. Second is to look at the price here. The issue price works out to the same $1.5 billion valuation Sarvam published in June. So this is a flat extension and not a step up. NVIDIA is coming in at the same number HCL Tech came in at 7 weeks ago. Third, this part pretty much matters the most here because the relationship between the companies is not new. Sarvam already trains on NVIDIA hardware. At its developer conference last week, it said it has access to about 2,000 Blackwell GPUs and is targeting 10,000 alongside sovereign data center partnership with HCL Tech in Odisha. So NVIDIA was already the supplier. What changes today is that the supplier becomes a shareholder, and that's the worry here because that's a pattern we've seen with NVIDIA. So we will see where this one goes.
Yes, thanks very much, Rachna, for joining us. That is the latest there as far as NVIDIA's deal with Sarvam is concerned. Let's move on now to Other news that we are tracking here this afternoon, and this is the latest on the flood situation in Assam, which is showing signs of improvement. Water levels finally receding across several affected areas. However, the death toll has now climbed to 87 after 2 more fatalities were reported from Sivasagar district in the last 24 hours. According to the Assam State Disaster Management Authority, nearly 1.28 lakh people across 6 districts still impacted by the floods. And Kerala continues to battle heavy rainfall with floods, mudslides and waterlogging disrupting normal life. The death toll from rain-related incidents has now risen to 15. In the past 3 days, the Weather Department has issued a red alert for 8 districts and has warned of strong winds. The monsoon session of Parliament continues to see disruptions. Protests by the opposition triggered repeated adjournments in both houses. Leader of the opposition in the Rajya Sabha, Mallikarjun Kharge, alleged that donations collected for the Ram temple in Ayodhya were misused and called for an independent probe. The Congress also demanded a statement from Home Minister Amit Shah on the police action against student protesters in Delhi. The BJP accused the Congress and its allies of deliberately stalling Parliament and blocking discussion on key bills.
इस ट्रस्ट का गठन केंद्र सरकार ने किया है। प्रधानमंत्री ने खुद संसद में ट्रस्ट के गठबंधन की घोषणा की और सरकार ने 70 एकड़ से अधिक भूमि ट्रस्ट को सौंपी। प्रधानमंत्री जी सदन में बताइए, ईडी, सीबीआई, इनकम टैक्स डिपार्टमेंट और अन्य केंद्रीय जांच
ये मुद्दा को लेकर के संसद के बाहर भी हंगामा करते हैं या चलने नहीं देते हैं, तो दूसरे का बात सुनता नहीं है। आप खुद ही बोलना चाहते हैं, वो मिसयूज करना चाहते हैं हर समय। ये हम लोग इसको मंजूर नहीं कर सकते हैं।
Well, that is action from Parliament. Now, Meta's executives are scheduled to meet government officials tomorrow. Speaking to reporters on the sidelines of an event, IT Secretary S. Krishnan said the tech giant would be asked to clarify on a whole host of issues, including safeguards against content takedowns for prominent personalities. Ashmit joins us now with the latest. Ashmit, give us a sense of the issues that are likely to be discussed during this meeting between Meta executives and the government.
Well, Meta has been on the receiving end over the last 15-odd days. We've seen Meta being pulled up by the parliamentary panel just yesterday. That was specifically pertaining to the issue of the takedown of Prime Minister's selfie video, subsequent to which Meta has given clarification, calling it a technical error, even saying that they'll go to the extent of deploying additional safeguards. However, the issue that is likely to come up tomorrow's engagement is likely to be on the twin issues of, number one, the WhatsApp username policy, and number two, child sexual abuse material being identified on Instagram. On both these issues, we're given to understand that the government has a whole host of queries. Number one, the government is likely to query Meta as to its understanding of what the law of the land is, what they're required to do, what their efforts are with respect to ensuring compliance. They're also likely to question Meta with respect to additional safeguards that are being deployed, what the learnings have been from the last 15-20 days, what Meta can do over and above what it has already been doing. And of course, we also heard from Secretary Krishnan, who said that this is, after all, one of the leading tech companies on the world. So there is no want of technology that is available with the company in question to deploy those additional safeguards. So clearly a lot that Meta will have to answer for. The meeting will, of course, begin tomorrow. For more on that, let's in fact listen in to Secretary Krishnan, the MeitY Secretary, giving clarity on what the line of questioning will be when this meeting begins tomorrow.
There are a range of issues. Sometimes we are aware that the CSAM issue was raised and what measures have been taken regarding that. Synthetically generated information, to what extent that is being looked at. Then, of course, for prominent personalities, when they have verified accounts, if content gets taken down, they have to be safeguards. So all of these will become issues, and we would like to understand from them as to why some of these things have not been working the way they are supposed to work.
Well, the IT Secretary there on the meeting with Meta's executives. With that, it is time for us to wrap up this edition of Business 360. The news continues on CNBC TV 18. Stay tuned. We'll be right back with you.
Let's Talk Money.
Hello and welcome to another new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, on this show, over the last many months and years, in fact, you've heard us talk about insurance, and we typically speak about the importance of term insurance. Obviously, you've heard a lot of conversations here on health insurance. Today, we decided to expand that insurance umbrella. Two other products immediately come to mind where insurance becomes almost a non-negotiable. One, of course, is motor insurance. That is, if you have a motor vehicle, there's a part of that insurance that is mandatory by law. And then there is the other part of that insurance that you will typically take to cover damage to your vehicle. The other piece on insurance, which perhaps doesn't get enough attention, is the insurance for your home. So this week on the show, we will put the spotlight on these two product categories and ask the question that we as policy buyers should be aware of when we're looking at buying either home insurance or motor insurance. To join us, to help us do this on the show, we have with us Mahavir Chopra, founder and CEO at beshak.org, and Rahul Agrawal, CEO and founder of Ideal Insurance Brokers. Mahavir and Rahul, thank you so much for joining in. It's been a while since we had you join us on the show. So to start off with, your thoughts on the topic at hand. Typically, we've always done shows with you on health insurance, but I thought today it's going to be a little different. Mahavir, opening views.
Yeah, I think most of the times I agree with you. Personal finance kind of content that comes either online or even whatever comes on TV today is largely around health insurance and term insurance. There are so many other products where there are myths that need to be busted, and people actually make a lot of mistakes, lose a lot of money. So from that perspective, very, very clear that, yeah, it's actually good to do refreshers and help people understand the other products around what are being used in their life or basically need to be protected in their life also. Like you rightly said, car is one of them. Home is another product that needs a lot of attention.
And I remember when it comes to home insurance, it must have been, I think, 8-9 years back when Rahul did a show, and I remember that was the first time I understood that there is such a good product in the market which can protect you from fire, any kind of damage to the contents in your house. So I thought a refresher is definitely warranted. And I'll also get to learn what the new trends are in the market. So, Rahul, good to have you back as well.
Thank you, Surabhi. Yes, it was about time to have another program on home insurance.
So, okay, let's do one thing, gentlemen. Let's start with motor. There's a lot of chatter, and why not motor? Because we've seen, right, the rebound in car sales, two-wheeler sales. I keep seeing the data when I do my market shows as well, that indeed, whether it's SUVs, even compact cars, the sales are really picking up after the GST cut. So I think it's a good time to talk about what has changed, if anything, in the motor insurance landscape. So opening thoughts here, first up on motor insurance, Mahavir, in terms of, and let's break it down, the third-party insurance and then the insurance that we take to cover damage to our own vehicle. What have you observed in the last few years?
Right. So first, to just make it simple for people, motor insurance is typically a combination of a comprehensive cover, which is on the, when we look at a comprehensive car insurance, it's about a cover which includes a cover which is for third-party insurance and a cover for own damage. Third-party insurance typically is a cover that protects people on the road and property that is a third party while you are driving, right? So any compensation that needs to be given in case you end up kind of injuring or damaging someone's property, that's what it covers. A lot of people look at this from a point of view of basically giving a fine or basically giving a bribe to the cop, and that's all about it. It's not saving you from that. It's actually saving you from something very, very serious, which is basically paying a compensation to someone who probably could have injured himself severely or could have probably lost his life. So now the amount can go to crores of rupees depending on the person who's basically got infected. The other part is basically the own damage part, which basically covers largely everything related to accidents. It covers fire. It will cover things like your entire natural events, like floods today is something that a lot of people are talking about because of the Assam floods. Floods get covered completely. On the innovation side, a lot of things have happened. The most striking trend for the last 4-5 years is that now add-ons have become a part of life. It's something that customizations are being done as a part of the product. Earlier, add-ons were something which was supposed to be on the side. Now, add-ons have become part of the product. People actually discuss add-ons a lot. Among the add-ons, obviously, the zero dep and the ones that we typically talk about are the ones that people look at. The other trends are around pay-as-you-drive, where basically people who have second cars, third cars, and they don't use it much, there obviously they can actually save a lot of money by typically not having to spend the flat rates that are typically charged by insurance companies for the entire year, right? Last is EV. So on EV, typically there are new protections that are available apart from the flat protection that a petrol diesel car was getting around battery and charger maintenance and all those things. So that's the roundabout, like kind of a summary of what's happening on the innovation side with car insurance.
All right, that's the broad landscape. It's a good starting point. So let's take some of these, themes and issues one by one. Rahul, let's talk motor third party, the mandatory part of insurance first. What you've observed. I don't think we've had a hike in motor third party rates for a long time. But I think when we talk about a comprehensive cover, and I looked at the breakup a couple of years ago when I was looking at my car cover, and I realized that a large part of that premium actually is motor third party, and there's a little part then that you pay to get the comprehensive cover. So is that how all policies are being designed right now? And should we expect a hike in motor third party rates anytime soon?
So, Surbhi, for that you have to we have to break up motor insurance into two parts. One is the private vehicles, which people like you and me drive, and then second is the commercial vehicles. While the motor third party premium is not very high for private vehicles, owner-driven vehicles, for commercial vehicles that's very high, right? Where it is way more than the first party premium, and the reason is very logical. Because third-party claims within the city, people like you and me, we drive within the city. There's not too much of third-party claims, but the majority of the third-party claims happens in highways where trucks operate on very high speed. Now, while now the third-party premium is going to come down in commercial vehicles, because over the last few years, the rate of claims has actually come down, because of better roads, because of better awareness, because of a lot of awareness in the drivers. So there's a very high chance that this year, the third-party premiums will come down for commercial vehicles. For private vehicles, there will not be too much of a difference, maybe a little bit of hike, but it may be around the same, right? So it is very important to understand the difference of third-party motor insurance for private vehicles as well as commercial vehicles.
Fair enough. Now, for the purpose of the conversation now, let's focus on private vehicles. Bulk of the audience watching the show is also interested in knowing more about those trends. So, Mahavir, now coming to what you said, that comprehensive plans themselves are evolving. And you mentioned that a lot of what used to be add-on riders, they're being built into the product itself. So just elaborate on that. And then therefore, if I'm looking for a new comprehensive policy, apart from obviously the mandatory third-party cover, what are the typical features that I should perhaps consider?
Right. So most of this would come down to basically choosing add-ons, right? Because once you've taken a decision to take a comprehensive cover, you have a policy in your hand now. And now you are basically looking at beyond add-ons, there would be basically pay-as-you-drive that you have. So like, let's go step by step. So pay-as-you-drive is one option that a customer has. If the person is not using his car regularly, and typically if the number of kilometers that the person is using is not very high, then pay-as-you-drive is an option that is now upfront available by most insurance companies. And it is something that can be used to reduce your premiums. It's not going to reduce your premium significantly, but it definitely is a saving on whatever you're going to pay. So typically 20% of the premium can be saved is what I've seen more or less in most cases. Then we come to add-ons. In the add-on section, basically zero depreciation is an add-on which is the most popular. It actually helps you reduce your out-of-pocket expenses, because all the depreciation of parts that typically would have to be paid by you now don't need to be paid by you. It can be basically part of the claim that the insurance company pays you. So largely, you only end up paying voluntary deductibles, voluntary deductibles, yes, and the deductibles, the mandatory deductibles that are there in the policy. In this specific thing, in zero depreciation, there's one important thing to understand is that insurance companies may put a cap on this, that you can use it only once or twice. So that's something that people should first understand before they take this. Beyond this, there are other add-ons that are available. Like, for example, there is an add-on which is around engine protect, which usually is very useful for people who are living in flood-prone areas, right? Then there is an add-on which is for consumable, where basically all the consumables that are usually not payable in a motor insurance policy or comprehensive motor insurance policy also basically get paid. So the out-of-pocket further reduces, right? Then there are a host of other add-ons, right? Meaning which is around key replacement, there are add-ons for tire damage and all that. If you have an EV car, then there are EV add-ons that are available. Typically, these add-ons are around the battery protection as well as the protection of the charger and the entire, basically the infra around it.
Mahavir, right now, between a new EV car and a regular ICE car, and I'm talking about a comprehensive insurance cover, typically what's the price variance in the premium for an EV versus a regular ICE?
In terms of premium variance, it varies depending upon the brand of the car and a lot of other things where you live and all that. But typically, we've seen a 10 to 15% difference on the premium. That's the maximum that we've seen.
One final point on this, Mahavir, like you mentioned that, recent flooding, damage because of rainfall, trees falling, huge issue here in Mumbai at the start of July, right? Yeah. Typically, will a comprehensive policy cover all of this, or do I need to insure any specific add-on or a rider to make sure that my vehicle is covered?
Yeah, so the only add-on that for a person living in Mumbai and typically any flood-prone areas is the engine protect rider, which basically helps covering any kind of water entering into the engine because you've driven through floods, and that's what it protects. Typically, an engine kind of getting affected is not covered under insurance because it's typically a part of the of a manufacturing-related problem.
Yeah.
But only for floods and water ingress is what's called in the technical language. When water enters the vehicle and engine is damaged, then that is covered using the engine protect cover.
Okay.
Apart from that, a tree falling or your car getting basically damaged because of water, all that is typically covered under the comprehensive policy itself.
Okay, so got it. If you are in, living in an area where typically you get heavy monsoons, make sure you have an engine protection cover. I think that's the point. That's well made. Got it. Let's take a quick break on that note. We've just covered motor insurance and the basics here. On the other side, we'll talk about home insurance, why that is so important. It doesn't matter whether you're a homeowner or whether you're a tenant. Home insurance and all the details on that coming up after the break.
Let's talk money. Let's Talk Money.
Welcome back. You're with us on Let's Talk Money, and this week we are discussing motor insurance and home insurance threadbare, two more insurance products that you must consider to get peace of mind when it comes to either your vehicle or, of course, your house. So we're in conversation with, of course, Mahavir Chopra as well as Rahul Agarwal. Now, gentlemen, let's pivot to home insurance. And I think, this, like I say, it's unfortunate that this comes up when you see around you or hear around you, typically fire cases where so much gets lost and damaged and, no one thought of insuring the contents of that house. So, Rahul, opening with you, let's just break this up. There are two types of home insurance, right? There's insurance for the structure of the house, whether it's an independent house, whether it's the apartment complex building, and then what's inside that house, right? That's how the policies work. Tell us more.
Yes. Yes. So when you buy a home insurance, there are two parts. One is the structure and one is the content. Content like your furniture, fixture, electronics, valuables. And why it is important to segregate both is because there are a lot of people in India or across the world. So some are home buyers and some are tenants. So while home buyers, homeowners and tenants. So while and as per law, only if you are owning the property that you can buy the insurance. So if you're a tenant, you are not supposed to buy the insurance for the property. But if you have the home contents, you have brought your furniture with you, appliances with you, then you can buy the insurance for that. So that's why this distinction is important. But if you're a homeowner and staying in your own flat, then of course you need to buy both the property for the structure as well as for the contents.
So I have a follow-up question for homeowners here. Now, a lot of people would be owning apartments, right? And typically, maybe the housing society itself has, an insurance plan for the whole building. Then do I still have to take another insurance separately for the structure of my apartment or flat? This is a question specifically for people owning an apartment as part of a complex or a building. Mahavir?
Yeah, absolutely true. Societies and basically will have their own insurance to cover the structure of the building. And that's what is something that people should know. They don't need to take a cover for the structure. What they need to take a cover for is largely for the contents inside their house, largely the interiors, any fancy equipments that they have, white goods that they have, even things like public liability can be covered if someone is basically wanting to cover their people who are coming to their house. Those kind of things basically can be looked at. Valuables, one of the things which Rahul mentioned, is something that for sure is something that should be part of it. Like, for example, gold that is there in your house can be covered as a part of it. In fact, gold in the locker also can be part of an add-on that you can take within the policy, within the home insurance policy.
Okay, but before I talk about contents, Rahul, your thoughts on this? So I live in an apartment complex. I own the apartment. There is let's say a water pipe bursts and my entire wall is damaged or my ceiling partially caves in. So is that damage going to be covered in the policy that the housing society itself took? What is my recourse in such a case? I'm talking about damage to my apartment.
Yes, so that's a little ambiguous, Surbi, and that's why it is very important to take a separate cover. I'll explain you the difference. When a society is buying the insurance for the building, their idea is basically to protect the entire outer structure, because if something happens to the outer structure or to the walls or common facilities, the housing society is responsible. No owner will come and get that done. So that is the prime concern of the society buying the insurance, right? But as a homeowner, right, you must buy both content as well as the home, right? Because there could be a lot of internal damages. Just like you said, there's a home rainwater seepage, which can create a lot of damage in the house. And also, now note, the additional premium of the property is extremely low, okay? So let's say even if you have a 2,000 square feet home in a posh locality in Bombay, right? The cost of structure might not even be, let's say, 400, 500 rupees per year, right? So it's better to have your own policy, which is covering your structure as well and the content as well. Now, let's imagine even if your structure is covered in the society policy and there's some claim where part of your structure is damaged and your contents are damaged. So then you'll have to make two claims to two different insurance companies and two different policies. which may be quite a hassle. So even if your society is covering the entire building in the structure, it's more prudent to take a comprehensive policy as a homeowner.
Okay, all right, makes sense. So we'll keep that in mind. And now I want to come to the contents of the house. Like both of you mentioned that valuables can be insured, gold, important appliances, etc. Now, Mahavir, how is all of this assessed and calculated? I could have art, like you said, I could have gold. I could have, these really fancy, electronic devices, television. These days, even an iPhone is like worth a lakh, right? So just take us through how this is arrived at, the value of the contents in the house. How do I get the insurance?
Yeah, so typically it will work in a similar fashion how a car insurance would work. Like when you do a car insurance, there's something called ITV, right? Which is basically your declared value of anything that you're insuring. So similarly, when you're basically looking at buying an insurance for the contents, you typically will have to factor depreciation on anything that you're insuring and then basically declare that value. Typically, how this is done is you actually get in an expert who basically has been doing this on a regular basis, someone who's doing home insurance, and then get them to help you do this well. Because for a regular user who's probably buying home insurance first time in his life, it could actually be very complicated for them to do it.
Okay. By the way, I want to point out here that home insurance in India comes in the form of a standardized policy, which I think the IRDA has put together. So that way it's easy for us, future policy buyers. It's called the Bharat Grah Raksha policy, right, Rahul? The standardized document.
Yes.
Okay. Yeah, I think we have some, some samples there as to what is the kind of various, pricing ranges depending on what is the value that you're insuring. So as we're rounding this off, quick checklist on buying home insurance, what all to keep in mind? Rahul, quickly.
Yeah, so of course, first you need to assess the value of the structure. So normally the cost of construction, it's always better to take on a little higher side. But where you go wrong, as Mahaviji said, is the content, right? You have to define the contents very properly. You have to give the valuation, especially for expensive stuff, like let's say for gold, right? You have some jewelry in the house or you have some expensive painting or artifacts, right? Then you have to provide the valuation certificate. Just mentioning that I have 20 lakhs worth of jewelry will not suffice. You need to have a proper valuation certificate. And for the rest of the content also, you need to assign a proper value. If you are capable, fine. Otherwise, there are valuers who can do it. It's a one-time effort. But the more effort you put in designing the policy and giving a proper cover, the easier it becomes at the time of the claim. And plus, now there are a lot of add-ons, even in home insurance, a lot of innovation is happening. Right? And I'm sure in the next 3 to 5 years, you will see this category growing very rapidly. For small, let's say now some insurers have started giving you additional rent. Let's say if something happens in your house and you have to stay out of the house for a month, right? Then they are even to the extent they're paying you rent for 1 month accommodation in an alternate space, right? So yes, so most of the time the valuation and listing down the household items is very important. Because there are so many electronics, even phones. And yes, a small correction, iPhone doesn't come for 1 lakh. I just had to spend a lot of money for my daughter. So even yes, a phone can be very expensive, right? So listing all the items, giving their valuation, it's a one-time effort, but that needs to be done. There's no shortcut.
Get it done. I know. I'm saving the hardest question for the last because I know this home insurance is going to be absolutely dependent on each individual case, which city, whether it's a 2 BHK house, 3 BHK, what are the contents of the house. So I know it's impossible to generalize, but still, just for the sake of having a reference point, say you're talking about a 2 BHK house in, say, a city like Delhi, middle class or upper affluent middle class family. Typically, 3-4 people stay in that household. I mean, I'm again talking about target viewers of this very show. What is the kind of cover they should take? Typically, it should be a 1 crore, more than one. And what is the average rough premium that you should be mentally prepared to fork out? I know this is a guesstimate question.
Yes. So just for viewers to understand, let's say 2 BHK, which could be about 1,000 square feet in a decent locality, where the cost of construction would be about, let's say, 3,000. The cost of apartment comes to 30 lakh rupees, and assuming a 20-30 lakh furniture and another 20 lakh rupees worth of electronics and jewelry. So if the total sum insured is about 80 lakh rupees, your premium would come about 2,000 to 3,000 on a higher side, right? So this is, as I said, very, very low. And if you take a 5-year policy as shown by your team, the premium again for 5 years maybe 5,000-6,000 rupees or 7,000 rupees. And it makes sense to take a 5-year policy so that you don't, of course, forget renewing the policy every year. Right?
Okay.
So as you can see, the premium is very, very low.
Yeah.
80 lakhs home. And let's not forget, the market value would be much higher. I'm only taking the cost of construction of the apartment, right?
True.
The market value of the same property may be 1.5 or 2 crore.
Yeah.
So 1.5, 2 crore house, cost of premium 2,000 rupees per year.
I think it's a small price to pay to get the assurance, the peace of mind that you have a backup in case anything goes wrong, in case you see unforeseen circumstances. All right, gentlemen, slightly hurried, slightly rushed, but I think we've touched upon some very, very important points. They give plenty of food for thought to this audience to think about how they can get the best possible motor vehicle insurance as well as the home insurance to save their prized possessions. Thank you so much for joining us and giving us all the perspective today, Mahavir and Rahul.
Thank you. Thank you, Surbhi.
All right, well, with that, we're out of time. Hopefully you found this conversation useful. Keep sending us your feedback, comments, and queries. We'll see you with another theme next week.
Let's talk money.
Hello and welcome to News Center. I am Ashmit Kumar. Now, a coalition of 25 U.S. states has sued the Trump administration over its latest round of tariffs on nearly 60 trading partners. The states are asking the U.S. Court of International Trade to block the levies, arguing that President is once again overstepping his authority and using forced labor concerns as a pretext to reimpose tariffs that were declared illegal earlier. The new duties, ranging from 10 to 12.5%, have been imposed under Section 301 of the Trade Act and covers over 99% of U.S. imports. The White House rejected this lawsuit and defended the tariff, saying that the U.S. is using lawful authority to eliminate unreasonable acts and policies burdening U.S. commerce. The new tariffs came after the U.S. Supreme Court dealt the president a major setback in February, ruling that the International Emergency Economic Powers Act does not give the president the power to impose tariffs. Now, India is among the economies impacted by the latest round of tariffs, with Indian exports facing a 10% levy. This comes even as New Delhi and Washington continue to negotiate on a bilateral trade agreement. Both sides have indicated that the talks are now in their final stages, raising questions over what the latest tariff move could mean for the proposed deal. And well, joining us now to help us unpack that question is with us Trent Dasgupta, former ambassador to the WTO. Also joining us shortly in a bit will be Mr. Ajay Dua, former Secretary of Commerce. First, coming to you, Mr. Dasgupta, tell us what the 25 states essentially are arguing in courts now is that what Donald Trump could not do directly is now trying to do indirectly through this ruse called Section 301. Your quick take on that.
The way Section 301 is constructed, it gives the president wide authority to impose tariffs after going through the due process. And the U.S. administration under the USTR seems to have gone through the due process by inviting comments, for instance, carrying out an investigation first, then inviting comments from the public, then from the interested parties. So to that extent, I think there would be some safeguarding of the president's viewpoint that he is well within his powers to impose tariffs or take other action that is also allowed to protect America's commercial interests. As far as this other point that you mentioned, that what he could not have done directly, he is doing indirectly, which is imposing tariffs, because the tariffs under Section 122 have had to be withdrawn after 6 months, which is on the 24th of July. So, perforce, he has now imposed 10 to 12.5% tariffs on 59 countries plus the European Union, which accounts for 99.4% of the total imports of the US, which is a very high number. So, this is something which goes against the US administration's actions.
Sure.
The court will have to take a view on which argument is stronger.
Well, that's an interesting debate to be had in the US and as well as here in New Delhi, the national capital. On that note, let's also get in Mr. Dua, who's joining us live as well. Mr. Dua, thank you so much for joining us. The same question that I asked Mr. Dasgupta as well to you. Are we looking at a situation where Donald Trump is trying to do indirectly what he could not have done directly, as we found out in the month of February? Because essentially what the 25 states are arguing is that this is simply impermissible, that Section 301 is a ruse. The timing of it indicates that it's only meant to supplement the tariffs that were already due to expire, and therefore arguing that this is a ruse. This will essentially, this exercise is going forward with predetermined objectives as dictated by Donald Trump.
Thank you, Ashwin. I totally share the view expressed that it's not going to be easy for President Trump to defend his action for 2 or 3 reasons. One, the 25 states are covering almost the entire imports of the US, 99.4% as an assessment made yesterday. Second, the action its timing itself is suspect. On the 24th of July, President's powers to levy tax for 150 days, which he had made use of, and levied a 10% duty all over the world. That expired. He brings in Section 301, and under that, he brings in the clause of forced labor. The fact of the matter is the 60 countries chosen and the United States and the European Union are virtually, as I mentioned, the entire set of imports come from them. And he has done it not earlier, not later, on the day, on the 23rd of July, on the 24th, next day, his powers of 10% under the other clause ending. So having said that, I think the president is going to have a very tough time going forward. Two other reasons, as have been mentioned in the commentaries. One is that forced labor collecting taxes should have been accompanied by what is he going to do with respect to abolition or mitigation of forced labor in these 61 countries, because the argument made for allowing him to do this is to minimize or reduce the impediment which is seen as an impediment by the United States. There is no such program announced, neither by him.
Sure.
Second is the question of what he has announced is going to be challenged on the ground that, all right, he's going to get certain income at 10%, at certain countries 10%, certain 12.5%, with India falling in the 10% category, that those taxes are liable to be paid by the citizens of US because they are the ones importing, and that's not fair to tax them when the benefits are much lower, even the perceived benefits of forced labor being mitigated. So I think there are a set of arguments clearly which could go against the president.
Right. So it's a challenging situation he finds himself in. We've also, in fact, heard from the MEA on what the status of the deal is. We'll come to that in just a bit. But Mr. Dasgupta, another question I want to get your thoughts on before we hear from the MEA is that even if we saw the Supreme Court in the United States showing spine, striking down the tariff powers of Donald Trump, should this legal process again culminate with the striking down of Section 301 and the subsequent tariffs? What many trade experts tell us is that, look, Donald Trump is not shy of powers. It's not that he'll be shy of, he has enough powder that's been kept dry. He has enough loopholes to work with that even if 301 gets shot down, there are other tools he has in his arsenal to levy even further tariffs.
My first reaction to that is that the US Supreme Court, barring the case dealing with the International Emergency Economic Powers Act, under which President Trump had applied differential tariffs on different countries amounting to as much as 50% against India, for instance, that was exceeding his authority, because that was within the authority of the US Congress to apply. And this is a different matter altogether, because this is within the president's powers. Whether he has exercised his powers in a bona fide manner or not, that remains to be seen by the US Supreme Court. But as I was saying, the US Supreme Court, barring this IEEPA action of annulling President Trump's actions, has upheld President Trump's actions in many other cases where there was a discretion. And this Supreme Court has a, mind you, 6-3 majority of Republican-oriented judges, or judges who have been appointed by Republican presidents. So I think there is, on balance, this Section 301 challenge may not be sustainable.
Well, it's interesting, and we'll, of course, have to see how that plays out. But on that note, let's listen in to officials from the Ministry of External Affairs. When they were asked about the latest challenge to Donald Trump's tariffs, the spokesperson had to say that this, of course, is the final leg of the India-US trade deal. Take a look.
Look, the conversation between India and the United States on the proposed bilateral trade agreement is ongoing. Both sides have done a lot of work in this regard. There are certain issues which needs finalization, and both countries are working towards finalization of the interim bilateral trade agreement.
Well, Mr. Dua, let me get your thoughts on, of course, the implications of this challenge, legal challenge in the United States on the India-US trade deal. The question I want to ask is, we've not, of course, signed any interim deal as of right now. India is standing firm on preferential access. Should we wait out, perhaps, to see what the legal landscape then evolves into in the United States? Should we wait for a decision on this by US courts?
I think so. For the simple reason that signing an interim deal, and its interim may have a sunset clause. It may be limited to a few items on which there is an understanding, a bilateral understanding. But at the same time, if the Damocles sword of 301 continues to hang over the rates agreed to, I think there could be a problem for India. India wouldn't be better off than what it is, or worse off than what it is today. It will actually end up being worse off. So I would think that India should wait out, let this issue of 301, which is now before the US Court of International Trade, not yet before the Supreme Court, which probably from there it can go to the Supreme Court, from this federal court. But at the same time, some experts, economists, as well as traders, are also planning to go straight to the US Supreme Court because saying that the order which you passed in February stands revoked and stands kind of bypassed in a way, manner revoked. So please entertain that. So having said that, I would say that the chance, in my view, slightly different from my colleague Jan, but that the US has not done the homework which was required to be done, even with respect to forced labor for all the 60 countries. It had selected the 60 countries on the basis of the trade by investigating one or two places, not hearing all the 60 countries' point of view. It has said we are levying this duty 12%.
Exercise is what you're calling the Section 301 tariffs. Let me take that across to Mr. Dasgupta. Viewing this issue from the lens of the India-US trade deal, the fact that these concerns are being raised by 25 out of 50 states in the United States, does that only cement the fears that India has been talking about to the USTR, that, look, we're afraid that even if we do sign the deal, there'll be that apprehension that you'll come forward with some unilateral action with no legal safeguard, leaving India exposed?
Yes, that is a real fear. And I agree entirely with Dr. Ajay Dua that we should wait for the verdict. It has the 25 states have filed this petition in the Court of International Trade, after which there is an appellate body, the Federal Appeals Court, and then the Supreme Court. So if it runs out its full course, it may take up to a year or just under a year before a final decision of the Supreme Court. And mind you, there are two other small companies which have also filed a case against the US administration for levying these tariffs. That is on a separate track. If there are companies which want to approach the Supreme Court directly, then perhaps it could be resolved earlier. But having said that, the main problem with the India-US trade deal is that there is no reciprocity which is being offered by the US. India has asked for two things very clearly. One is that there has to be some reciprocity, which means that the US has to also offer market access. It can't just say that from, let's say, an average tariff of 4%, I am raising the tariff to 18%. And that is all. There is nothing which I am going to offer to India by way of market access. So reciprocity is one thing. The second aspect is that India says that at the end of the day, it should have a better status in terms of tariffs and market access than its competitors. And by that, it means the Southeast Asian countries and some South Asian countries as well. Some South American countries could also be in that group. So this is something also which needs to be ensured. And as matters stand today, India is facing a tariff of 10%, and 99.4% of the exporters to the US are all facing similar tariffs. So I don't think India is in a worse off situation than any others. So what is the hurry in accepting an interim trade deal or signing off before the 301 decision of the US administration comes under scrutiny of the Supreme Court?
So no reason to rush into an interim trade deal. Does the data corroborate that, Mr. Dua? We saw the exports to the US rising a fair bit despite the tariff burden. Can India maintain that momentum with this 10% levy that we're looking at while we wait and watch for clarity from US courts?
Ashwin, we have survived even the slightly higher duties with, but because of the Russian, the export from or imported from Russia, the crude oil. And now there is a threat of it, certainly. The Senate has passed it, but not the Congress as a whole. We don't know what will happen overall. But I do think that with 10% now, we could, including our labor-intensive exports, could maintain their momentum of export to the US. Let's also appreciate the fact that the US has given exemption even from whatever the levy was earlier or the 10% imposed now, including under the forced labor guise. They are not taxing everything. For instance, the generic medicines are not being taxed. Certain components which the US needs, US industry needs, be it of airplanes or be it of even EVs, they have kept them outside the purview of the US taxation. So I'm optimistic that with the Indian imports of US of LPG continuing to increase, last month's figures, 54% of our LPG came from the US, and the US is now seeing the so-called trade gap between the two of us, the so-called trade deficit, is not as bad as it was before. So I think we will continue looking at the fluid situation in the Gulf. LPG in large quantities could continue to come from the US, get increased, and that might keep the US happy and not take any further, I would say, abrupt action against India.
Right, Mr. Dua. Right, Mr. Dua, again, and a very valid point there that even as we talk about this 12.5% tariff, the US is contemplating a bill that could levy a tariff as high as 100% on buyers of Russian crude, which includes China and India. But that's all the time that we have. I'd like to thank both Ambassador Dasgupta, Dr. Dua for joining us for their time and insight. On that note, let's slip into a very short break. On the other side, NVIDIA places the chips on server, leads a $74 million funding round in the homegrown AI company. Investment is a part of a larger $300 million fundraise, valuing Sarvam at around $1.5 billion. We get you that exclusive conversation with the co-founder, Pratyush Kumar, on the other side. Welcome back. Now, NVIDIA has bet big on Indian AI startup Sarvam. The chip giant led a $74 million funding round in the homegrown AI company. The investment is part of a larger $300 million fundraise, and this will value Sarvam at around $1.5 billion. Sarvam already trains on NVIDIA hardware. At its developer conference last week, it said that it has access to about 2,000 Blackwell GPUs and is targeting 10,000 alongside a sovereign data center partnership with HCL Tech in Odisha. So, NVIDIA was already the supplier. What changes today is that the supplier now becomes a shareholder. My colleague Ritu Singh spoke with the company's co-founder on its funding needs and its growth vision going forward. Listen in.
I know you've raised $300 million recently, but is that capital going to be sufficient? Would you require more?
Of course, we will continue to raise. As you know, this is an area where capital is one of those key ingredients, right?
Yeah.
Because as you rightly said, you need these accelerators to run AI GPUs, and they're not cheap, right?
Yeah.
So you need to be able to procure them, and hence capital is important. But the flywheel of AI, which is you invest in the infrastructure, needs to translate to ROI for companies. Now we are very focused on that, which means efficiency at each layer, but actually solving business problems where there are value pools, right? And we are very confident that we are at a place where we can crank this lever and demonstrate success and then keep investing more to have an Indian alternative to the AI infrastructure.
Absolutely. And, let me just ask you, since there's been numerous reports about it and you yourself say you will be requiring more capital, is the government of India looking to invest in Sarvam?
I'm happy to comment once we have more official confirmation of that. But bottom line is this, so firstly, as you rightly said, with the India AI mission, the government did support the building of the first model. And the government is a very strong stakeholder in this concept of a sovereign AI, because India needs to absolutely have an alternative, because it's not clear when the export controls come in. Today there are open Chinese models, maybe next year they aren't there, right? So we absolutely need to be doing that. But we also are very clear that we are a private company innovating in this space, right? And with the government, there are interesting things where we are working with state governments, for example, across the board, to provide them solutions that work, right? So working closely with the government is very much part of our thought process. Investments and ownership is a more detailed conversation, right? But we are open to it. I think that globally this has become something which has been tied to geopolitical and sovereign considerations. And we are very much an India first player.
So let me get to what all of this means in terms of growth for the company, in terms of the kind of profits and revenues you're generating. You haven't officially commented much on this, but I believe the last reported figure was about 45 crores of revenue for FY26. Your last commanded valuation was $1.5 billion. It's a huge gap. How fast is revenue scaling up as you also continue to burn through a lot of capital to make these kind of product innovations that you're doing?
Yeah, the revenue is really picking up, not just because of the new stuff we are launching, but with the new products that have been in the market over the last couple of quarters. But I think this phase is now an entirely new era. So I think of this as labs. And we started off as a research organization that said we could go and build our models. We were able to prove that. And that's what the new investment is a representation of, which, by the way, is very little compared to how the value funds model companies and AI companies. Now it's really about scaling it up on the revenue side. Now it's about getting closer to business, making components that people want, whether it's at the infrastructure, model, or application layer. And we are really projecting a fast growth in what we are doing.
And where is that going to come from? Again, to repeat all of these things you're doing, I forgot to add data centers there as well that you've just announced in Odisha. So, what are the fastest growing segments? What are the most profitable segments for you?
As I said, right, the first thing is people want infrastructure. People want to be able to access models. Our models, open models, we're going to make that available in India. In fact, that's an important thing, right? You need to be able to make in India, and you need to make AI in India at scale. That's going to be very interesting. We are actually continuing to see momentum on the voice AI side, which remains one of the key products that we have. But with products that are equivalent to Microsoft Copilot or Anthropic Cowork or Gemini Enterprise, now we have a real solution for enterprises to adopt us, right? build custom things for them, actually show that it works, right? So we are deeply interested in scaling that up. And also, of course, in the public sector and in the strategic sectors, where products like this need to work within their infrastructure given the security. That's also going to be very important. And the final thing is, I think I'm very keen to establish research partnerships with the most influential institutions in the country, because they're all grappling with a certain moment where they need to figure out what to do with AI. Right? As you said, who of these many vendors to work with? Should they build versus buy? So we come in not as all just providing our wares, but as a thought partner to do that. And I think we are seeing great traction for that line of thinking.
Completely deflected my financial question, but let me just end by asking you, what next? I mean, you've spoken about a whole lot of things that Saram started with, is building, is set to launch. What next? What are you most excited about?
I'm really excited about this phase. We are sort of like getting super real in the market out there. I see a lot more people using us. We just had a build-a-thon. Almost 1 million people now on our platform using different parts of our stack. So I think this is a phase where a lot more usage on our platform comes in. We get feedback, we iterate quickly. So it's one of those fast laps that we'll have to do now. It's a straight lap. We'll accelerate, and I think the whole team is charged. It's very interesting to see, very young team, maybe average age of 25.
Yeah, I felt the oldest person in the room.
It's interesting. It's infectious energy. So that's the iteration we are on, and that's what is exciting.
Well, here's an important developing story straight out of West Asia. U.S. Treasury Secretary Scott Bessent, in an exclusive conversation with CNBC, has said that Washington will likely have a deal with Iran by tomorrow. Earlier, Qatar also said that the language for a possible resolution has been drafted and is being circulated between the parties. Let's listen in. Well, this, of course, has been a developing situation. Mind you, Donald Trump was under severe pressure, was looking for an off-ramp. At least that's what the commentators had been saying. And since then, Donald Trump held back on the attacks. The language that he has been using, of course, has been twofold. On one side, threatening unequivocal damage as far as Iran is concerned, but at the same breath also saying that perhaps there is a conversation to be had with Tehran on an off-ramp, on a resolution, on some kind of interim framework for the situation straight out of West Asia. On that note, let's listen in to Treasury Secretary Scott Bessent. He has hinted that a deal with Iran to open the Strait of Hormuz may fructify as early as tomorrow.
We are in talks with the Iranians, and I think there is a chance we may have a deal today or tomorrow to open the strait and move towards a more normalized position in this conflict.
The idea of having a deal today or tomorrow to reopen the strait, would that be reopening the strait, but the Iranians somehow having the ability to charge a toll on that? Or would that be reopening the strait and it's free and clear and anybody can move through?
I think it would be freedom of movement. And even though things are still a little dicey there over the past few days, we've saw quite a few ships coming out even now. So, I'd expect the energy prices to settle back down, which, as I said, will be good for the entire world.
So breakthroughs around the corner. Scott Bessent there hinting that perhaps a framework could be in place. We could see the signs of that as early as tomorrow. But with that, it's a wrap on this edition of News Center. More news and updates will continue right here.
Welcome to the Citizens Monetary Policy Committee deliberations. The August policy of the Reserve Bank comes at a time when the crude shocks are not quite over, global uncertainty is there, but there is also a massive global capex underway because of artificial intelligence-related investments. So how should the RBI proceed with its policy as inflation starts ticking up? Joining me are the members of the Citizens Monetary Policy Committee of CNBC TV 18. I have with me Samiran Chakrabarti of Citi, Soumyakanti Ghosh of SBI, Sajid Chinoy of JP Morgan, Sonal Verma of Nomura, and the chairman of our committee, Dr. Pranab Sen, the former chief statistician of India and former chairman of the Planning Commission. Gentlemen and Sonal, thank you very much indeed for your time. Well, we have to start with inflation because that clearly is becoming a persistent danger. So to you, Samiran, how do you see the inflation trajectory panning out? After all, we are seeing Asian countries reporting higher PPIs. Our own WPI has shot up. So what's your forecast and what may RBI do to its forecast?
So historically, clearly, there is a correlation between the WPI feeding into the CPI core. But what is interesting is that there is often a comparison done between this episode with what happened during that Ukraine war period. And we saw almost an exact increase of about 7.5% over a 4-month period during Ukraine war in WPI. And then over the next 12 months, that entire increase got corrected downwards. Now, this time around, this is something, whether it happens or not, will be very interesting to see from a CPI perspective, that if it is just a one-time shock in raw material cost and then it dissipates, then maybe the companies will take it more in their margins rather than passing it on to the headline CPI number. So that's something that we have kept in mind while projecting our core inflation also. At this moment, what we are looking at is that the core inflation number moves higher in the latter part of the year, but does not become a very ugly number.
So, Sajid, you know, globally, what should the RBI take into consideration while setting the policy? The Fed is perhaps not done with its hikes. We saw Bank of Korea, Bank of Japan, all of them on the hawkish side. So what should the global takeaways be?
It's a multitude of shocks in the global economy. It's not just one. Yes, people focus on the Fed because, you know, what you're seeing is in developed markets, inflation has been extremely sticky, whether it's, in the euro area, whether it's especially in the US, whether it's in Japan. And so we will expect some kind of synchronized monetary tightening cycle across the world. Now, I think some of these fears are overstated. We got a core PCE number last night from the US, which was quite benign, 0.13. So I think there's no urgency for the Fed to hike in September, but markets still believe there'll be about a couple of hikes over the next year. But for me, it's not just any one shock. There are 4 different global shocks that the central bank will have to be very focused on. One is the tightening by developed market central banks. The second is the fact that the Middle East shock hasn't really dissipated. Crude is back up above 90, and there are still concerns about whether the strait will fully open. Will we have this intermittent closing and opening that's going to keep the energy complex nervous, especially because refined capacities in Russia as well have been damaged. So you've got an oil, simmering oil price shock as well. Number 3, tariffs are back on the table. Section 122 is rolled off, and what we found is President Trump has reached into his pocket and found Section 338 of the Smoot-Hawley Act of the 1930s, which has never been used again, which he believes he can use like AIPA to impose country-specific tariffs. And then we've got El Nino, which is, working through its way through the region and could cast its, longer shadow later in the year.
There are also many positives. We had this tariff and crude uncertainty for the past 6 months and tariff even for the past 18 months. But Sonal, highest ever credit offtake in the past 2 years. Excellent auto sales numbers. The PMI numbers are strong. Look at the IIP number. That's very strong. Global capex, Asian capex strong. Do you think RBI has to actually upgrade its growth forecast? Your thoughts on growth?
Lata. I think not just in India, but across most countries, I think growth has been more resilient than people had feared, both last year with the tariff shock and this year with the Iran shock. So I think particularly for India, managing of the supply side of energy shock, plus the government absorbing some of the cost increase, I think has protected the consumers. And as you put it, most of the high frequency indicators in the April-June quarter point to an economy that has sustained a very strong momentum, particularly in consumption. So we think Q1 GDP is likely to surprise on the upside. The RBI had projected a 6.6%. Our own forecast is a 7.2%. So things look pretty good. I think the challenge really starts in terms of the two big uncertainties that are ahead and how they impact the growth outlook. Number one is the oil price increase, and second is the El Nino impact on food production and therefore rural consumption going forward. We do think that there will be some tapering of the growth momentum as the year progresses. Cost pressures build up for the manufacturing firms has been quite substantial. That does imply that the value addition will be much lower than what we had seen last year. And with July is done, sowing is marginally lower than last year. We do think there'll be some moderation in food production and therefore modest, adverse impact on rural consumption. Although the impact of this is more likely to be visible after September, October, so back half of FY27. And we've also seen some moderation in sectors like services exports, which we need to monitor how they play out going forward. So absolutely right, things have been extremely resilient, but I think there are still downside risks that could offset some of the positives we are starting off with. So all told, I think 6.6% that the Reserve Bank has projected for FY27 probably makes sense to hold on to that projection for now until we have more clarity on how these uncertainties actually play out.
No, I take your point on margins. The current corporate earnings season, clearly revenue growth is higher than EBITDA growth. So clearly, the cost pressures are there. Let's see how it impinges on the GDP. But rupee, Soumya, on that, rupee was the talking point in the previous policy. Is it yesterday's story and the Reserve Bank doesn't have to bother about it, or will it impinge? The MPC has to worry about it.
Thank you, Lata. No, I think as secondly put out by the other members, I think even as all the other momentums look good at this point of time on the growth, and also on the external sector, the situation has significantly flipped. And when we have discussed last time in terms of a BOP deficit, from a high BOP deficit to a quite decent BOP surplus projections at this point of time. But having said that, I think the rupee movements have actually not in sync with whatever has been the outcome on the external sector. If we actually look into the value of the rupee since April 2025, the rupee actually depreciated close to 12% over the entire period. And during the period April to February, before the war started, the rupee depreciation was, I think, the second highest to Japan. And after the war started also, the rupee has continued to depreciate, and it remains among the top three currencies in depreciation. Only in the last couple of days, including today, there has been a positive moves on the rupee. The point to note over here is that I think as FCNRB flows come in, the projections gets updated, and the point to note is that the entire policy package was to flip the negativity on the external sector in terms of the capital outflows, and that's why the series of steps were announced in the first week of April. My sense is that if you compare this with the 2013 and even the 1998 Asian crisis, the rupee had actually strongly bounced back after the measures were announced. If that is not the case this time, and the rupee, suppose as per the fair value, even the Reserve Bank of own interpretation in terms of an undervaluation a couple of days back, as per the governor's interview. I think all these points that if the rupee doesn't significantly make up from the lost ground in the last couple of months or the last couple of years, it would be difficult to sustain the momentum when the extended window is over. And that actually could be a setback in terms of the overall currency.
That's an important point. That's very important, and RBI will worry about it. I don't know if they'll announce anything or talk up the currency during the press conference. Dr. Sen, if you can, round it all up, how would you assess the India growth inflation mix? Do you think a rate hike is needed now or in the year itself?
Not at all. Okay. All right. At the moment, we are in a situation where I think the price effects have already been factored in. However, the quantity effects are yet to come. Okay. And I think what we are looking at is a situation where there will be pressure on growth. And we're going to have to manage that. The really important question out here is the timing.
Let me just show you my colleague Ritu, who did a poll with several economists, and it looks like an overwhelming number does not expect change. Actually, 100% are expecting a hold. But what about stands? What will the governor guide? All those questions to the Citizens MPC after the break. Welcome back to the deliberations of CNBC TV 18's Citizens Monetary Policy Committee. I have been speaking with the members of our committee, Samiran Chakrabarti, Sajid Chinoy, Soumyakanti Ghosh, Sonal Verma, and our chairman, Dr. Pranab Sen. Gentlemen, and Sonal, thank you very much for staying on and for your patience. Before going to the break, Soumya highlighted that the rupee threat is not quite over, and therefore, while I accept that FCNR is done and those steps, that will also result in a liquidity problem. So that question to you, Samiran, how will RBI handle the resultant liquidity?
I think August policy might be too early for RBI to lay out its game plan on how to manage the liquidity part. But our sense is that with our somewhat conservative estimate of about $60 billion inflow through these schemes, we could still end up with about 8 to 9 trillion rupees of durable liquidity surplus by end September. Now, the question is that if you just compare with 2013, that scheme was primarily running during the festive season, and the increase in currency in circulation took care of much of the liquidity that came in. This time around, the currency in circulation increase in festive season will happen only from October onwards. So the RBI will have to push the problem by a couple of months. And that's where our sense is the most preferred choice could actually be using the VRRR, maybe slightly longer dated VRRR, to just push the liquidity problem for the October-November period, rather than taking any significant steps. The other big distinction is that in 2013, the stated RBI stance was that monetary policy transmission works best under tight liquidity conditions. That is not the situation anymore. Now RBI often has run more surplus liquidity conditions, and it's possible that RBI does not go into cash management bill issuance or doing OMO sale type of things to suck out liquidity in a more durable way. But a lot will also depend upon how the in general yields behave when the flows hit the market. If the fall in yields, RBI consider them to be in excess of what fundamentals would suggest, then they might have to take some liquidity actions on the back of that.
Okay, so liquidity is not going to figure in the policy statement itself. Let's see if they'll give us some hints in the press conference. But, the governor in his interview to Business Line already told us what he will watch out for. He said they see some signs of generalized inflation. Now, Sajid, if you can help us, what do you think will be the exact numbers or data streams they will watch out for the next decision whether to hike or not?
But I think the governor's comments are important because what we are experiencing this year, both through oil and through the prospect of an El Nino, is a supply shock, right? And the central bank dharma is, if it's a temporary supply shock, there's nothing that central banks can do about it, and so you look through it. Now, if the supply shock lasts for long enough, right, and it gets more generalized through an inflation expectations channel, that's when central banks respond. So what do you look at? First is to look at whether inflation is getting generalized. You look at core inflation, and core in India needs to be adjusted to understand the true underlying inflation, because core in India includes petrol, diesel, gold, and silver. Once you strip this out, and let's call that super core, which is the true underlying inflation, that has been very benign for a couple of years. It's not just for a few months. That super core is only running year on year at 2.5%. Now, year-on-year rates are sluggish. If you look at the momentum in the last 3 months, it's still running at 3.5%. So I think the central bank will look at how does that super core evolve? Are we seeing pressures of that broadening? If that's happening, then you get vigilant. The second thing to look at is going to be inflation expectations. Because remember, inflation is a function typically of slack in the economy and inflation expectations. Here you look both at household inflation expectations and firm expectations. What do you see? Household expectations are picking up. Forward-looking expectations 3 months ahead have moved up by 80 basis points, but in level terms are below where they were in 22-23. So this needs careful watching. You look at firm expectations, which for the last 4 or 5 months have been above 5%, but in the last round dipped down. So I think it's a combination of these things, Lata. This is more an art than a science. What's happening to firm and household inflation expectations, what's happening to core inflation, and why does core matter? It matters because ultimately when headline and core converge, you could have a situation where if you get a bad El Nino and food prices go up, headline could be 5.5% to 6%, core is going to be 3.5% for a few months. Which one do you trust? Okay. And as a lot of empirical work, including some work we've done in the last decade, has shown in India, typically when headline and core converge, it's headline that converges to core 12 months out and not vice versa. One final thing I'll say, why is it that core inflation has been so benign through all of these price shocks? And the sense there is that, India is still about 4 to 5% below its pre-pandemic potential path. Capacity utilization is still running around 75%. So there hasn't been an opportunity for firms to pass on input price shocks, more consistently. And whether they pass it on this time around is what the RBI will be watching very, very carefully.
Fair point. Sonal, now, if there are no steps being taken, will they change the stance at all? And more importantly, what will they, how will they guide? Will they tell us anything about if this happens, then I am going to hike? Will there be a hawkish guidance?
Yeah, Lata, I think it is optimal to retain the stance at neutral, primarily because the uncertainty on the El Nino impact on both inflation and growth, plus the various global uncertainties, whether oil prices will stick here or come down. I think there are just too many uncertainties to basically give any clear guidance at this stage. And the moment the stance is changed, I think that will be taken by markets as a clear signal that a hike is coming if we move away from neutral. So from a cost-benefit analysis perspective, I don't think it makes any sense to change the stance. The existing stance gives the RBI enough flexibility. Now, in terms of what the RBI can guide for, I think, are things that they are watching to assess whether they need to, change policy rates or not. It could be, the broadening out of inflation, what specifically that means. Is it the inflation expectations measure? Are there some signals on growth that they are monitoring? So I think parameters that they will be tracking to assess whether the current policy stance is appropriate or not, I think that is the guidance that needs to be given. We live in a world where the macro outlook changes almost every 2 months. And therefore, the firm commitment really has to be to stay vigilant and that policy will react as needed. So it will need to be a very data-dependent policy stance in this world.
Okay. Actually, Soumya, this is more of the same question for you. Samiran says that liquidity steps will not be announced. Really, what will change? Do you see any inflation target changing, any growth target changing? Just guide us. What should we look for in the policy and where?
No, I think, Lata, that's a fair question, and I agree somewhat to Samiran's point in terms of liquidity. It's been too early to speculate on the liquidity because that will depend entirely on the amount of capital flows, which at this point of time looks quite healthy, and anything close to 9 trillion could be an additional liquidity injected in the system. But what is likely to change is that I think we have already discussed it. Growth is running ahead of expectations, and the credit deposit gap currently is running at 500 basis points. So if there is adequate amount of liquidity inflows, and since most of these deposits will be in the mostly they are in the 5-year category, the FCNB deposits, the first thing is going to do is that it could change the asset liability profile of the banks a little bit in terms of the overall distribution. The second thing is what it like to do, as it happened in 2013, is that it could squeeze out the credit deposit gap to some extent. So for example, credit growth has a little bit moderated from last week. Now it is running at around 17.7% and deposit around 12.7%. So what it could happen is that the deposit growth moves towards 15%, and even if the credit growth stays at that level, it will be easier for the banks to fund the credit opportunities, because in our sense it will continue to come along in a situation when geopolitical conflicts has taken center stage. We have seen it in 2005 where oil prices were very high and there was a significant pickup in credit growth. This is also likely to continue this year with a significant pickup in working capital loans. So that I think will be the most important development post these measures.
Okay. Yeah, and that will be very good for banks. And perhaps the Reserve Bank will take some courage from that. So now that was what we should watch from the policy. Dr. Sen, to wind up, since you have been there, done that for so many decades on Indian economy, how should the RBI sound? What should be the RBI's guidance be?
Cautious with optimism. Cautious in the sense that we don't know how long this US-Iran war is going to drag on. And we don't know the further extension of disruption that may happen because of the Houthis. So there is a lot of uncertainty even now. But so some things have already fallen into place. And the likelihood is that going forward, the other sort of blocks will also be taken care of. But it's going to take time. So I think it should be a cautious optimism.
I agree with the optimism part as well, sir. Somehow I seem to be the only one on the street who believes that the first quarter is going to be a 7% GDP. But no, what does my committee think? We have to start the voting. The first most important vote, what will the MPC do to the repo rate on August 5th? First, Samiran, your call?
No change.
Okay. Sonal, your call?
Hold.
Saumya?
Hold.
Ajit? Dr. Sen, the committee is already overwhelmingly hold.
Hold.
Hold. All right. So, gentlemen and Sonal, thank you very much for a very interesting Citizens Monetary Policy deliberations. Let's see what we get on August 5th. Thanks much for watching.
Hello and welcome to Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening. Crude oil prices rise amidst conflicting signals from the US and Iran on the status of the negotiations to end the 5-month-old war. President Trump claims talks are underway, calls it a last chance for Tehran. The Strait of Hormuz remains choked. A cargo vessel gets hit by a projectile near Oman.
Based on a shortage, they're making too much money. I don't like it. When we're finished with Iran, you're going to see the prices drop through the floor. But they made too much money. Too much money.
President Trump turns up the heat on oil giants again, pushes them to cut prices as they book bumper earnings amidst the Gulf oil squeeze. BP's profits more than doubled to $5.7 billion. Saudi Aramco's profits jumped 33%. The Sensex and the Nifty end in the red even after pairing losses in the closing auction. Banks and mid-caps also declined. 35 out of the 50 Nifty stocks end with cuts. The rupee remains on a tight leash, but bonds rally on the eve of the RBI's monetary policy. 100% of market participants polled by CNBC TV 18 expect the status quo. 60% expect at least one rate hike this fiscal. The government tables a bill to amend tax laws, removing a blanket ban on network fee on prescribed digital payments. Industry sees this as a precursor to impose a merchant discount rate on UPI payments to large merchants. Sources say smaller transactions and merchants could remain charge-free. The government's disinvestment mop-up is set to cross 53,000 crore rupees. The 6.5% stake in LIC kicks off through an offer for sale as the centre eyes 31,000 crore rupees. Sources say there will be no further stake sale in LIC for 2 to 3 years. Nvidia places chips on Sarvam, leads a $74 million funding round in the homegrown AI company. Investment is part of a larger $300 million fundraise, valuing Sarvam at around $1.5 billion. Meta executives scheduled to meet government officials tomorrow. IT Secretary says the tech giant would be asked to clarify on a host of issues surrounding child sexual abuse material, WhatsApp username policy and safeguards against content takedown for prominent personalities. The meeting comes days after a video of Prime Minister Modi on Facebook was briefly removed. Meta attributed the incident to a technical error. The food safety regulator prohibits Dabur from selling products with 100% claims, including honey, ghee, edible oil and other items. Says such labeling is against the law and misleading. Dabur says its product labels comply with the law and is seeking legal advice on the future course of action. Well, straight to the top story this evening. Conflicting signals on the status of negotiations between the US and Iran. Now, President Trump has warned Iran that it has one last chance to reach a deal. Here's a look at the latest developments. President Trump says he wants to give Iran, quote, one last chance before decapitation. Trump went on to say he will not let Iran charge a fee for transit through the Strait of Hormuz. President Trump also maintained that talks are underway, reiterating that the US attack stopped only because Iran and other Gulf nations asked him to do so. However, Tehran refuses to back down and has warned of a full-scale offensive operation if the US escalation continues. Military advisor to Iran's supreme leader said Tehran will not tolerate the US naval blockade in the strait. He also warned of serious risks and casualties to US forces if it continues. Meanwhile, in Gaza, the US-led Board of Peace has said Israel will not withdraw from Gaza until Hamas completely disarms. This as Israeli forces killed at least 19 Palestinians in Gaza in strikes over the weekend. Here's President Trump issuing a warning to Iran.
I think we're going to maybe get something, but I want to give them every last chance before decapitation. Very tough to do what we have planned, still planned. We'll see what happens. For some reason, when they're talking, they don't like saying that they're talking. So I say, wait, we're in talks. Big deal, we're in talks. And they'll sometimes deny it, even though they spend hours and hours together talking. No, the talks are going along.
Well, that's President Trump, and all of this impacting Brent crude prices, which have surged past the $90 mark after briefly retreating in yesterday's session. Now, shipping traffic in the Strait of Hormuz remains constrained. According to chip tracker Kepler, the waterway recorded just 9 transits on the 2nd of August. A cargo vessel has been hit by a projectile near the Gulf of Oman. Crossings in the Red Sea are also lower. The higher oil prices are boosting balance sheets, though, of oil companies. British oil giant BP's profits more than doubled in the second quarter. Meanwhile, revenue rose 47% to $70 billion. The world's largest oil company, Saudi Aramco, has also seen a 33% jump in its profits in Q2, despite shipping disruptions. Aramco has managed to insulate its supply through its east-west pipeline in the Red Sea. President Trump has turned up the heat on oil giants, once again accusing them of making too much money and pushing them to cut prices. Oil giants like BP maintain that prices depend on global commodity prices. The firm also said it is prioritizing availability of products that consumers need the most, like jet fuel and diesel.
Based on a shortage, they're making too much money. I don't like it. And I should be the last one to say, because I'm a big free enterprise guy, nobody bigger. And, you know, you're going to see oil, when we're finished with Iran, you're going to see the prices drop through the floor. But they made too much money, too much money. Chevron, too much money. ExxonMobil, too much money. When you look at one company where they made 12 times what they made the year before, they're going to give some of that back to the public, and they better cut the retail price.
Well, that's President Trump pushing oil companies to cut prices. A Ukrainian drone hit a crowded beach in southern Russia, killing 7 people, including 3 children. Now, nearly 40 people were injured, with more than 17 taken to hospital. Russia has accused Ukraine of deliberately targeting civilians. Some Ukrainian channels claimed electronic warfare may have disrupted the drone's signal. 25 American states have sued the Trump administration over its latest tariffs pegged at between 10 to 12.5% on goods from 60 trading partners. Now, these states have called the taxes a pretext for replacing the import taxes that the Supreme Court had struck down in February. These states have asked the U.S. Court of International Trade to declare the duties unlawful and also order refunds. So that's the latest legal challenge being mounted against the 301 tariffs. On to the market action back home. It's day 2 of the new closing auction rules, and it was another day where the Wall Street saw a sharp jump in the final minutes of trade. At 3:15 p.m., the Nifty was at 24,436. That's 3:15. 3:30, 24,615. A 150-point up move in just a single tick. Meanwhile, the Sensex, which was at 78,315 at 3:15, jumped to 78,429 at 3:30. The Nifty closing over 0.5% lower, while the Sensex ended only 0.2% in the red. The Nifty Bank slipped 341 points, closing 0.5% lower. So that's the Nifty Bank for you, and the Nifty 100 also lower by a little over 0.5%. In the money market, the rupee on a tight leash against the dollar. The currency was largely flat as it remains above the 95 mark. 10-year bonds rallying in trade and the yield softened ahead of the RBI's monetary policy. 95.37 is the dollar rupee for you. And of course, track all the monetary policy action right here on CNBC TV 18. We will bring you live coverage. So what are the markets expecting from the RBI tomorrow? All market participants polled by CNBC TV 18 expect the RBI to leave the repo rate unchanged. So a status quo policy is what the street is expecting, while most also forecast no change to the central bank's FY27 GDP or inflation projections. But 60% expect at least one rate hike this fiscal. That is the expectation as far as the rate hike cycle is concerned. The government has tabled a bill to amend tax laws which give it flexibility to impose network fee on certain UPI payments should it desire so. The move has fueled industry expectations that it could pave the way for reintroduction of a fee on large UPI transactions made by an individual to select merchants. Remember, the bill has only been tabled. The proposed tweaks only give the government flexibility to notify which digital payment modes would attract a fee. Ritu joins us now to decode the proposed amendments and its implications. Ritu, what does this mean?
Well, let me start with the fact that UPI payments remain free, but the government has proposed a legal change that can pave the way for charges on certain UPI transactions in the future. Now, here's what's been proposed today. Section 10A of the Payment and Settlement Systems Act says certain prescribed digital payments cannot be charged. That list is then linked to Section 269 SU of the Income Tax Act, which specifies the payment modes that businesses should offer. Now, the government wants to remove this link. Instead, Section 10A will allow the government to decide through a notification which payments modes should or should not remain free. So, this does not immediately bring MDR on UPI, but it simply gives the government flexibility, legally speaking, to introduce MDR on some UPI transactions in future if it so decides. And this is why the industry sees it as a precursor to MDR on UPI, particularly for large merchants. Now, we understand the structure that was discussed could cover person-to-merchant transactions of more than 2,000 rupees in value, while smaller merchants and low-value transactions could remain MDR-free. Now, Jefferies estimates that an MDR of 15 to 30 basis points, for instance, that could create a revenue pool of 5,000 to 10,000 crore rupees for payment platforms together by FY28. It says transactions of more than 2,000 rupees account for just 4% of the P2M transaction volumes, but 67% of the person-to-merchant transaction value. Now, MDR fee is typically shared across the payment ecosystem, and Jefferies estimates payment platforms can retain around 5 to 10 basis points, and for companies like Paytm and Pine Labs, that could create a meaningful new revenue stream. In fact, it estimates 300 to 700 crores of potential revenue for Paytm and 50 to 150 crores for Pine Labs if MDR is indeed brought in.
Well, that is the big uncertainty and the big question. If MDR is brought back, of course, that bill has been tabled. It has not been passed just yet. As of today, there is no change. Shares of LIC fell nearly 9% in trade after the government launched an offer for sale to pare 6.5% in the state-owned insurer. The government is eyeing around 31,000 crore rupees from the issue. Sources tell CNBC TV 18 that the centre has assured investors there will be no further dilution of LIC stake over the next 2 to 3 years. Hormuz joins us now to bring us the latest on the NIC stake sale and the government's disinvestment report card. Hormuz.
It's a healthy subscription to the non-retail portion, fully subscribed when it comes to LIC on the first day. But the bigger story is the fact that the mission mode that the government is in when it comes to disinvestment this financial year. Now, of course, the LIC OFS was a much awaited one. The last time the government sold stake was during its IPO back in 2022, which was around 3.5%. Now it plans to sell a 6.5% stake, provided the green shoe option is fully subscribed as well. And if that happens, they'll be able to mop up a cool 31,000 crore rupees. Of course, LIC is not the first company where they have mopped up stake this time around. Look at Coal India, BHEL, NHPC, GIC, other companies like IRFC, NLC India, Central Bank. Together, these offer for sales have managed to garner over 23,000 crore rupees for the government. Now, if you include, assuming that the full OFS for LIC is fully subscribed as well, that will take the tally past 53,000 crore rupees, which will be almost 2/3 of the government's disinvestment target, which is close to 80,000 crore rupees for this financial year. Of course, LIC is not the only company, again, where the government stake is in excess of 75%. There are 14 other companies as well. Now, if you take the excess government stake in these 14 companies, which is above 75%, that total value as of the current price comes up to nearly 1.5 lakh crore rupees. Now, which are those companies? Of course, LIC tops that list. We are putting the government stake here at 90%, assuming that the OFS is fully subscribed. That excess 15% stake is valued at over 76,000 crore rupees at the current price. There's Indian Overseas Bank, IRFC, Masgaon Dock, all of them having that excess government stake valued at anywhere between 6,000 rupees to 11,000 crore rupees. So it's a big disinvestment drive that the government has embarked upon. It is only through these offer for sales that the tally may cross 50,000 crore. If you add more the QIPs and so on, that number goes even further, and the government definitely looks to be in mission mode for achieving that disinvestment target.
All right, many thanks, Hormuz, for joining us. Paytm ended about 0.5% higher after a large block deal. Around 1.49 crore shares, or 2.3% of the company's outstanding equity, changed hands. The shares were traded at an average price of 1,367 rupees apiece, valuing the transaction at over 2,000 crores. We learned from sources that Saif Partners was a likely seller. The floor price was at a 5% discount to yesterday's closing price. Nisho also in focus on the back of a big block deal, over 10 crore shares changing hands worth nearly 2,000 crore rupees. Elevation Capital and Peak 15 Partners entities were the sellers, offloading the stock at 182 rupees apiece. The sale was at a 5% discount to Monday's closing price. The stock had listed in the markets in December last year after a blockbuster IPO. Shares of Dabur slumping in trade after the food safety watchdog, the FSSAI, ordered the company to stop selling several food products carrying the 100% claim. Now, the FSSAI claims that the terminology is ambiguous, unverifiable and potentially misleading to consumers. The food regulator has said that its prohibition order covered products that include honey, apple cider, virgin coconut oil and other products carrying these claims. Dabur has said that its product labels comply with the law. It's seeking legal advice on its future course of action. We will head into a break, but up next, NVIDIA places the chips on Sarvam, leads a $74 million fundraise in the homegrown AI company. That and more when we return. Apple's annual sales in India crossing 10 billion for the first time in FY26. As per Bloomberg, iPhones drove the bulk of the growth, with iPad and MacBook demand also on the rise. The milestone comes as Apple expanded its retail footprint in India, so 10 billion in FY26. Gaming company Nazara Tech has appointed Raymond Stauffer as its new chief executive officer. The company's founder, Nitesh Mittersain, will step down from the role to focus on long-term strategy and portfolio direction. This came as the company announced its first quarter results. Nazara's revenue dropped 14% on an annual basis. The company also reported a net loss of over 82 crore rupees in the June quarter. Fast fashion giant Shein is reportedly planning to launch its initial public offer in Hong Kong as early as the middle of August. Reuters reports that the company is targeting a valuation of $30 to $40 billion. This is significantly lower than its $98 billion valuation in 2022. Nvidia has bet big on Indian AI startup Sarvam. The chip giant led a $74 million funding round in the homegrown AI company. The investment is part of a larger $300 million fundraise, and this will value Sarvam at around $1.5 billion. Rachna brings us more details. Rachna, take us through the contours of this investment and Nvidia's bet on Sarvam.
Nvidia has been powering Sarvam AI for a while now. Today, it wants a piece of the company itself. Sarvam's board has approved a fresh raise of about $74 million, roughly 698 crore rupees. This is as per a filing with the Ministry of Corporate Affairs. Now, Nvidia leads this round with 238 crore rupees. That's about $25 million. Gladebrook Capital follows with 190 crore rupees. Gaja Capital puts in 95 crore rupees. And a set of family offices and angel investors make up the balance. Now, three things are worth noting here. First, that this is not a fresh round. It is the second close of a Series B that was never actually completed. Sarvam announced a $300 million round back in June and closed only 234 of it. That left about $66 million on the table. Now, this tranche covers that gap and adds a little more to it. Second, look at the price. The issue price works out to the same $1.5 billion valuation Sarvam published in June. So this is a flat extension and not a step up. Nvidia is coming in at the same number HCL Tech came in at 7 weeks ago. Third, and this is the part that matters the most here because the relationship between the companies is not new. Sarvam already trains on Nvidia hardware. At its developer conference, in fact, last week, it said it has access to about 2,000 Blackwell GPUs and is targeting 10,000 alongside a sovereign data center partnership with HCL Tech in Odisha. So Nvidia was already the supplier. What changes today is that the supplier becomes a shareholder, and that is a pattern Nvidia has run all year, taking equity positions in the very companies that turn around and buy its chips. It has committed upwards of $40 billion in equity bets in 2026 alone. Analysts have a name for this strategy. It's called the circular investment theme, which is why the real question for Sarvam is not the money. It is whether any part of this check comes tied to compute commitments. One caveat before we move on here is that a board approval does not mean money is already in the bank. The allotment is yet to be confirmed. Sarvam has not announced this itself, and Nvidia has not commented either, so we'll keep an eye out for more.
Yes, thanks very much, Rachna, for joining us. That is the latest there as far as Nvidia's deal with Sarvam is concerned. Let's move on now to other news that we are tracking here this afternoon, and this is the latest on the flood situation in Assam, which is showing signs of improvement. Water levels finally receding across several affected areas. However, the death toll has now climbed to 87 after 2 more fatalities were reported from Sivasagar district in the last 24 hours. According to the Assam State Disaster Management Authority, nearly 1.28 lakh people across 6 districts still impacted by the floods. And Kerala continues to battle heavy rainfall, with floods, mudslides and waterlogging disrupting normal life. The death toll from rain-related incidents has now risen to 15 in the past 3 days. The Weather Department has issued a red alert for 8 districts and has warned of strong winds. The monsoon session of Parliament continues to see disruptions. Protests by the opposition triggered repeated adjournments in both houses. Leader of the opposition in the Rajya Sabha, Mallikarjun Kharge, alleged that donations collected for the Ram Temple in Ayodhya were misused and called for an independent probe. The Congress also demanded a statement from Home Minister Amit Shah on the police action against student protesters in Delhi. The BJP accused the Congress and its allies of deliberately stalling Parliament and blocking discussion on key bills.
इस ट्रस्ट का गठन केंद्र सरकार ने किया है। प्रधानमंत्री ने खुद संसद में ट्रस्ट के गठबंधन की घोषणा की और सरकार ने 70 एकड़ से अधिक भूमि ट्रस्ट को सौंपी। प्रधानमंत्री जी बताइए ईडी, सीबीआई, और अन्य केंद्रीय जांच ये मुद्दा को लेकर के वो संसद के बाहर भी हंगामा करते हैं या चलने नहीं देते हैं, तो दूसरा का बात सुनता नहीं है। आप खुद ही बोलना चाहते हैं, वो मिसयूज करना चाहते हैं हर समय। ये हम लोग इसको मंजूर नहीं कर सकते हैं।
Well, that is action from Parliament. Now, Meta's executives are scheduled to meet government officials tomorrow. Speaking to reporters on the sidelines of an event, IT Secretary S. Krishnan said the tech giant would be asked to clarify on a whole host of issues, including safeguards against content takedowns for prominent personalities. Ashmit joins us now with the latest. Ashmit, give us a sense of the issues that are likely to be discussed during this meeting between Meta executives and the government.
Well, Meta has been on the receiving end over the last 15 odd days. We've seen Meta being pulled up by the parliamentary panel just yesterday. That was specifically pertaining to the issue of the takedown of Prime Minister's selfie video, subsequent to which Meta has given clarification, calling it a technical error, even saying that they'll go to the extent of deploying additional safeguards. However, the issue that is likely to come up tomorrow's engagement is likely to be on the twin issues of, number one, the WhatsApp username policy, and number two, child sexual abuse material being identified on Instagram. On both these issues, we're given to understand that the government has a whole host of queries. Number one, the government is likely to query Meta as to its understanding of what the law of the land is, what they're required to do, what their efforts are with respect to ensuring compliance. They're also likely to question Meta with respect to additional safeguards that are being deployed, what the learnings have been for the last from the last 15-20 days, what Meta can do over and above what it has already been doing. And of course, we also heard from Secretary Krishnan, who said that this is, after all, one of the leading tech companies on the world. So there is no want of technology that is available with the company in question to deploy those additional safeguards. So clearly a lot that Meta will have to answer for. The meeting will, of course, begin tomorrow. For more on that, let's in fact listen in to Secretary Krishnan, the MeitY Secretary, giving clarity on what the line of